and I welcome you all to the Almus Rupee Money Conference 2022. Let's have a huge round of applause. Louder, ladies and gentlemen. Almus Risk Consulting is a risk management company whose specific focus is a complete tactical and operational solutions that focuses on foreign exchange treasury, covering currency rate risks, related interest rate risks, and commodity rate risks. The client can choose to outsource its entire forex treasury, front office, middle and back office, or component of each activity being performed on a technology management system. Almus team and partners have corporate treasury and practical expertise as well as technical and fundamental knowledge of financial markets with wide and rich experience in banks, including public and private sector, as well as foreign banks and corporate treasuries. Almus Rupee Money Conference is an annual event that brings together the entire ecosystem of the financial markets. The conference has always been a culmination of various thought-provoking engagements done through the calendar year. And now, before we begin, as is customary, we invoke the gods by lighting the ceremonial lamp. May I please invite Dolly Chaudhary, Director, Promotions and Marketing, GJEPC, on stage, please. Mr. Sunil Patwari, Managing Director, Nagrika Exports. Mr. KG Chandrasekhar, Senior Director, Finance and Accounts, Dissolve. Ladies and gentlemen, a huge round of applause. Mr. Arnav Mehta, Director, Blue Star. Mr. G. Padmanabhan, former Executive Director, Reserve Bank of India. Mr. Govardhan M., co-founder and partner with Mr. Venkatesh S. Bijur. Mr. Jairam Krishnamurthy, co-founder and COO, Almus Risk Consulting. Please. And Mr. Pankaj. Can we have a huge... Ladies and gentlemen, a huge round of applause. A huge round of applause, ladies and gentlemen. Thank you so much, ladies and gentlemen.
Respected Mr. G. Padmanabhan sir, Mr. Malingam sir, Mr. Anant Narayan, who's yet to come in, Mr. Srinivasan Vardarajan sir, dignitaries, our esteemed clients, our prospective clients, the friends from the financial market. Good morning and welcome everyone to the 9th edition of Almus Rupee Money Conference. And it takes me an immense pride to say that this is the 9th edition and we have been one of the most consistent corporate treasury event in this part of the world. Friends, motivation is what gets you started and consistency is what keeps us going. And I can tell you, we at Almus Rupee Money Conference at Almus, for us, your participation, your enthusiasm, your response, your presence here keeps us going every year to conduct this Almus Rupee Money Conference in spite of all the odds, including COVID times. And we have been very consistent over the last 8 years and into the 9th year. This is made possible with support from sponsor partners, and I welcome all of them. We have had many sponsor partners who have been with us for last almost 8 years. I welcome principal sponsor National Stock Exchange along with Cogensis, the gold partner Union Bank of India, the gold partner Aditya Infotech Limited, our client who owns CP Plus brand, the banking partner RBL Bank, the silver partner Gandhar Oil Refineries Limited. This year we have new entrant to the sponsor partners list, and that is CFO Bridge, Trontech. And we are proud to say that this year we got support from GJEPC, Gems and Jewellery Export Promotion Council, a trade body that is sponsored by Ministry of Commerce and Industry, the trade body that consists of almost 7,000 plus members, contributing to about 10% of the country's total merchandise exports and employs about 7 million people. And we are really indeed proud and honored to have their support this year as well. And the list goes on because we have many supporting partners who are contributing and supporting to our initiative of this financial sector development. And that is what Almus Rupee Money Conference is known for. Some of you have been a regular participant to this Almus Rupee Money Conference, whereas some of you may be attending for the first time. And there could be a question as to what is this Almus Rupee Money Conference all about? And I'm going to take a few moments to share the entire concept of Almus Rupee Money Conference and why this conference. It all began with bringing together the entire ecosystem of the financial market, specifically focusing on the forex and the bond market. We have in this room throughout the day the bankers, the regulators, the corporate treasurers, CFOs, and they contribute together in deliberating some of the critical issues. Now it's a free-flowing conversations throughout the day in the presence of the regulator, and the issues are not just deliberated. In fact, issues are acted upon. And here is some of the cases in point that I am referring to. Going back in times in 2015, at Almus Rupee Money Conference, we talked about internationalization of rupee. Look at current year, 11 July 22, this year, RBI came out with trade settlement in INR, a step towards internationalization. Maybe a tiny step, but it is significant. Even as recent as October 22, Deputy Governor RBI made a strong pitch for internationalization of rupee and listing out various positive aspects, and at the same time quoting very clearly that could be a risk associated with that, but that is unavoidable. Fast forward to 2019, and I know at the same place we talked about gateway of Indian rupees, Mumbai and not London, wherein we talked about bringing back the market here, back in India. In 2020, RBI came out with a circular which allowed the banks to participate in the international exchange, international market, NDF market. 2020, I remember we deliberated on bringing margins to the mainstreams. We talked about transparency in quoting the rates. RBI subsequently made it mandatory for all the banks to quote the mid-market rate. Even to the extent of, they mentioned that you'll have to timestamp all the forward market deals, all the forward contract deals. Now, the list can go on. The point is that there are some serious deliberation that takes place and finally gets acted upon. Now, the question is, how do we produce these results? Is it just an accident? We discuss some of the issues and finally it gets converted into a policy redrafting. Is it merely a coincidence? Now, with due permission from Malingam sir, Padmanabhan sir, and Anand Narayan, who is not here, I take the liberty to say, sir, we have a trio at Almus. And this trio, hai to sab kuch mumkin hai. And I'm going to explain this with a small story. In the good old days, when the king wants to know the ground reality of or the conditions of the common man, the king will change its outlook and walk on the street, being the common man. Here, in the good new days, I would say, when the central bank wants to know the conditions of the market participants, central banker takes off the title, being one of the market participants, and I'm referring to Padmanabhan sir and Mahalingam sir. And if that is not enough, we also have a case of a switch role where the market participants become the regulator. And I'm referring to Anand Narayan sir. On the same dais, I know I have introduced Anand Narayan as a banker, as an academician, and today he will be with us as one of the regulator, a whole-time member of SEBI. So, with the passion and the commitment that they bring forth, our issues are being heard. Our issues are being acted upon. And there is definite change. The policies are being redefined. And I want all of you to know that in the process, all of you, all of us are contributing to policy making. That's really the significance of Almus Rupee Money Conference. So that as a background, let me now come to the current year, 2022, and this year's theme of the conference. Now, as a risk consulting firm specialized in managing currency, commodity, and interest rate risk, one thing which I candidly admit from this year's experience is some of the best risk management practices and the principles have been under test. Whatever prudent decision that you may think at that point in time turns out to be either a bad or a irrational because the way market is. As you all can see, 2022, and most of us are already experiencing this. Probably 2022 will go down in the history as one of the year which is the year of change in the world order. There are significant shifts that we all are experiencing anyway. In fact, some of the shifts that are very noticeable, a shift from a bipolar world to the multipolar world. A world that exists with a one manufacturing nation and a one consuming nation, now it's a multipolar world. A shift from a very strong supply chain to maybe a fragmented one. Maybe a shift from a dollar-denominated trade to maybe a bilateral regional currency trade, and many more. In today's session, throughout the day, all of you will experience maybe a new lens to look at the perspective of the recent developments and the trends that may come in 2023. And that may probably help you in managing your business, managing the risk that you are already sitting up with. And we really do not know. Someone says 2022, if it was bad, we don't know. 2023 could be even worse. The question really is not what the market will be. The question is, how am I, as a corporate entity, dealing with those risks? How am I sustaining, stabilizing my business on the face of all the risks that could exist anyway? So we have lined up some of the eminent speakers throughout the day. Some of the sessions are curated, centered around this theme, being able to manage the risk no matter what the outside volatility could be. And at the same time, we have kept few sessions which are an inspiring stories. Those are the breakout sessions throughout the day. And I'm sure during the day, for any help, any support that you require, Mansi is anyway going to take care of you. Our registration desk that you see will convert itself into a help desk. So feel free to reach out to any one of us. And finally, I'll come to the last section of my opening remark, a very special moment. And that's an honor that I have, that's a privilege that I have of introducing our mentor to the conference, Mr. G. Padmanabhan sir. Now, before I introduce him, sir, observation. Now, all of us carry maybe the same title for the last many years. I've been a co-founder and CEO of Almus Consulting since the conference started. When I keep getting the profile every year, either your title is different or your title is expanded. So, I'm going to introduce you, sir, as someone who is presently the independent non-executive director at Axis Bank. He is also the senior consultant at AZB Partners. He is currently chairing the committee set up by IFSCA for creating a framework for stress assets from domestic lenders to financial institution, IFSC. And he was earlier non-executive chairman of Bank of India and executive director, Reserve Bank of India. But one title that he has retained over the last 8 years is mentor to the conference. So please join me in welcoming Mr. G. Padmanabhan for mentor's address. Sir, please.
Good morning, ladies and gentlemen. I think, first of all, thank you for that very generous introduction. It's always a pleasure to be back at the Almus Conference, 9th edition, as Maulik said. And I enjoy coming back every year because probably this conference can boast of bringing together the best of speakers and some of very good discussions that happen during the day. I think it's after two years we are meeting physically fully, and I think that again brings back. I think a conference or a kind of a talk will have to have an eye-to-eye contact, and however much we have progressed as far as the webinars and web talks are concerned, I think it's a different feeling when you have the audience before you and there is an eye-to-eye contact. A special welcome to our guests of honor. Anant Narayan is yet to reach. My friend, Union Bank Non-Executive Chairman Srinivas Varadarajan, and of course, my long years we were together in the Reserve Bank, Mahalingam. Now, I would probably claim that all of us in a way represent the glimpse beyond the obvious. For me, basically, I think there's a general feeling that if you're a central banker, you cannot do anything worthwhile other than central banking. I ended up being the chairman of a large bank. It was a unique experience for 5 years. Dealing a lot with the private sector now. I'm an independent director in the private sector bank. Mahalingam probably straddled two entities, Reserve Bank and the SEBI, which the public thinks cannot see eye to eye. So Mahalingam went there. Anant and Srini, as I call them, I think they are unique in their own way. They have been, most of their careers, they have been in the private sector, and now they are stepping onto the public sector, and that again is a unique experience. So I would think that four of us being here represent the title, Glimpse Beyond the Obvious. I think Anant, as all of us know, has been with us for almost every year. For Srini, this is the first experience. I hope you find this event very useful, that you will continue to come back every year and, more importantly, support us year after year. Now, the theme for this event, for every event, and particularly this event, I must say has been very carefully chosen. And most of you do not know, which I think it's my duty to tell, is that in this entire planning of this event, including deciding on the theme and the flow of the event, there is a young member of the Almus team who works or who starts the work many months ago, first comes to me and starts discussing about the various themes, and he meticulously plans even the flow of the event. I am not talking about, I know the efforts put in by Maulik, Bijur, etc. I think I need to flag here the efforts put in by a young member of Bijur's team, which is Sumant Prabhu. I think he has been taking enormous interest. And is he somewhere here? Just outside. Can we call him in? Yeah, come here. Let public see you. I think give him a big applause. Now, the theme glimpse beyond the obvious, may I say, states the obvious in today's times. And what is this obvious? I think you need out-of-the-box thinking. You need completely new thoughts. Now, you have to carve out new paths. Now, you have to manage new risk, manage the unknown unknowns, and then still come out triumphant. This is indeed a very hard task. Now, I would say that be it regulators, be it the institutions, be it businessmen, be it the government, I think the challenges are enormous. Now, all of us know that the interest rate cycle is reversed. And as one of the leading economists said, in today's context, it is easier to write a narrow, well-researched piece rather than to connect dots across seemingly unrelated terrains. But the fact of the matter is, unless we do that, we cannot survive. So it is in this context that we need to think about policy making and find answers to perhaps, I would think, some of the questions which I think are relevant. I think what are the medium-term risks to the economy and the financial stability if real rates continue to rise substantially? Now, is that something we have completely thought through? Do we have answers to all of them? The implications of the monetary tightening on the household expectations, particularly the hardening of the oil prices, which started happening before Ukraine, and Ukraine is a story which is not likely to end very soon. In fact, I can share with you that I was having a discussion with one of the leading bankers from Russia, and since the discussion was open, I asked him a question. Basically, what percentage of Russians really support Putin for what he is doing in Ukraine? And let me tell you, the answer I got was 85% of the Russians support Putin. Now, so that is not going to go away easily. Corporate debt and the implications of increased volatility, how that is going to be treated. Now, when we are talking about increased volatility, we can even talk about retail debt in the Indian context, particularly the housing sector. The implication of volatility from the markets, particularly the government and the bond markets, and in the Indian context, the foreign exchange market. Now, I think towards the end of today's session, Mr. Viral Acharya will address you. And he has highlighted a very interesting concept. He says during the quantitative easing world over, massive amounts moved into the triple B rated bonds. And these are potential candidates for downgrade. When this happens, could we see a massive flight to safety? Possibly the answer is yes. And if that is happening, what are going to be the implications? Have we understood it in its full perspective? Now, I conclude by saying that just like my role for this conference is very easy, being a mentor, hard work gets done by others. I think probably in an uncertain world, it is easy to be analysts and commentators rather than be in the boots of the government and the regulators. Now, sustaining stability is a nightmare as far as any central bank is concerned, because there is nothing to refer to or fall back upon. This is a new script they will have to think about. Even more for the players who have to be unconventional and at the same time agile. Now, I hope this conference and the networking that happens during this conference finds answers to some of these difficult questions that enable, at least as the theme says, to get a glimpse, at least a glimpse beyond the obvious. Thank you very much, and all the best.
Thank you so much, sir. I would now like to call upon Mr. Venkatesh S. Bijur on stage, who is the co-founder and chief strategy officer at Almus Risk Consulting LLP, to please introduce our next speaker. Ladies and gentlemen, a huge round of applause for Mr. Bijur.
Thank you and good morning. Welcome, Mr. Anant Narayan and other dignitaries and participants of the conference. I have a privilege to introduce Mr. Srinivas Varadarajan, one of the outstanding market participants of our times. Right now, he has taken a role of non-executive chairman, Union Bank of India. Mr. Srinivasan is a banking veteran and market expert with more than 3 decades experience in financial services. His career has spanned commercial banking, investment banking, international banking, treasury and global markets. The last he served as a deputy managing director at Axis Bank before setting up his own advisory practice about 3 years back. As a financial advisor, he has worked with diverse set of firms such as leading international consulting firm, a sovereign wealth fund, a large corporate group, and NBFC. He joined Axis Bank as the executive director corporate banking in 2009 and was elevated as a deputy managing director in October 2015. At Axis Bank, he was responsible for wholesale banking, SME, mid-corporate, business, transaction banking, international business, and treasury. He was also chairman of many subsidiaries helping to grow their business before joining Axis Bank. Mr. Srinivasan was managing director and head of markets with JP Morgan India. He was also the CEO of JP Morgan Chase Bank in India. Prior to JP Morgan, he worked with ICICI Group. He has served several RBI committees, including the Technical Advisory Committee, Committee for Repos, and committees for STRIPS. He has also held position of chairman of Fixed Income Market and Derivatives Association, FIMDA, and chairman Primary Dealers Association of India. He has recently been appointed as non-executive chairman, Union Bank of India. It's a very welcome step by the government to appoint the eminent bankers and IIM graduates to the banks as a non-executive chairman. And I recall the contribution made by Mr. Padmanabhan sir to the commercial banking when he was the non-executive chairman. We look forward to hear and the contribution to the entire financial sector and Union Bank in particular. He holds engineering degree from College of Engineering, Anna University, Chennai, and is an MBA from the Indian Institute of Management, Calcutta. Sir, it's over to you.
That's okay.
Very good morning to all of you. It's a pleasure indeed to welcome all of you to this conference of alumnus. As Mr. Padmanabhan said, this is the first time, and I'm sure he'll keep coming back. As Chairman of Union Bank of India and a principal sponsor of this conference, I also welcome you in that role. Today morning, I think right from Mr. Maulik to Mr. Padmanabhan, I think the talk has been different roles being, or different hats being donned by all of us, whether it's Mr. Padmanabhan, Mr. Malingam, Anand, me, and whatever. And I would like to don the role of whatever Mr. Padmanabhan said in the end, which is as a commentator, as an analyst, because I owe no one anything. So I'm just going to say that 30 years I've been in the markets, or done whatever related to markets. What are the lessons from it? Because this is not for people who are in the markets, and this is basically for the users of markets, this presentation is primarily from the users, because I presume the customers of alumnus are primarily users of these markets, and what they should keep in mind as they do things related to their roles. And that's why I just thought it's useful to sort of step back, not talk anything about markets, keep it plain English, and then tell you how you should sort of approach things when you have a role to play as a treasurer or a CFO as far as a corporate is concerned. In your roles, I think it's important to sort of, I'm sure you're going to have enough sessions through the day in terms of telling you what the volatility is, how things are so uncertain, how things are so going to be so difficult, and how we don't know what's going to happen. So as all of us know from our own mythology and scriptures, that it all comes from within. We need to stabilize ourselves. So when you're talking of sustaining stability in your organization, in keeping your head steady in markets, it's important to sort of make sure that first you steady yourself. And first, for steadying yourself, what are the things you should keep in mind? And I think that's what I'm going to go through. It's not only for markets, it's for life too. Yeah. First, you should understand. I've been on the marketing side, sales side in a bank, in a foreign bank, whatever. We know how to sell trades. We basically have to be clear that things that never happened before happen all the time. Whether it is markets, whether it's life, whether it's sport. So yesterday what happened? Croatia beat Brazil. None of us would have thought it would happen. So the whole thing of saying that last 100 years I've seen data, last 50 years I've seen data, last so many years I've done this and whatever, and trying to say that, boss, it's never happened, so it's never going to happen today. So never predicate any of your calls on saying, boss, it's never happened before. Whether you call it a black swan, whether you call it whatever, it's important to know that everything has a context. In a particular context, things will happen which never happened before. So this is the basic thing in your mind you have to keep, always be aware of. Never do something because it's never happened before, based on that premise. This is a favorite thing of mine, a couple of quotes. First thing is, you have forecasts all the time. So what do these forecasts mean? No one knows what's going to happen tomorrow. However good he may be, how much of information he may be, how much of analysis he may have done. The more analysis you do, the better the presentation is. But ultimately, it's an educated guess of what can happen based on certain things he believes will happen. So if you go into a particular forecast, there will be a list of 5 assumptions. This has to happen. CPI data, NFP data, this data, Fed thing, whatever. There'll be five things. Five is in small number. Actually, there'll be 10 things which they will predicate on. If all this happen, then this will happen. But the headline will be just the forecast. The remaining 10 is not going to be there. But basic probability is, if this has to happen, and this has to happen, and this has to happen, and this has to happen, everything has a probability. And again, many math students will know the probability of all of them happening together is a much lower probability. So it's important to say that what are my assumptions? And is my assumptions something which is in sync with that? Then the forecast is something which can make sense to you. But you have to look beyond the forecast and then decide whether this makes sense to you. Because you may be looking at it in a different form. The assumptions may be for something else. So you have to understand no one knows what's tomorrow. It is something which you have to sort of take a call on your own, and everyone is guessing. Presentations may be good, analysis may be good, but you got to see how it works for you. The other thing you should understand, the most important things, forecasts always tell you more about the forecaster than of the forecast, than of the future. Any trader you speak to him, he's never going to speak against his position. So if he is bullish on the rupee, if he's bullish bonds, you clearly know from what he's saying, you know what his position is. Any analyst, any researcher, if they have a view, they're not going to tell you anything against it. So it always tells you where they are coming from, and you need to know whether you're going from the same place, whether you're in the same position. So you have to sort of strip. You got to look at the content, not about the view, because a forecaster has a view, has a position, has an axe to grind. And that is what the forecast is. So you always have to say, when someone's talking to you, giving you a view, I'm not saying it's right, wrong, whatever, but you always should be aware that it tells you more about the forecaster, and then try and sort of strip it out, try and sort of take out some of the frills attached to it and see what the essence of the thing is and whether it makes sense for you. So you got to be clear that any forecast tells you more about the forecaster than of the future. And that's something you always have to keep in mind as a user of forecasts. So all this, I think you're going to get a whole lot of information, knowledge, things today. I'm just telling you in what lens you need to look at it. And I think it will be useful for you to sort of try and condition yourself to look at it in that, because that's the way the real world works. So it comes from experience sitting on multiple sides of the table as far as the markets are concerned. That's the advantage of having been donning multiple hats. This is the most important thing. This is possibly the most important thing you have to keep in your mind. Everyone is playing different games. Focus on your board. Someone is an intraday trader. Someone is looking at a view for 1 week. Someone is looking at a view for 3 weeks. Someone is looking at a view for 1 year. Someone for 5 years. But the forecast is the same. You have to see what that forecast is for. Whether it's got a horizon, what horizon does it have, and what does it mean for you. You got to decide, what am I trying to do? What is my role? What is my goal? Then decide, how do I go about doing it? Don't look at the other guy and see, a lot of guys are doing something else, and am I right or wrong? Because he is playing a different game. He's not playing the same game as you. So you got to be clear that this is what I'm trying to do, and I will focus on what I'm trying to do. Don't get distracted by other people doing something else, because they are playing different games, and that game is not your game. Also remember, you're playing poker and not chess. The difference is quite a bit. In chess, from every move, there are only a finite number of moves you can do. It is a finite, maybe numerous, but it is finite. And therefore, your ability to sort of parse those moves and say which is the right move, and if you made a mistake, you can go back and say, this is where I made a mistake. In poker, you don't know what is coming. It is a probability thing. It's a question of you don't know what's the next car. You don't know what's the next hand. That is what markets are. That's what life is. That's what everything which we do on a day-to-day basis is. You don't know what is the next minute. You never knew what COVID was till 2020. You never knew the Ukraine war till it happened. So there are so many things. So these are fresh things. The cards being played are very different from what you thought it will be. So everything in life is, there's no solutions. There's never any solution. There are only trade-offs. You can only manage a probability. You can say, this is the max downside I can have. This is the 20% of the time I can be wrong. 10%. It's always a game of probabilities. You're never certain in anything you do in markets. It's always a trade-off. If I do this, there's 80% chance I may get this. 20% chance I may lose so much. 90-10, 50-50. If you're playing blind in poker, it is whatever, 5-95, whatever. So it is, you are always going to sort of, it's everything is probabilities. And you succeed not by saying I have a right trade. You succeed by gauging the probabilities right. What is the chance of me getting this right? If you're able to assess that, and then all of you know what the expected value of a trade can be based on probabilities, and then taking a call on that, that's the best you can do. You should always remember, like a guy who wins blind in poker is not skill, it is luck. You may take the best decision, it can go wrong, because you are already said 20% of the time I can lose. So that 20% can happen. So a good decision does not mean the right outcome. A bad decision does not mean a bad outcome. So decisions should be right. Outcomes can change because the probabilities always are there. Nothing is 100% right or wrong. No decision can be 100% right. There were always things which go wrong. So you got to be prepared for that eventuality and then say, what is the probability of that happening? And what is my downside on that? And how do I protect my downside? That's the way you got to approach how you manage your exposures. So there are no solutions. You got to keep this in mind. There's no solution. There are only trade-offs. There are only things like this versus this versus this. This way I think I can make so much, I lose so much. This way I think I can make much more, but the probability of loss is much higher. So what is the one we want to choose? You got to be clear on that. This is about each of you. You may have the best knowledge, you may have the best analysis, you may have the best thing, but human behavior is something you can never predict. So if you're not able to predict what the other person is going to do or how his behavior is going to impact you, you're on a slippery slope. So markets are not just data and analysis and Reuters and Bloomberg. Markets are also people. So you got to factor that in terms of trying to say, how does it impact me? What do people typically do in these scenarios? Are they going to run? Are they going to, how much stop loss is going to get hit? What's the behavior? Are people going to execute stop loss? Are people going to hold? I mean, these are things, I'm not saying everyone knows what's going to happen, but you have to keep at the back of your mind how people behave, how markets behave. So it is not just numbers and data. Most importantly, as I said, when you got a call right and you made a lot of money, you got to tell yourself, my ability has not changed before to after. It's not like I've become a superhero and I know everything in the markets after the trade than before the trade. You're still the same person. It just increases your confidence. It should not become overconfidence. It should not become rashness. Because you're still the same person. You can still make mistakes. You got something right. It doesn't mean, it's just the probabilities weighed in favor of you. Whatever you thought can go right, it happened. It's possible that it may not happen. So you got to tell yourself that past successes does not change who you are, does not change your ability. You improve as you take losses, not when you succeed. Let me tell you that. That's the next thing. Smart money is dumb money that has gone through a crash. You learn money when you lose money and say, boss, I will never do this again. I will have to be careful. So you sort of improve as a market professional as you sort of go through these ups and downs. But if you believe you're just going to be on an upswing all the time, and you are God and Superman and no one's as good as you in the markets will give you a huge lesson. So it's important for you to remember that you are still the same person before you made money, before you lost money, and after you made money, after you lost money. It is just that you got to go back and think that, yeah, my assessment in terms of probabilities was right or wrong. How do I next fine-tune my decision making? And that's what you need to do. You should not sort of become overconfident or brash. This is the simple thing. Need and hit sixes every ball, every over. I think the person who ultimately makes it is a person who does an average performance over a sustained period of time. I have a story on this. Basically, two people are climbing up a hill, and one person decides that come rain, come snow, come sun, he will do 10 kilometers a day. The other person says, if it's sunny, I will do 25. If it's too cold, I will just sit in my tent and I will not get out. Who do you think reaches the top of the hill first? It is a guy who does 10 kilometers per day all the time, irrespective of what is happening. So it is important to make sure that you sort of keep moving on, keep progressing, make sure the power of compounding works for you, and just move forward, and you will ultimately get there. Some flashes in the pan by people are sitting next to you or sitting in a different corporate in the same industry or whatever something should not bother you as long as you are on your trajectory. I use this analogy in a different context in another conference. Because people talk of India's decade, India's time has come and whatever, which can all be true. But I always keep saying India is the first guy. If global economy is doing well, it will do 8%. If global economy is not doing well, there are so many headwinds, you'll do 5.5%, 6%. But you will continue to do your 5 to 8% range every year, irrespective of what happens in the rest of the world. Whereas the others may have 4% one day, minus 2%, whatever. You keep doing this, you're basically almost at the same place. So what works for India is come rain, come snow, come sun, we continue to progress, we continue to do reasonably okay at a decent pace and keep moving on. And I think that's the trajectory we'll stay. So whether it's India's decade or not, I don't know, but we will continue to progress, we will continue to do well, and our power of compounding will work for us and we'll get to a good place. So what we need to remember is that you've got to sustain performance. A performance that is not sustained will not get you far. You'll just keep rotating in the same place. So these were some of my thoughts, the way you should approach this conference, the lens you should look at when people talk to you today and through the years. These are things which will help you succeed, not just in markets, but in life too. Thank you.
Thank you so much, sir. That was definitely very, very informative and some very interesting examples. I'd like to call on stage Mr. Bijur to please present the memento to Mr. Varadarajan.
Thank you.
I'd like to invite Mr. Pankaj Kumar Rathi, who is a partner and head treasury at Almus Risk Consulting LLP, to please introduce our next speaker.
Good morning, everyone. Thank you, Mr. Mahalingam, for accepting our invitation to speak on topic reimagining markets in a deglobalized world, challenges and opportunities. According to me, he is the most equipped person to speak on this topic since he has invested more than 4 decades of his professional career spanning across the financial market regulators, Reserve Bank of India and SEBI. He has also got best mix of FX and debt while in RBI and equities and commodities while in SEBI. He has taken on varied roles in RBI encompassing financial market development, regulations and operations, foreign exchange reserves management, debt management and regulation, and supervision of bank. He was executive director in charge of forex market intervention, as well as management of forex reserves of the country and rupee liquidity, policy and operations. His experience spans across most difficult time of the financial market, such as 2008 Lehman crisis, as well as taper tantrum in 2013 and 16. He was closely involved in giving shape to the foreign exchange policy and monetary policies implementation. In his role as a whole-time board member of SEBI between 2016 and 2021, he carried basically executive responsibilities as well. He has a wide experience of regulating mutual funds, stock exchanges, listed companies, foreign portfolio investors, corporate governance aspects, stocks and derivative markets, corporate bond market, and amongst others. Mr. Mahalingam started his career in the State Bank of India in 1978 after finishing his master's in statistics and operation research from IIT Kanpur. He is also an MBA in international banking and finance from Birmingham Business School in the UK. Welcome, sir. Please come.
Good morning to all of you. Thanks to Almus for this opportunity once again for me to interact with a very enlightened audience here. My special thanks, of course, to the Almus people, Mr. Maulik, Mr. Biju, and the entire team which has put in a huge amount of hard work here. And as Mr. Padmanabhan said, I think as a mentor for this particular conference year after year, I think the team under Padmanabhan has been able to produce excellent themes for discussion here and for brainstorming here, which has been pretty useful over the policy making arena as far as the 2 regulators are concerned, the financial sector regulators are concerned. I would like to start off by first acknowledging that generally I start my talk with macros. Thankfully, Anand took this job now, so I don't need to talk on the macros at all. So I will straight away plunge into the subject. And Srini gave an excellent account of, what you need to do as mantras for success, whether it is a market or whether it is a real life. 100% correct. My experience in the market is never feel that you are on the top of the market. Never. Because the moment you start feeling that, I think the market gives you such a mighty blow that you come down to earth. That's going to be the theme. Now, the topic which has been given to me, of course, I am going to do 2 roles. I am going to speak on this and I am going to be a part of the panel discussion also. So I'm not going to throw all the points out here. I have generously borrowed from what Anirudh actually put out as a kind of a subject matter for this particular panel discussion, reimagining markets in a deglobalizing world. Clearly, when we talk about globalization, we tend to restrict ourselves to finance. That's the general weakness that all of us have. Anant really highlighted it very well. We think the whole world is made of finance. We forget about the real economy. In fact, we talk to any engineer today, that guy, he says that I'm in the software, I'm in finance. Nobody says I'm a mechanical engineer, I'm a chemical engineer, and civil engineering is a forgotten engineering today. It's a very, very sad state of affairs, absolutely sad state of affairs. Unless the real sector is going to come to the forefront, which I repeat from what Anand says, I think the country has no future at all. I am absolutely clear about it. We can't really ride on the financial sector buoyancy to build up the GDP, which will come down crashing if the real sector is not going to support us at all. So when we talk about globalization, globalization is not just about finance. Globalization is about the countries of the world getting intertwined in terms of economic resources, financial resources, technology resources, health issues, climate change issues. I think all these are important. We can't really be looking at just the globalization of the finance. So when we talked about globalization, we are talking about free trade. We are talking about within the finance, we are talking about free trade, free remittances, reasonably free capital flows. This globalization process has never been a linear process. First of all, let me stress that it's not a one-off affair. It's a process. It lasts over a longish period of time, and there are hiccups. We did face a big hiccup in 2001 at the time of World Trade Center, New York accident. Subsequently, at the time of global financial crisis, European debt crisis. All this actually created some kind of a dent on globalization. When we say dent on globalization, the freer trades, the freer capital flows, the freer information flows, they were all actually impeded to some extent because of these incidents. Today, we are now stepped back and we are talking about a deglobalizing world. I am not in agreement with that, but of course the organizers have given me this topic, so I need to talk on that. I continue to believe globalization is a process which has begun quite some time back, almost about 3.5 decades back. We are firmly into it. To step back and reverse the direction is going to be well nigh impossible. I am repeating it, it's absolutely impossible. We are living in a completely interdependent world. We are linked to each other. And if we say that we are deglobalizing today, I would consider that as a blip. I would consider that as a market where the market is going up, there is a blip, it comes down, it consolidates, again it starts going up, again it comes down, again it goes up. But if you look at the secular trend, the trend is one of an upward movement. Similarly here, I would treat globalization as something where we have we have got into a path where we are learning to live, used to live in an interlinked world where we cannot really step back at all. So the two events which are making us think back on this clearly are COVID and the Russia-Ukraine war. COVID, not man-made, maybe people say it's Chinese-made, and the Russia-Ukraine war, which is clearly man-made. Now, these two events have created some kinds of dents, blips in the globalization process. Again, I think Anand said something which is very good. He quoted somebody, I just noted down. We overestimate outcomes in the short term, underestimate outcomes in the long term. So my feeling is that when we say we are deglobalizing, we are looking at the shortest possible term starting from March 2020 when COVID actually took roots. Subsequently, in 2021-22, it intensified, and then Russia-Ukraine war started. And we now believe that we have taken a firm, decisive turn from globalization. I don't really agree with that at all, as I mentioned before. For we can't be living in a fragmented world. But let's just assume that we are going to be living in a fragmented world, even for a short time, say for the next about 5 years or so. What could be the policy implications for this? I'm not going to get into the global policy implications. I'm going to leave a lot of space for Anirudh to talk during the panel discussion. I'm going to confine my thoughts on 2 or 3 issues as far as India is concerned. How are the policies going to be reshaped as far as India is concerned in this kind of a fragmented world? What will happen to the capital flows? Now, can we really say that we are going to live in a fragmented world, that we are deglobalized, we don't need the capital flows at all? The scary thing today is that the current account deficit of the country has been going up. Estimates point out that this year we could have a current account deficit in excess of $100 billion. It could touch about $120 billion. How is it going to get financed at all? That's going to be a moot question if the globalization process is going to be there for a firm reversal. Clearly, I think RBI has taken cognizance of that, and RBI has been taking firm steps towards that. And in July this year, as people pointed out earlier, we talked about a rupee trade settlement. Now, I'm going to be a little self-critical about this, as I normally do, being from RBI, having spent about 3.5 decades there, I'm going to be quite critical about this. Is it going to be a problem solver for us? Is it going to be a long-term problem solver for us, rupee trade settlement? In my view, no. Why? Let me just put out my arguments. We are saying, number one, we should encourage more countries to come into opening rupee accounts. The foreign banks will come and keep rupee accounts with us, and our exports and imports will actually be done in rupee, and then it will get settled in rupee. Take Russia, for example. Russia has come into this, more willingly. And there are other countries which will come into this a little more willingly, not because of any intrinsic beauty of this particular model. It is because they have the incapacity, they have the reasons. Russia cannot trade in dollars today. Sri Lanka has its own problems. Iran has been having traditional problems. So perhaps some of these countries may get into this. Now, when they come into this rupee trade settlement mechanism, and the situation with Indian-Russia trade today, Anand pointed out about China. Russia is not that horrific, but then with Russia we clearly run in excess of about $10 billion trade deficit. So, if you open a rupee account, rupees will get accumulated in the Russian bank's account. Good, fine, story here is good. What will the Russians do with this rupee? What will the Russian banks do with this rupee? They can again set it off against their own imports. But then that we already talked about the story, there's going to be a net surplus of rupees lying in the foreign bank's account. Next, they can consider investment in the Indian market. Either it could be a direct investment or it could be a financial investment. I'm not sure whether that much of opportunities are available in India, and whether the Russian exporters or the Russia as a government will be willing to invest everything here in India. So clearly, this surplus which is going to be there, assume that, on a very optimistic basis, about 50% of this surplus is going to be invested in direct investment or the portfolio investment. What do you do with the rest of the 50%? Now, how is it going to be repatriated? Are you going to repatriate it back into Russia? The Russian banks actually take it back into the country, and the Russian government maintains a rupee account. Or you take an Indian example. Let's assume India were to be in a surplus position with Russia, and Indian banks get all the rubles. What do we do with these rubles at all? ultimately these rubles will have to be bought up by the Reserve Bank of India as a part of the foreign exchange reserves. So what is going to happen willy-nilly is that the Indian foreign exchange reserves are going to get diversified out of dollars into those currencies with which India runs a trade surplus. Unfortunately, India does not run a trade surplus with a large number of countries. So we can actually market these schemes with those countries with whom we are running a trade surplus, but unfortunately we don't have. So those countries which are running a trade deficit will be willing takers for this, but ultimately there is no logical end to this at all. There is another concomitant issue that you are going to face in the markets. If such bilateral trade blocks come into operation, which we are talking about as a deglobalization process, as an unintended outcome of the deglobalization process, Russian ruble's value in terms of rupee has to be found. Today, Russian ruble's value in terms of rupee is done through an intermediate route of dollar. Assuming that the dollar market is going to dry up completely, the value discovery for the currency is going to become even more difficult, because the Russian ruble dollar market has at least some traction. But when Russian ruble is going to trade against rupee, Indian rupee, Pakistani rupee, Sri Lankan rupee and all, the entire thing gets segmented into much, much smaller components, with the result that the price discovery in these markets is going to become well nigh impossible, and the entire valuation mechanism that we are talking about is going to land all the countries into a lot of legal wrangles and problems, which we entered into, mind you, when we had the Russian ruble trade. We had a huge problems determining the value of Russian ruble in terms of rupee, which created a huge problem in those days also. Now, this is one issue that I would like to highlight and leave it at that for the panel to take it up a little further. Ultimately, this issue could be solved if rupee becomes convertible on the capital account or ruble becomes convertible on the capital account. I'm not sure how long this process is going to be. Whether India is keen about rupee being made completely convertible on the capital account, I'm not too sure about it at all. There are lots and lots of macroeconomic problems that are on the way. Unless those are going to be taken out of the way, rupee convertibility will still remain as a distant dream. Deputy Governor Ravi Shankar, when he talked about internationalization of rupee very recently, he brought out other factors apart from the factors that the Tarapur committee highlighted. Tarapur committee had highlighted the fiscal deficit issue, the inflation issue, exchange rate stability issue. Deputy Governor Ravi Shankar talked about the military might of the country, a very real factor which we do not factor in our economic discussions. If a country has to have a convertible currency, the military might is going to really be a very important factor. So I don't know how to factor this in. I don't know how we are going to have a guesswork on this for ensuring that rupee is going to become convertible a little too soon, so that the rupee trade settlement itself will have a logical end in people trying to hold rupee as a reserve currency. Offshore and onshore rupee, yes, that's going to be another problem where the policy makers are going to face a huge amount of issue. Today, with the offshore and onshore having a common position, we did very recently see how the Reserve Bank was up against a huge amount of issue in managing the rupee. So this is something which has to be thought through. I don't have a real solution for this. If you looked at Usha Thorat committee report, the Usha Thorat committee report did not talk about intermingling of positions at all. It talked about absolutely separate positions being maintained, separate books being maintained. So this is an unsolved issue. This could take a policy, this need a huge amount of policy thought if the deglobalization effort is going to take place. One more issue that I would like to highlight is that what would RBI intervention do when deglobalization takes place. In general, there is a perception that RBI jumps into the fray if the rupee depreciates, and then it would like to prevent rupee depreciation. I won't say it is completely correct. There is a slant towards it, I would say, particularly in times when there is a vertical fall of the rupee, so that the perceptions are not affected in a very big way amongst the industry people. So RBI steps into the job. But the way RBI spent money in the recent episode is something which was scary. The foreign exchange reserves going all the way down to 520 billion from a high of about 642 billion in a matter of just about a year is something which we thought if it could last for another about 1 or 2 years, perhaps we would face a horrible situation of the foreign exchange reserves. This is where I feel maybe RBI as a policy call will have to be very calibrated in its intervention efforts when it comes to deglobalization process. It cannot be spending money, spending dollars in a way that the dollar is going to get depleted in an accelerated pace, which means we need to develop some amount of tolerance for rupee depreciation. And by allowing the rupee to depreciate, if you look at even the statistics from what the RBI bulletin publishes, clearly, I would say, don't look at just the past year for the purpose of real effective exchange rate. If you look at the longer horizon, rupee still continues to remain overvalued on a longer horizon. If we just keep shifting the base and start deriving comfort from that, I think we are deriving a foolhardy comfort, which is not really good for us. Last point that I would make is about the bond markets in a deglobalized scenario. All of us are aware the Indian government is now borrowing more than about 15 lakh crores a year. Yes, the institutional investors are there in a big way. The primary dealers are doing a wonderful job trying to market this borrowing. But can it be done without the FPIs coming into the country at all? Can we completely close the gate for the FPIs, thinking that the deglobalization process is something which is going to completely stop the FPIs from investing in the rupee debt, or we should stop them? This is clearly not a solution at all. It's going to put a big hole as far as the government's borrowing program is concerned. Who is going to step into this hole? Can the retail investors come in? Well, I doubt. Whatever may be the kind of program that the policy makers can introduce, the retail investors cannot step into the foreign investors as far as the government securities are concerned. So this is something where actually we need to really think through again. We have to link it up with the trade settlement issue. And if the trade settlement issue is going to provide avenues for the excess rupees accumulated to be invested in the Indian government securities, do we have tolerance for it? A lot of foreign banks coming and investing the rupee in the Indian rupee security market and then willing to take it away in times of turmoil. Do we have the gumption to live with it? Do we have the guts to live with it? This is something which a question that we need to ask before we can actually solve this entire issue. Let me close it saying that I started the address talking about globalization spanning across finance. I ended up talking only about finance. But let me close saying that unless this issue is correlated with several other issues of climate change, technology sharing, information sharing, when we talk about globalization, can we stop the internet and live with it for about 1 hour? Impossible. We just can't live at all. We can't stop looking at the WhatsApp. If WhatsApp were not to be there, I think most of us would go mad and the hospitals will be full today. So given that kind of a situation, I think globalization is a topic which spans well, well beyond finance. Thank you very much for a very patient listening.
Thank you so much, sir. I request you to please stay back and join the panel. And now, introducing our very first panel for the day, Reimagining Markets in a Deglobalizing World, Challenges and Opportunities. I'd like to call upon stage Mr. Anirudh Chatterjee, who's also going to be the moderator for this panel. Mr. Chatterjee brings about 25 years of experience in the information and analysis industry and has held several leadership roles across leading companies and successfully led business growth and transformations. Prior to joining NSE Cognizant in 2022, Mr. Anirudh worked for Refinitiv as market leader, account management for key and strategic accounts across South Asia. He has also served as the regional sales director at Dow Jones and spent over a decade with India's premier economic think tank, CMIE. A huge round of applause for Mr. Anirudh. Mr. Mahalingam. He has had a professional career of more than 4 decades spanning over the financial sector regulators, Reserve Bank of India, RBI, and Securities and Exchange Board of India, SEBI. He was instrumental in formulating regulatory policies in respect of financial markets and conduct of market operations of RBI. In his role as a whole-time board member of SEBI between 2016 to 2021, which he carried executive responsibilities as well, he is currently chairing the SEBI advisory committees on secondary markets as well as the corporate bond market. A huge round of applause for Mr. Mahalingam. Next, I'd like to invite Mr. Parth Are, who is currently director of National Institute of Bank Management, Pune. He was a professor of economics at the Indian Institute of Management, Kolkata, during December 2011 to April 2021. Earlier, during 1989 to 2006, he was working in the specialist cadre of economists in the Reserve Bank of India during 2007 and 2011. He was the advisor to the Executive Director, India, at the International Monetary Fund, Washington, D.C. A huge round of applause for sir. Next, I'd like to invite Mr. B. Prasanna, who's the Group Head, Global Markets, Sales, Trading and Research at ICICI Bank Limited. He is responsible for economic research, trading, market making, and sales and distribution of all the treasury products related to fixed income, foreign exchange, and derivatives. He's also the chairman of ICICI Securities, Primary Dealership, Group Head, Global Markets, Sales, Trading and Research, ICICI Bank Limited. He has a rich experience. All right. Next, I'd like to invite Mr. R.K. Sinha, who is currently the Chief General Manager, Global Markets at State Bank of India, Corporate Center, Mumbai. He oversees treasury operations of the bank, consisting of investment portfolio, money market equity, private equity, and forex operations of the bank, with a portfolio of nearly 15 lakh crore rupees. Prior to the current assignment, Mr. Sinha managed the financial institution relationship, treasury operations, and ALM of SBI's overseas operations. Mr. Sinha has worked extensively in major banking verticals like treasury, international banking, and retail banking, including overseas assignments at SBI London. A huge round of applause for all our lovely panelists. Mr. Chatterjee, you can take over.
Thank you very much.
So, Anirudh, before we start, I have a small request. Like I watched the Croatia-Brazil match yesterday, I would like to simply watch this panel discussion going on, because I have already played the ball and I have been dribbling with the ball for quite some time.
I think to a large extent you already did that. I have to really work very hard to get somebody who would have an opposing view than what you just said. So good morning, everyone, I'm been very, very excited to lead this panel. The topic is very exciting too. And as Mr. Padmanabhan mentioned at the beginning at his speech, that sometimes what we do is try and connect several dots, sometimes not even knowing whether the dots are really related or not, right? So I have some dots, and which I will do is I'll try and connect them by asking some of the questions to my eminent panel. But I'd like to start the session by, quoting a quote from the former US President Bill Clinton. So he was addressing an audience in Vietnam in 2000, and he said that globalization is something which cannot be turned off or put off, right? And it is very clear that you certainly subscribe to his views. But again, Brexit did happen, and we know that the dream that we had once of just-in-time supply management is a distant dream now, and people have already started thinking otherwise. So I think, and then there are, of course, multiple ways of expressing this. I mean, there are working report from BIS that suggests that this slowdown of trade and movement of the international capital is primarily a phenomena of the European banks, and they have done what they have done in response to the global financial crisis in 2008. PwC famously wrote a note, and they said, look, it is globalization, and we can term it differently and call it globalization. And then, of course, recently, I think Invesco, they did another note, and they said, so this is still globalization, but re-globalization, right? So there are several terms that keeps coining out. So I just want to understand and also test the hypothesis of this deglobalization and understand where you all stand. So maybe Prasanna, we can start with you. So what evidence that you would give it to us to say that whether or not there is globalization or deglobalization?
Okay. Yeah. So thank you, Anirudh. And I think Mr. Mahalingam has set the ball rolling with a fantastic speech, and I think kind of stolen all our thunder in terms of what we wanted to say. So whatever we have prepared now, I don't think that's going to be of relevance. But then let me start off. I think this seminar has started off very seriously. So let me start off with something more on the lighter note. So yesterday when I was preparing with my team member Shravan on what is the stance that we should take on globalization, he actually asked me, I'll tell you one quote, you try to tell me who spoke about it. So the words are, I have it in front of me, I'll just read it. The inhabitant of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth in such quantity as he might see fit, and reasonably expect their early delivery upon his doorstep. This was the quote he said. So I asked him, is it Swiggy CEO? But then it was London. So then I was doubting whether there was a Swiggy equivalent in UK who has talked about it. And of course the word telephone also was, it could have been app or something. He told me it's John Maynard Keynes in 1914. So that's when the true, what should I say, the vision of globalization, I think has started all the way, the integration and the globalization has started all the way in 1900s, early 1900s. And then what we saw was unfortunately the two world wars, the Cold War, then all the things that happened between the 70s and 80s. That was the ones which actually did not lead to globalization that could have pretty much happened much earlier than what he thought. And what picked up in globalization was predominantly in the 90s and early 2000s. And that's when China really integrated with the world. And of course, I don't think I need to say it here. It's very clear that the very genesis of globalization is productivity and the theory of comparative advantage. I mean, let whichever country which has unit economics which is in favor, produce that product and import the other product from another country. So I think that's what was happening between 1990 and 2010 and 2000, or maybe around the GFC. And then a lot of things that you alluded to happened. And then there has been a slowdown in globalization. So instead of using the word number one, deglobalization, I would rather call it as what we call it as slowbalization and maybe newbalization, because slowbalization is actually happening because of the fact that the world trade to GDP has peaked in the early 2000s and then come down. And it's still in the process of coming down, and people are assuming that this is a long-term process. But like I said, the process of globalization was a 100-year process, which just took place in the early 2000s, very difficult for it to go back. So I would completely agree with what Mr. Mahalingam, kind of alluded to. In fact, my early response would have been fully very similar such points, but in the interest of time, I would have to stop here and say that while we accept and acknowledge that there is a substantial amount of globalization which is happening, this is just a process which will come back. There is no doubt about that. And second thing is the technology and the financial infrastructure. Again, I will accept that. In fact, it's very important that finance follows real economy, and all kinds of internationalization of your currency and all that will automatically happen if, as an economy, your country grows much, much faster and is able to show the might that as a country you are able to grow very well, and even military might that he was talking about. If those things happen, then I'm sure these will automatically happen, not by way of regulations which come and pushes you to do something like that. I'll stop here, maybe if given a chance again.
Thank you, Prashant. Mr. Sinha, how would you comment?
Mr. Mahalingam has already explained it, and I fully agree. It's not something that can be reversed. There may be some hiccups, some blips, and we have seen it happening over 100 years, actually. Second thing is that when we talk about globalization or deglobalization, we, as Mr. Mahalingam again pointed out, we restrict ourselves to financial market. Thing is that look at capital investment, for example, flow of capital and remittances. We have seen some slowdown, but mostly because of strategic reason. If you look at since 2005, emerging economies especially, people who need capital actually have opened up their economy. So while for strategic reasons, certain type of investments have been restricted by developed economies, emerging economies actually have gone ahead with this thing. So this is not going to reverse. It will slow down some strategic changes, structural changes. Look at manpower, for example. It has always been a problem. Globalization has never fully happened so far as movement of, physical movement of human beings is concerned. But that is the case since the beginning of the time, actually, honestly speaking. If you ask me, last week's development in Germany is very welcome. I think they are going to open up their economy to immigrants in a major way. That is what I understand going by the newspapers. Slowdown has happened in goods and services sector. Is it permanent? Except for one thing, and that also is not deglobalization, except for China plus one thing. Most of the things are temporary. China plus one thing again is not deglobalization. Reshoring or onshoring is extremely difficult. It is inefficient essentially, and that's why it's difficult. These are tough times. So during these times, these type of things have always, surfaced. I believe that manufacturing especially, and to some extent services also, will be, production will shift, a part of it may shift from China to some other countries, but nowhere close to deglobalization. I think manufacturing shifting from China to Vietnam or India or Thailand is not deglobalization, but that is a structural change. Instead of, one country supplying to rest of the world, possibly we will have more than one country supplying to the world. I think that is a good thing, and that is not deglobalization at all, but that is going to happen. So that is what, if we are worried about, China, then it's a structural change, it's not deglobalization. Other things, nationalistic policy, whenever economy is in distress, Mahalingam sir again mentioned about, it all started after that suicide bomb attack in US. It gets aggravated during great financial crisis, then again peripheral Europe or European debt crisis, again COVID. So these things, whenever we face a crisis of global scale, globalization will take a pause, but it will start again. Thank you.
Thank you. I think, it's definitely not deglobalization, but structural change. And we'll come back to that point in a while. But Professor Ray, what's your thoughts?
Yeah. So, listening to Mr. Mahalingam gave me a feeling that almost everything that I wanted to say has been said. But despite that, having come here, I have to say. So first, let me start with the statement that this issue of deglobalization is primarily political in nature and not economic. Now, why do I say so? Globalization did not come from any milk and motherhood statement. It came from pure brute economic forces. What are the things that have happened? There are different dimensions of globalization per se. It could be trade, it could be services, it could be finance, it could be technology, and finally it could be regulation. Now, clearly the progress of economic globalization across all these 6 pillars has not been uniform. Financial globalization has progressed further. We in between have seen various other impediments. Now, I'll just go back a little bit long in history, and we are thankful for Angus Madison, who has worked out the GDP for last 1,000 years. If you look at the broad epochs of globalization, the first one is clearly something like early 1800, where Britain emerged as a big industrial power, and the force of globalization there was the Industrial Revolution of James Watt and the likes, and colonialization. That was 1820s. And then came the emergence of United States after World War I, which was happening, and then finally came the emergence of Asia. If you look at last 1,000 years, there's a peculiar number emerges. So around 1820, the emergence of the so-called European powers became something like between 1/3 and little higher than 1/3 of aggregate global GDP. This number was repeated again 1/3 and little higher than 1/3 by United States by 1920. Asia had a secular decline from 1000 AD to around early 1970s. Then something happened. The last 25 years of the last millennium, the share of Asia became almost double from around 16% to around 32%. We have not seen over the last 1,000 years. That's emergence of Asia between 1970 to 2000, and you all know the basic drivers. First, the East Asian tigers and cubs came up in 70s, then China came in 1980s, and then India came in 1990s. Now, therefore, there has been different shades of globalization. Why are we obsessed about deglobalization at the current juncture? As I said earlier, perhaps the triggers are political in nature. You can think of at least the following 4 to 5 triggers. You can start with possibly Brexit in 2016, then Mr. Trump and the US-China, the trade war. Then you can bring it definitely pandemic affected the pace of globalization, and then came the recent Ukraine war. So these, in some sense, essentially political in nature. So I do not think the basic force of globalization that has come off late in the recent epochs via reduction of the communication cost, huge demographic pressure on the developed world, and Mr. Sinha has alluded to Japan. The Japan had to open its door to the Filipino nurses something like 25 years back, not out of any compassion, but they realized when you have a large number of old people, you need nurses to take care of them. Therefore, those forces of globalization, via demography, via other forces of economic features, they continue to remain, and I don't think they have taken a dent. This is purely a noise in terms of the current politics. And the other chunk is, of course, there's a huge emergence of economic nationalism in Europe. Apart from Brexit, you can think of Marine Le Pen in France, in Germany, etc. So therefore, all these forces together, you have a movement towards political globalization. But as far as the economics is concerned, I think there has not been any particular dent.
All right, so if I can just quickly summarize. So of course what we are saying is that, look, I mean, there might be a slowdown or reversal in terms of trade flow and to some extent capital flow as well. But globalization is not only about trade and financial flow as you are alluding to, but it is also about flow of ideas, people, data, and there is no sign of slowing down anywhere. So therefore this entire myth of deglobalization But is this completely baseless, or are we just saying that, look, I mean, there are economic priorities and then there are political priorities. So it's like economy and geopolitics at a loggerhead. But then the question would be, where do we go next?
Yeah, Anirudh, I think it's been a pretty interesting question. I wouldn't really call it as a myth. I disagree vehemently with the fact that there has not been deglobalization at all. But then I wouldn't call it as a myth, as I was mentioning while I was addressing. It's a blip which is taking place in the process of globalization right now. So there is clearly a kind of a reversal as far as the globalization efforts are concerned. But as Prasanna put it, I think the life is going to be normal after some time. We are going to go in the path of globalization. There is no turning back at all. In fact, I would draw examples from these very blips to say that how globalization is deeply entrenched in the whole world. For example, global financial crisis, that brought in a huge amount of cooperation amongst the financial regulators of the world. And we have Basel I, Basel II, Basel III. I don't know how many more Basels we'll have. With each blip, we'll have one more, at least three Basel guidelines added. It only talks about a symmetry of the regulation across the world. Number two, COVID. Another brilliant example of how the world actually shared its knowledge of actually trying to control COVID, prevent COVID, vaccination, all that. I think this global cooperation has been unprecedented actually. Maybe a similar thing was not existence at the time of Spanish flu in 1917 and all. Today we have the benefits of technology, benefits of sharing, and that was quite evident at that point of time. Last point that I would like to stress is climate change. There is a vehement disagreement on this point amongst blocks of countries, but today we see that I think all of us have joined hands to ensure that a few more generations will be able to live comfortably in the world. So all of us are going to put efforts into ensuring that we have a reasonably free kind of, at least pollution-free, healthy living conditions across the world. I would stop with that.
Okay. All right. So I think let's move on from this particular point. Let's talk about something else, right? And I think there's another recent phenomena that we have seen, which is segmentation of the commodity trade, and which we can also say about rise of the regional blocks. You talked about what's happening between India and Russia, but that's not the only thing which is happening. We heard Mr. Anant Narayan talking about the trades between India and China. So definitely there are clear indications that there are these initiatives which are on. I mean, just about few days back, we carried exclusive news from Informers that says that the government of India is going to launch a new negotiation for FTA with GCC. And this is also happening parallelly with Australia, with the UK, and we all know about that, right? So if we have to put that in context, now, is that not an after effect of the so-called slowing down or globalization? Prasanna, if I go to you.
So I think, okay, let me just give out some data first. So in terms of, I think if you look at the world trade to GDP, if you really look at it, that would be in the region of around 45 to 50%. It's been coming down in the last 10 years, but it's been going up in the last 30 years. So the blip which Mr. Mahalingam was talking about is that. But when you talk about a country association like ASEAN, which is what I think you were also referring to in terms of our flows shifting and all that, the trade to GDP ratio within ASEAN nations are actually going up. It's not coming down. So clearly, I think that, and the growth rate of trade at an aggregate level within ASEAN versus the overall, there is definitely a difference. So I think clearly, globally, there is definitely a move towards diversifying away from what you thought was globalization in the earlier stage and what you think you want to be doing going forward. It's physically not possible for every country to produce every damn thing that it wants even now. It has to rely on others. But I can choose whom to rely on. So I think that's where, instead of, what are the things which are actually drawing countries close to each other are, number one, proximity, geographical location, which obviously makes it easier for me to source something from Bangladesh than source something from Brazil, for example. And I think similar principles, similar thought process, similar motivations to protect a particular region from something else. This also, I think, answers a lot of why, Pacific countries are cooperating with each other and things like that. So I think we are definitely moving away from a high level of concentration, because I think like what Sir was saying in terms of COVID, the behavioral changes, that the most important thing that it gave rise to is I can't really depend on a country from sourcing from them 80% of what my inputs are coming from. So it's just not going to, that's just too risky. If you can diversify your investments and not put all eggs in one basket, that same thing should apply at an aggregate, at a country level and at a government level, right? And this kind of a crisis where people figured out that they are not in control of their own vaccines, they are not in control of their own, health crisis, and the loss of business on account of supply chain destruction that we have seen, whether it's semiconductors or whatever it is, I think that's what has now made sure that people are looking at, countries are looking at where their sourcing is coming from and consciously trying to look at diversifying away from it. And that's one of the reasons why these regional trade blocks, I would say, is actually mushrooming much, much better than, more than what, overall, at overall level. I think I'll stop there.
Thanks, Prasanna. Mr. Sinha, I'll come to you. Now, see, I think what he's effectively saying is that maybe some kind of structural change happening, and of course, there is reason for it. I'll superimpose one more fact on top of that, like what just we have seen in case of Russia, right? Because the Western world went about putting sanctions on them, but we still had to do trade with them, and we decided, okay, fine, we'll duck dollar, and we'll kind of use our own currency to trade with them. And that's not only unique to us, it happened with China, it happened with Turkey, and there are many other countries who are also looking at that prospect. I mean, are we really then looking at de-dollarization?
Regional blocks do not promote de-dollarization. De-dollarization is a concept that, again, just like deglobalisation keeps coming every 5 years. You will read, Open Financial Times, you will read 5 articles on de-dollarization. It has not happened so far. If you look at the share of dollar in forex reserve, it has come down marginally, only marginally. If you look at the share of dollar in trade invoicing, it is not down. If you look at the share of overall settlement, dollar share actually has gone up marginally. It's not happening as yet. What we are talking about right now, look, regional blocks are happening for 2 regions. One, it's total failure of WTO or whichever organization we have globally. If we cannot provide a proper, fair structure, then people will move to blocks where they can have at least scale to bring the cost down, to improve the efficiency. So possibly till we have an entity or till we have agreement at global level, we have to move towards regional blocks. It's not, again, it's a move in that direction only. Problem is that we do not have a global system, unified tax or accounting or whatever system, trade blocks. Second is strategic or security related. We are talking about payment and settlement in regional currencies. I don't think de-dollarization is going to happen for various reasons. First of all, as our speakers have already pointed out, look at the entire infrastructure of invoicing, pricing, it's all dollar denominated. Look at the price of oil. There are 20 value additions at different levels. Every single goods and services, intermediate and goods and services are priced in dollar. It's a massive infrastructure that we have built over last 50 years, 60 years rather. It's not going to happen in a hurry. Regional blocks will facilitate trade for various economies. It will provide them slightly better efficiency, slightly better scale. It's not as good as we would have liked it to, but we do not have any way out at this point in time. So regional blocks will happen. Regional blocks have very little to do actually with de-dollarization. De-dollarization is not going to happen unless and until we find an alternate And that is a different discussion altogether. Thank you.
Thank you, Mr. Sinha. So, Professor Roy, I mean, if I can just kind of ask you to elaborate more on that, and maybe counter by saying that, okay, fine, go back pre-World War I. Of course, everything was Commonwealth currencies, but we are now living in a different world altogether. So, is that possibility really simply not possible, or it can still happen?
Okay, let me start with some general comments, then I'll come to the specifics. First, as Sid has already said, one of the primary, we owe this huge emergence of regional trade blocs to Mr. Trump. Mr. Trump has completely trivialized WTO. So we had this institution which we expected will play a big role in terms as a trade, ultimately super body, that became completely defunct. Now, in case of India, there is a specific reason, which someone not mentioned. We have this ambivalent strategy towards China. Economic dependence, that has been very categorically pointed out by Mr. Ananthanarayan, that our dependence on China has actually increased rather than going down. But we have different kinds of political discomforts, as a result of which we did not join the RCEP. So when we did not join the RCEP, naturally the path that we had, perhaps have more and more regional trade blocs. And as a result of which, what we are going to get, Mr. President has said that earlier, if there was a starred globalization model, is kind of, I'm borrowing from the operations management literature, it's like China as a center and everybody around, we perhaps are going to observe a slightly more diverse globalization, where it could be a China plus one strategy, and so on and so forth. But when it comes to currency in particular, currency movement takes huge time. We needed 2 world wars to get rid of the hegemony of pound sterling. Therefore, I don't expect de-dollarization can be so fast a process that we are going to observe at the current juncture. There may be marginal changes here and there. There may be certain increases, certain clamor and announcement for regional currencies, but as of now, the numbers, at least, it does not say that anything towards de-dollarization.
All right. Thank you, Professor. Yeah.
Just to add a few comments on this, I think all the previous people, Prasanna, Sinha, as well as Partho, made very good points on this. I would just like to supplement saying that de-dollarization is something which I would personally look up to. I think we need to have that. But unfortunately, we are in a situation which is similar to India. It is BJP versus opposition parties. It is dollar versus the other currencies. That's what it is globally, actually. So the idea here is, like Partho very clearly said, for dollar to evolve, it took quite some time. And then, if we want to move away from that system, which has given a significant seniorage advantage to US, tremendous amount of investment advantage to US, and the way money flows into US, despite the twin deficits being of a very high magnitude there, is something which we are all passively watching and we have learned to live with, actually. So what we need is some kind of a synthetic currency. I think the IMF started with all seriousness about SDRs. I don't think SDRs really have caught on the attention. The regional blocks today are, at some point of time we are talking about a regional currency. Even those ideas have not fructified. But I really wish and dream that at some point of time, we are able to come up with an acceptable synthetic currency which would be able to pose a challenge to dollar hegemony.
Thank you, sir. So, I'll come back to you because I think the next topic that we were going to discuss about the rupee internationalization. But before that, so Prasanna and Mr. Sinha, I just want to take this question back to you. Do you think the market would actually want de-dollarization, given that there is a twin deficits and then our dependence, other EM dependence on the US economy, trade, the capital flows, everything?
So, today, if you really look at how much of invoicing happens in dollar, I think if you sum up all the, if you look at how much US imports and how much US exports, technically speaking, that should be the amount of dollar invoicing which should happen in the global thing. I think the number is somewhere between 4 times and 5 times. So that clearly means India and China, when you are doing trade surplus or trade deficit between each other, you're invoicing it in dollars. So, and the reason is because you don't have, and which currency would you want to take exposure is not a currency which is expected to consistently keep depreciating over a period of time. It has to be a currency which is stable, and you have the ability to go in and go out of the currency, no questions asked, able to open accounts anywhere, everywhere. So clearly today, when you look at alternatives to the dollar, I mean, outside of the synthetic currency that he was talking about, in the terms of real currencies, if you think of euro, or you think of renminbi, or you think of the pound, I don't need to explain. I don't think there is any confidence in any of those currencies at all. So I don't think, so the market will do its bit. I mean, whether market wants it or not, I think if development happens, market will take it in its stride and do it. But at this point of time, there is no real alternative. And that's the reason why so much of invoicing is happening in dollars, even though you're not actually exposed to the dollar in the underlying trade.
Got it. Okay. So, Mr. Sinha, I'll just tweak the question a bit to you. So now, would that, and Professor Roy also talked about the diversified globalization process that we are observing now, and that is leading to different blocks. But would you use that context to say that maybe the time is ripe for us to talk about rupee internationalization?
I like to make it very clear that internationalization of rupee is not something that is in the domain of the market. It's a policy issue. So if it is a policy issue, we need policy level intervention. Right now, what we are witnessing, look at China. They worked very hard for 20 years, and it has resulted in some success. I think right now the settlement in yuan is around 7% from something around 0.9% a decade or 15 years back. But it was an official, formal attempt. I think they have given up on that. I don't know. So if we are leaving the clearing of this internationalization of rupee to the markets and market players, it will take significant amount of time. At least in initial stages, I believe you have, Mr. Mahalingam has actually jotted down all the issues that we will face if we go for this. What will happen? What will we do with rupee? I mean, they will do with rupee, and we will do with ruble or any other currency. Only an economy that is under distress will opt for this, mechanism at this point in time. We need some sort of support at policy level. You leave it at market players, it will take a significant amount of time. So, operationally, it's extremely inconvenient. Why should I go and do invoicing in a currency where I do not even have the hedging tools? Which are the countries who have shown interest? Maldives. Again, sir has pointed out, Maldives, Sri Lanka, Russia, of course, maybe Iran, long backs, South Africa. South Africa is the only decent country among the lot, actually, where we can actually think about it. It's operationally inconvenient. There is no mechanism at this point in time to take care of the after effects of internationalization of rupee if it happens. I think we need some support here. Market needs some support. Thank you.
So, sir, if I may come to you before I go to Professor Roy. I mean, of course, we have seen masala bond, and if I consider that was a kind of, market perceived that is a first step towards, rupee internationalization, and then we have recently seen that, settlement of trades in rupees. So, and of course, the market, Mr. Sinha is saying the market is looking for support from the regulators. What you would perceive as the next regulatory effort?
Not necessarily regulated. Market needs support. Wherever it comes, it's welcome.
Okay.
No, I'm really not able to really get down to the next step the regulator has to take, because, again, when you talk about internationalization, I think Sinha rightly said, it has less to do with finance, more to do with how the overall, the way the country is managed, how the macroeconomy is going to get managed. That's going to be a very important factor out here. I think just because the market decides the rupee has to be internationalized, settlements will take place in rupee, it's not going to change overnight at all. So basically, you are looking at a situation where the macroeconomic parameters of the country are going to be on a stable, sustainable trajectory, that there is a kind of element of trust that Anant Narayan talked about. I think ultimately, when it comes to the financial sector, you are talking about a trust. If there is a trust deficit, certainly this will not take off at all. So if the building up the trust is less with financial sector and more with the political people and the other leadership and the policy makers who are going to decide this deficit of trust, how it is going to be cured.
Professor Ray,
Anirudh, here, Prasanna here. So just let me add quickly. So the point on regulation and point on trust, I think you need to have regulations which permit you to do certain things which, you know, where internationalization of rupee is possible. And that's, I think, what the Reserve Bank did in terms of allowing Vostro accounts to invest in, Indian government bonds and encourage a Russian, not Russian, but any country to, do it. But it is not going to happen unless people get comfort in the rupee, and the comfort in the rupee will not happen unless the economy is strong and unless there is stability of the currency. So I think to some extent we need to understand which is the body of the dog and which is the tail. And we can't just say we do something for the tail and then say that, okay, internationalization should happen. I think the facilitation is there, but I think the process of India going towards a superpower, India going towards strong economic growth and hence stability, I think that will what will determine the final rupee internationalization is my.
Absolutely. I think we are talking about the real economy back again. So what would be your thoughts?
Yeah, let me first point out that India is a huge trade deficit country. So that you should remember that will determine the relative demand and supply of rupee in the trade account. Now, even on current account, despite the flow of remittances, as well as the software services, we have a current account deficit consistently. Therefore, we are going to continue to have that particular problem at the juncture. And I think the elephant in the room is somewhere capital account convertibility. Mr. Mahalingam has alluded to the three conditions of the report committee: the fiscal deficit, the inflation, and NPA. And I don't think we have ever had any combination, any year that all the three are completely favorable, and therefore we did not pursue that. Having said that, I think RBI has repeatedly emphasized that the rupee internationalization or capital account convertibility, I'm using them interchangeably, are not 0 and 1. This is a process, and we are moving towards that. We have been accused, India has been accused of, the Indian regulators have been accused of being conservative, but we have been slow, but we followed a calibrated approach, and many of the measures that has been mentioned in this panel are towards those calibrated approach, towards more and more international usage of it. But it's not 0 and 1.
Right. So I'm also a little concerned and mindful of the time that we have right now. But there's one more aspect I just want to quickly touch upon. I'll come to you, sir. Given that there's an intent that we want rupee internationalization, of course there are challenges that we have to overcome, both in terms of the health of the economy as well as the regulatory framework in place. But the other issue people would talk about, that what about, like this unification of the onshore and offshore market, right? So tell us a little more, like what's our thought and what is the kind of idea that we have? Like how are we trying to bring this onshore and offshore markets together?
No, I would prefer actually let it come straight from the
I have a different
place.
question for them. Okay, Prasanna, you want to take it up?
So I think the RBI, when it finally did accept, the NDF, for example, as a product which Indian banks are allowed to do, it was a process which actually set in place a lot of times when the pricing of a particular currency or a interest rate, let's say, is not really determined by all the people who have substantial underlying. So it was the case of, you really look at it this way, why does NDF market really, offshore market really exist, is obviously the fact that rupee is not fully convertible and nobody can really do pretty much what they want. So the access to onshore and offshore is completely different. Offshore people can, pretty much do what they want, whereas onshore people can't do much. And that's why the offshore residents thought that they would want to sometimes, hedge or speculate on the currency, which has a market of its own. So when you let the Indian banks in it, you can't obviate the need. I mean, you can't take over the entire offshore market, obviously, because of the fact that we are not rupee convertible and there will be a market which exists there. But at least what happens is the pipe between the pricing in the onshore and the pricing in the offshore becomes a little bit stronger because of the ability of Indian banks to maybe arbitrage out the differences, bring the spreads down into reasonable level. Otherwise, what was happening is that it was pretty much like NDF was trading like a derivative which had no relation with the underlying cash market. Imagine a Reliance Spot and a Reliance Futures, and Futures going on its own demand and supply, and Reliance Spot trading on a different demand and supply. That's what was effectively happening a lot of times when views of the foreigners turned unilaterally bearish, let's say. But here it was not so, that bearish and that kind of stuff. So I think this pipe is what was made stronger by these regulations. So though the Usha Tharoor committee did say that they don't want Indian banks to actually be doing it, I think finally RBI in its wisdom ended up doing it, and the result of that, according to me, has been positive. And spreads, all kinds of spreads had come down, and to a lot of extent onshore was then actually driving offshore, except in small times when I think there has been a lot of volatility. But what worries me actually is, once you have set in place a motion, I think you have to really follow it up with it unless you really feel something is big time wrong with it. The thing about doing something when market is in favor and not doing it and withdrawing it when market is not in favor, I think that's the start-stop kind of an uncertainty which will really, I mean, if you keep doing it, then the offshore guys will never enter in, onshore in any case. I mean, they'll keep looking at the offshore market only. So I think that's the only limited point that I have to make.
I think we have to be more open and say the problem is cutting your position in the NDF market as and when the volatility is not as easy as cutting it in the domestic market. It never works. So you will have to be careful. I mean, the point, I'm furthering the point that you made.
No, that's right.
Right,
But
yeah.
I think for the
What,
benefit of
I
everybody
think-
else, the mic should be given to him so that he can...
Yeah, just to add to what Prasanna said, Prasanna made some very valid points. I think initially we were unwilling to recognize that there was an NDF market. It took us at least about 10 years in RBI to see the big ghost in front of us, but we are closing our eyes. Then the ghost became visible. And once it became visible, the question of how to address it was a real problem in front of us. We knew that actually, again, generally if you look at the researchers who have come up with papers on the local market following the NDF market, I don't agree with that at all. On a normal day, it is the NDF market which follows the local market. And once a local market opens, actually it is a local market which leads, for the simple reason that the local market is backed up by the underlying. The NDF market is more a speculative market. So on a day when Indian market is closed, or on a day or at a time zone when the Indian market is yet to open, the NDF market is actually going nowhere at all. While in times of depreciation, in times when there is a huge event which has taken place, yes, I agree, NDF market provides some kind of a pointers to the local market. So at that point of time, I think it was very rightly decided in RBI that we should take a call on the NDF markets by allowing the Indian banks to participate. If not for anything, we get a lot of information value from the NDF markets. We know who are the people who are taking positions, what kind of positions are taken, who are the people who are actually running longer positions. All this information became very, very important. In fact, I can tell you, I can share here, I think Reserve Bank of India was not very comfortable about intervening in the futures market for quite some time. Although it was just with the other regulator, it was operating in the same country itself. It took quite some amount of convincing to say that futures market is also a part of the currency market, while the futures market was thriving more on speculation, like the NDF market. Perhaps we need to address a future market to turn the sentiment around. Thankfully today, the Reserve Bank is operating equally well in the futures market.
Thank you, sir. I am looking at Bijur. I guess we are terribly over time right now.
I have a very quick point to make.
Absolutely.
Just to tell that Indian rupee is not the only NDF market. There are South Korean won, there are Taiwanese new dollar or Brazilian real. One, and I have another quick point. At least now we have the permission of the Gift City International Financial Center to offer INR derivatives contract with settlement for currency. That's one step ahead towards incremental recognition.
Absolutely.
Can I take 30 seconds? Sure. Just offer two comments. One is that I think the recent move by the Reserve Bank of India in invoicing in rupee, I want to make it very clear that to my mind it has nothing to do with internationalization. In fact, invoicing in Indian rupee was permitted. Since I handled FEMA, I can tell you with some authority, from the first FEMA document which was put in place. But nobody was willing to invoice in the rupee because any receiver of currency will never invoice in a currency which is showing a secular decline. So that was the problem. So, but it is a step, and then basically, because if we were internationalizing, then we should have permitted, to Mahalingam's point, the currency balances which is built up by Russia to be settling in rupee debt to some other country, which we are not doing because we are still worried about how that will do. That's number one. Number two, about the deglobalization. Now, I think one thing on which I am grappling with is, maybe it is not possible to reverse something which is 100 years old overnight. But today, if you look at a business which is looking at next 5 years horizon, because he is not going to look at 10 years horizon, I think today, because of Trump or whoever it is, because the way today technology has come in and data is getting segmented, I think the people are not very clear how they will be able to perform in an external market because of the various geopolitical and other related issues. This is a fact, I mean, to my mind. Whether it means deglobalization, I completely agree it is not. But somewhere, maybe Prasanna used the word slowbalization or whatever it is, the things are looking little bit tricky, at least for the next 3 to 5 years, because of the geopolitical issues and the technology issues now. Because please remember, it took several years for trade to open up. But internet was completely open, and now countries are trying. 3 years ago, we were talking about big data analytics. Today, people are talking about data privacy. Right? That change, I think we should keep in the back of the mind.
Absolutely. So do we have time to take few questions from the audience now? Okay, all right. So I think with that, no? Mr. Anade, I think you would have best.
No, if you don't have time, I'll get into the coffee.
That's fine, no problem. We'll go ahead.
I'm tempted to take advantage of Mr. Mahalingam's presence.
Sure.
So just very quickly, if it can answer in 2 minutes. You mentioned India's 15 lakh crore borrowing, so it's like slightly outside the panel. And you said that's a big challenge. But there are countries like Japan and others who have very, very large fiscal deficits. And it's a difference. But I'm wondering whether you see, you advocated FPIs, we should think about FPIs getting access to this government borrowing market. I think that's what you're hinting. Very large borrowing, and unless we get some solution of other people coming in. But don't you think there is, like the Japanese model, where everything is internal?
Yeah, I completely agree, Ajit, actually. What you're saying is 100% correct. What I was alluding to is that if we have to go a few more steps in deglobalization and we say that we shut our doors to FPIs entering the country, that's not going to serve the cause of the bond market here at all. So if the government bond markets have to thrive, if they have to be vibrant, deep and well-entrenched bond markets that we need to have, I think we need to encourage the FPI investments in the bonds. And we cannot be, paranoid about FPIs exiting the country. They will exit the country if we are not going to behave ourselves well. If you are not going to behave, our macroeconomy is not going to behave. So in fact, I would consider that as a positive, that if the FPIs come and invest, they are putting a kind of a control on the overall macroeconomic policy makers to behave well. So I would consider that as a positive. I am only saying that as an outcome of the deglobalization process, we should not shut out FPIs.
Sir, this is one of my passionate topics, so let me take 30 seconds on this, sir. I think what we have done so far on the bond market is only to encourage people who take active interest rate calls, where they actually want to deviate away from the index, which means it becomes an active call, not a passive investment style. But if you look at the equity markets, for example, since we are a part of every index, every time flow into equity globally, hence to emerging markets, it also flows to India. And that's been a natural, kind of a cushion for the entire market during bad times as well, because then the impact is not as bad. But when you're having full of active investors, and then I think the situation becomes worse. So now we actually introduce, you get included in the index, there'll be $25 to $30 billion of money which at current AUMs in the global sphere, which will flow into India over a one year to 18-month period, which I think, it's a good problem to have in the sense that you're actually letting a lot of passive investors coming in. And the bond vigilantes, which he was referring to, is also very much there. That means that India will be far more careful in terms of their fiscal and the current account deficit, and think in terms of what could potentially happen if a bond vigilante really takes the country by storm.
Thank you so much, sir.
Thank you very much. I think with that note, we'll just kind of close the session. A big round of applause for all our panelists. And thank you all of you for being such a lovely audience. Thank you.
Thank you so much, gentlemen. Now we're going to have a very short tea break for 10 minutes, and we'll be back with our next panel discussion. I'd like to call upon stage Mr. Hari K. Mr. Hari K is the Chief Business Officer at NSE, India's premier bourse for trading equities, currencies, and their derivatives. Mr. Hari has been with NSE almost since inception for about 26 years now. He was associated with the clearing corporation of NSE initially and was also involved in the capital market and surveillance operations. He was part of the team that introduced derivatives in Indian capital markets. He was heading the listing for over a decade at NSE. He was also involved in NSE SME platform Emerge that was launched recently. He spearheads the business development across products at NSE, listings, and head member services function. Ladies and gentlemen, please put your hands together for Mr. Hari K.
Good morning, ladies and gentlemen. So it's a difficult session after two wonderful matches last night and a wonderful panel discussion just now and a tea break. Difficult to get your attention, but that's how it is. So first of all, let me take this opportunity to thank Almus for giving NSE this opportunity to be here this morning. A very short presentation on exchange traded currency derivatives, because what had happened in this event, which I've been following for the last about 7-8 years, is that you get corporates for the first time coming together on an event wherein we talk about currency derivatives, exchange traded currency derivatives, which is one kind of an event wherein we get a good participation, and that's why we are here today. So just to give a brief, 2008, the RBI SEBI led standing committee or technical standing committee decided on exchange traded currency derivatives, and that's why currency derivatives were born on the exchanges. It's a very active, lively market. On the futures side, we do about 50,000 crores of average daily turnover. Currency options did not pick up for a long time. Currency futures was very active. When I say currency futures, we normally refer to USD INR. USD INR was very active. So we've got about 55,000 turnover. And in the equity side, options is very, very well traded. So incidentally, NSE is the largest derivatives exchange in the world for the third year running. That's basically because of Nifty and Bank Nifty. But when it came to currency options, there were not much of activity. So we were wondering, why there is not much of activity in currency, and suddenly all our members started participating along with banks in the options. And today we do a premium turnover of about 250 crores in currency options, which is very, very good, considering that there were no volumes about 2 years back. The volume in the currency futures has gone up about 45% last year. And whenever we talk about derivatives market, when you have a healthy OI, that is open interest, then we believe that yes, there are genuine hedgers in the market. It's not only the day traders, it's not only the speculators. So we have 65% of a market, which is 65% is the open interest on a daily basis, which shows that there are genuine hedgers. So the exchange traded currency derivatives was basically is one of the product for small corporates, SMEs, to come into the platform and hedge, right? Because what we understand when a small corporate go to a bank and they don't get the best of the rates, when you come to the exchange, everybody is same because the demand, you have a bid and offer, and that is anonymous. So nobody knows who's on the other side. It's purely on demand supply, you get a rate, and that's why exchange traded currency derivatives is more, it's more suitable for all, because be it the biggest corporate in India, be the smallest corporate in India, both of them get the same rate. So that's why we were very excited about this product. We have about 12,000 corporates registered on the currency derivative segment, and we have about 2,500 corporates who trade on a daily basis on the currency side. So one of the important aspects is that we have banks, of course, public sector banks and private sector banks also participate. We have corporates, we have FPIs, we have proprietary traders, and some retail also trade the currency products. That's a mix of currency, and that mix makes the market more liquid, more active. As Mr. Mahalingam pointed out, the Reserve Bank of India also intervenes on the exchange traded product, shows the credibility of the platform, shows the liquidity of the platform as well. So when we talk about currency, it's not only USD INR. In the last 6-8 months, Euro INR and GBP INR have also picked up. In the Euro INR, we do about 2,000 crores daily. In the GBP INR, we do about 3,500 crores daily, both on the futures side, which is again, people thought that may not pick up, that's also picked up. So in general, when you talk about the currency market, it's not comparable to equity market, it's not comparable to the NDF market, which we spoke, but this is a market of its own. This 55,000 crores is just, we're just scratching the surface, we feel, because if more and more SMEs come for hedging, more and more people start knowing about it, I'm sure this volumes is going to go up, it's going to be more liquid. Today the market is between 9 a.m. to 5 p.m. So there was a Usha Tourette committee report which also recommended that the currency market could be extended to say about 11:30 p.m. India time. What typically happens, since it's in USD INR, the key data points from US come at about 7 p.m., 7:30 p.m. India time when we are closed. So when the market opens the next day, there is a gap up opening or a gap down opening, and we are not able to, our hedgers are not able to effectively use the information flow which comes from the US market. In India, the commodities market are still open till 11:30 in the night, so there is no problem in keeping this market open till long hours. That is one important aspect. When we say USD INR, the very important thing is it's not only traded in India, it's traded in Singapore, it's traded in Dubai, it's traded in Hong Kong, it's traded in Canada. So all these places trade USD INR. That's the best part. And they all get access to this information when we are closed. So I think the next logical step will be to extend this market a little more than the normal time so that we are able to make use of the information which flows after our market closes. What we have also seen when we meet SMEs and when we meet a lot of corporates, one of the disadvantage of a currency market is that an SME or a corporate will have an LC coming and going at any time in the month. It's not here in the futures market, it's structured. Every last second working day of the month, it will expire. It doesn't expire every day. It doesn't expire whenever the corporate wants. So that's where a little bit of paperwork is required. The day your LC is expiring or the day you require money, you have to close your positions here, take the money and go back to your bank and then execute the transaction. To that extent, there is a little bit of paperwork required, but otherwise the market is liquid, it's fair in terms of pricing, and that's why people are using it very, very extensively. So one of the things which is also significant in an exchange traded market is it's margined. Every day there's a mark-to-market margin, which is good from an exchange and from a risk management perspective, but from a corporate perspective, he'll say this broker is asking me for money every day or is giving me money every day. That's again, over a period of time, people will get used to it because mark-to-market is a way to actually trade the products. Global rankings, if you see the exchange traded currency futures market itself, again, NSE's number of contracts, based on the number of contracts, we are top 3 in the world. So this is basically on the currency side. Both futures, options, both the products are liquid. We will see some more products coming. So what we did about a year and a half back, we introduced weekly contracts. Weekly contracts in futures has again picked up. 40% of our volumes are on weekly contracts. So weekly contracts, you have to keep rolling over every week instead of rolling over every month. Why we did that is, in the equity side, when we introduced weekly products, it became hugely successful in terms of Nifty and Bank Nifty. So we thought we should replicate that. We did that, and that has also gone very well with the market. In the equity market, what happened was, when we did weekly, the monthly just disappeared. But in currency, the monthly and weekly both complement each other, and they do exceedingly well. We have about 70-75% market share in the currency market as a whole. And thanks to many of you, you are here as corporates who hedge on the exchange on a daily basis. Currency being a volatile product, it's an important tool for hedging, and that's why we have this derivatives market. Futures is completely margined. The exchange, the clearing corporation is the counterparty to both the transactions, so absolutely secure. And you have banks, public sector banks, everybody participating, and this market is becoming bigger day by day. So thank you very much. Thank you very much for your time. All of you have seen this before. Yes, sir.
Sorry, I won't really take too much of your time, but I was genuinely interested in this. How do we make this futures market deliverable? I mean, somebody wants delivery of dollars. We have to deliver, because ultimately that guy ends up going to the bank again to book a contract to get delivery. Can we not devise a way in which there is at least a kind of a net delivery made? I mean, have you people thought about it actually?
Yes, sir, we have thought about having a spot market for the currency, so that it can make it deliverable, so that it competes with the bank. That's why I said that's the little paperwork which is required for a corporate, which makes it uncomfortable. So we have a proposal which we are evaluating. It's still on the drawing board for an exchange to come to the regulators and ask the regulators to allow exchange to have a spot market for FX. So that will help delivery, sir.
Yeah, basically, I think there's an issue we have been talking, me and Maling. Unless there is delivery, I mean, once he has to go and buy it in the market to do the transaction, then all this is...
Correct. So the only reason why he still comes here and hedges is because he compares the same, he goes to a bank and he finds the rate, he comes to the exchange, which is on the website, he can see the price, he finds this little bit much finer, so the corporate comes here.
So bit of the being completely open he can make up, but not entirely.
That's right. That's right. And there is a position limit requirement is also there. So it's a percentage of OI, and that's also increased over a period of time because people have actually kept OI, which means they are genuinely trading here with an ability to hedge at any point of time.
Good morning, Mr. Hari. Sir, as you rightly mentioned about some of the problems which corporate will have in case of dealing with the exchange is one, of course, since it's a non-deliverable market, we have to again go to the bank. And secondly, the more importantly is the margins which we have to pay for everyday basis, because in the bank, once we made the forward booking, either buy or sell, we don't have any kind of margin pressure on the daily basis. So what I have an observation is that the exchange have a very good product, which is an options, which is a buying a call or a put for an importer or a buyer, an importer or an exporter. However, the banks are not yet giving us the options of buying a call or a put in such a liquid manner. You are saying that most of the bankers are dealing with options. However, we don't find that currently.
Correct.
Yeah. So if that can be done, I think this is a very good hedging tool which can be used from the exchange side.
So as I said, futures has been there from 2009 onwards. Options market has picked up only in the last, say, couple of years. When I say banks are doing options, banks are doing from their prop account more than from a client perspective. Because banks are not still equipped to give this, if I can call it a complex product of options to a client at this point of time. Most of the banks, 99% of the banks only give futures to the client. Options is evolving. A lot of banks, what I told you, are all they're trading on their own account. It took time for them to understand this product. A lot of people know this product, they didn't want to. They took internal approvals and they've started trading. Once they are comfortable, maybe at some point of time they will give it. You said it's liquid, it's about 250 crores premium turnover. So slowly it will pick up.
Thank you, Mr. Hari. I have to cut short. We are running out very badly time. Once over to you. Thank you, Hari, sir.
Thank you very much, sir. Thank you.
Thank you so much, sir. I'd like to request Mr. Biju to please come up on stage and present the memento to Mr. Hari. Ladies and gentlemen, a huge round of applause. Thank you so much. And now introducing our next panel, which is Sustaining the Pace of Financial Inclusion, FinTech, CBDC or else. I'd like to invite Mr. G. Padmanabhan, who will be the moderator for this panel, Mr. Naveen Surya, who is the Chairman, Non-Executive FinTech Convergence Council. He's an investor, founder, mentor, advisor, and FinTech industry thought leader. A huge round of applause. Mr. Rishi Gupta, who is the Managing Director and Chief Executive Officer of Fino Payments Bank. He's currently associated with one of the premier industry associations in the country, ASSOCHAM, and as the co-chairman of the National Council on Banking and Financial Services. A huge round of applause to Mr. Rishi Gupta. And next, I'd like to invite Mr. Suresh Sethi, who has over 3 decades of diversified global experience in the financial services industry and works extensively in the financial inclusion space, leveraging fintech and digital-led innovations to make a difference. He is currently the Managing Director and CEO of Protein E-Government Technologies Limited. A huge round of applause for Mr. Suresh Sethi. Over to you, sir.
Can be heard? Yeah. Okay. Thank you very much. We move away from the glamorous world of treasury, globalization, to Atmanirbhar and financial inclusion. So it's a completely change, but let's try to make it interesting. I think the financial inclusion part has been here for quite some time. I'm not trying to sort of reinvent or redefine what is financial inclusion. Everybody knows about providing affordable services, and any growth to be sustaining will have to be inclusive. All this we are aware of. I think what's important is the Reserve Bank of India got into the picture in a big way. Initially, as usual, the central banks world over, we also got it wrong. I still refer to we when we refer to Reserve Bank. We got it wrong in the sense that the Reserve Bank initially thought that the financial inclusion can be driven only by banks, and then it'll have to come as 4 products all coupled together, what we call the deposit, the payments, the credit and insurance. I think there was only one interesting thought within Reserve Bank of India at that point of time, which was articulated by the then Deputy Governor, late Subir Gokran. And Subir, in one of his speeches, said that the problem with the financial inclusion in this country is that we think we know what the poor people want, but we are not able to really understand or decide or understand what exactly they want and make this available to them. That's number one. And secondly, the fintechs or the non-banks came and asked this question: why banks? Why banks alone, and why these products must be given coupled? Why don't we decouple the whole thing and then probably couple it or bring it together at some level. So these were the interesting developments that happened when we talk about financial inclusion. I think in 2020, Reserve Bank of India came out with what they called a national strategy on financial inclusion for 5 years. Again, I think probably they got the timing wrong, not entirely due to their fault, because the next 3 years simply went away in COVID. And again, probably the priorities will have to be rethought about. Now, having said that, I think we need to admit that considerable progress has happened. If you look at these 4 products on its own, deposit, payments, credit, and insurance, I think in deposit and payments, considerable progress has happened. Whether we like it or not, as far as the payments, particularly the retail payments are concerned, I think India is the toast of the world. Particularly as far as the UPI is concerned, which incidentally clocked 7 billion plus last month. So that's something which people are trying to mimic around the world. As far as deposit is concerned, because of the government initiative, a number of Jan Dhan accounts or no-frills account got opened. In fact, that was a challenge for the new set of banks, the payment banks and the small finance banks which came in. But however, I think number of accounts have got opened, which is again a fact. But I think as far as the insurance and credit are concerned, there is considerable lag. And I think one thing that we need to understand about the way Reserve Bank or the government has driven the financial inclusion, particularly in payments, is I think the very structure itself was something which the world has not seen before. I think people like Naveen were in the initial thought process where the whole model was being driven. I think speaking of UPI, CGAP CEO Greta Thunberg, and I quote, that captures everything. India has been at the forefront of fintech revolution with a unique public-private model. And then comes the important observation. Not only has India been a world leader in building digital ID, a world-class payment system, but it has done this with an eye to inclusion and competitive landscape rather than the winner takes all model, which is unique as far as this country or the world is concerned. So that is where I think we differed from the rest of the world. The progress as monitored by the Reserve Bank of India Financial Inclusion Index has been commendable. I think the numbers changed by 2.5 from to 56.4 last year, March 22, when the data is available. The Reserve Bank has also flagged many of the issues which needed to be taken care of, which is on the universal access, bouquet of financial services, livelihood, customer service, all these kind of things, customer education. But the question that we are trying to discuss here and over the next, let's say 35, 40 minutes, is trying to understand financial inclusion, to my mind, is at crossroads. We have achieved certain basic things. Now to proceed, there are certain important things that we need to get right. And there, particularly when it comes to the role of fintechs and non-banks, I think the promoters of these entities are today in a confused state of mind because of the way in which the regulations are getting driven and articulated. So where do we stand? What do we need to do right to get this act right? Because financial inclusion is quite critical. And probably what needs to be really thought through instead of allowing certain products to happen. For instance, during the course of discussion, we will try to articulate the fact that one of the main areas, the credit, was in some way being taken care of by the non-banks and fintechs, and then the recent regulatory moves by the Reserve Bank of India cannibalized that to a large extent. So these are the issues which the industry is grappling with. The speakers have been, the panelists have been introduced to you. They need no special introduction, but I want to make a special mention of a recent talk which Suresh gave at the Singapore FinTech Festival. I was fascinated by the topic you spoke on, which says banking on trust, how the ubiquitous postman became a catalyst for financial transformation. Did I get that right? I think very interesting talk with Suresh gave. So how we propose to structure this panel is maybe a couple of minutes, given Biju has already, before we started, Biju has given me an end time. So, and he says we are running late, so I tried telling him I am not responsible for that, but he says, however, cut it out. So instead of 3 minutes, let's say a couple of minutes, your initial thoughts, then we will go to the specific issues. Maybe I'll start with Suresh.
Thank you, Mr. Padmanabhan. No, sir, I agree with you absolutely, the points you called out. And since we are talking about sustainable financial inclusion, I think certain things which go at the heart of the matter is the fact that inclusivity is critical, but affordability and access. And these are two factors which become very relevant. And India's story, as we've seen, I think Aadhaar, the national ID itself, has been a foundational moment. So once people had a digital ID and that enabled access. Coming forward from there, you are talking about ID becoming the foundation, but equally important was the fact which includes literacy. So when people were able to open bank accounts, and we've seen, and it's documented again, that India's inclusion journey, because of foundational factors like the ID, took 7 years, what otherwise would have taken 46 years. So the sort of account penetration that we got, that was phenomenal. But what became very important, and again, carrying forward the discussion we had around India Post, was the fact that just telling the people open a savings account doesn't solve. Because it is not the count of accounts that have got opened, it is the accessibility and the ability to use them. And there comes literacy, and it is equally important that the sort of product design you take on the ground, and that is where fintechs and the extensions that you get alongside the banks become very important, which have helped the people realize how they can use this particular facility. Accessibility has another factor to it, looking at the geographic width and breadth of the country, and the fact that in rural India, how do you get access? The physical distances need to be covered, and technology plays a big role. And I think India has been unique again in setting a very strong assisted model in play. Everybody does not need to self-serve, and I think those models have become very, very relevant in our context to say that the last person on the ground does not get left out. And affordability definitely, because some of the technology transformations, especially when we look at the fact that there is a lot of focus on creating digital public rails and putting an open architecture around them so that everybody can play on these same rails and provide solutions and services at the last mile. So I think these are the three factors I would like to call out, which have gone a big way in reaching where we are today in terms of sustainable inclusion at the last mile.
Thank you. We'll take this forward. Now, I think, can I ask Rishi to give his thoughts? I must say that Rishi resembles the Karna in Mahabharata. So far, they have been giving, as we know. I think they are yet to become, in terms of making money, but they have been doing enormous service as far as the financial inclusion is concerned. Earlier as business correspondent and now as a payment bank. I think, Rishi, your initial thoughts.
Thank you, sir, and good afternoon to everyone. So, I have been talking about financial inclusion for the last 16 years, and the fact that FINO was created 16 years back, and when RBI came out with this outsourcing guidelines on business correspondence. So a lot of things have evolved in the last 15, 16 years. I think the fact that the India stack came in, the technology actually helped. The initial 5-10 years we had a big issue because financial inclusion and everything was tagged with banks as a public sector banks, more from a give perspective as a social initiative. And financial inclusion could not actually become a business model, and a lot of people actually thought about the fact that financial inclusion is more of a service to the poor people, and it's not a business model. I think in the last 5 to 7 years, a lot of transformation on the thought process across the industry has happened. I think that's one of the big game changer from my point of view when commercial institutions and we talk about fintechs now getting into financial inclusion, because from a social initiative, it has become a business initiative. I think that is one big change which has happened. Fortunately for us in today's world, we are living in a technology which is available, network which is available. Way back, 10 years back, 2G networks, technology being not available, power was a big issue. A lot of those hindrances have been taken care of. I would say on the excess part, which my friend Suresh talked about, we had a big challenge about it a few years back. But now with the availability of business correspondents, merchant network, more than 3 million merchants are connected with various banks, whether it's a payments bank or a universal bank or an SFB. A lot of the excess issues have been solved. So opening an account is not a problem now. Transacting on an account in remotest parts of the country is again not a problem now. I think what we need to move up in the chain is the fact that people can open an account, they can do payment services. UPI has become available to everybody, nearly 15%, and you will be quite surprised that nearly 15% of our transactions are now happening on UPI, and we are largely rural focused bank or a middle income, a lower middle income focused bank. So with that category of customers, also 15% have now moved to digital ecosystem. So people are watching, people are understanding, a lot of communication is happening from multiple sources. I think what we need to now look at is how do we move up? As we see in any business, it's all about ABC. ABC means acquire a customer, build balances, and then do cross-sell. Financial inclusion to me is still in the first stage of acquiring right now. Unfortunately, we have not seen a big build-up of liability in that business. Cross-sell is still some distance away. So for me, financial inclusion has achieved the first step of acquiring and servicing. I think now we need to build that trust with the customer that they can build businesses. Obviously, we can continue to argue that they are people with limited means, so they will not be able to save that kind of money. But we now have to build that kind of trust with them so they start saving small and then go to cross-sell. And I think we have a question around cross-sell and credit and investments. Probably I'll keep it for that. But financial inclusion has come a long way, still a long way to go. But we are in a fortunate world right now with technology being available at a very cheap price that we are able to make this financial inclusion move from a social initiative to a business initiative.
Okay, thanks. I think, Rishi, you picked up the important issue of trust, and that's critical. But I think, as you said, we have moved a long way in the sense that if you look at the way these accounts, what are called Jandan accounts are behaving, earlier, the day it was credited, the amount used to be withdrawn. So the banks particularly hardly had any balances in this Jandan. But I think that picture is changing quite a bit as we speak. Naveen, your initial thoughts. In fact, I just want to provoke you a bit. I think during our conversation, you had even disputed the fact that India has done reasonably well in payments. So maybe you can start with that.
So my point was on financial inclusion part. So I don't want to take our credit for what we've built in the whole world around UPI, IMPS, and a lot of other payment solutions. We definitely are the leaders. But having said that, the reality remains, and again, all of us are exposed to this term financial inclusion somewhere around 2004-05, and we've been looking at it. Of course, we've made considerable progress, but the reality is largely around two buckets. In fact, one bigger bucket, which is banking, which again proves that the approach is not necessarily changed. Yet, I mean, while we like to say it changes, but I keep seeing flip-flop continuously every 3-4 years. So that's something which I wanted to call out. Payments, I definitely see a lot more use cases and a lot more uses by people sitting in this room. And again, to remind, financial inclusion in India is not a 20% bottom of pyramid issue. It's an 80% issue. Let me keep again and again saying even digital payments penetration is about close to 20-25% max of the spend. Still, majority spend, while the digital is growing, let's not forget physical cash transactions are equally growing at the same pace, which clearly says that there's still a lot more needs to be done. And even some of the initiative that IMPS and UPI have put together taken, I think we all need to work harder on, let's say, something like 123 Pay, which are offline solutions. So these are the reasons I disputed. I just wanted to quickly flag two parts around financial inclusion. One, on the approach, same way. I remember 2016, our association, which was represented by me in our Ratan Vatal committee, first time we put together a plan saying that we have to change our approach of putting cart before the horse, which is putting banks for the financial inclusion, because that's misfit. Look at this 80% consumers, what do they need first? The banks become relevant if you have a savings. They actually receive money and spend. So your payment is the first need, followed by emergency credit. If he's poor, he needs a credit. And followed by the health insurance, because if they get sick, then their whole poverty cycle comes in. And if we do not identify players who are engaged in those services at the grassroots level and empower them to do cross-sell of other services, we'll not have a model. And it was accepted, it was put in on a paper, it worked for some time. We see some bit of a work happening, but I keep seeing again newer thought process from a lot of policy makers saying bank will remain central, and we have nothing against them. The problem is that the model and the economics and the sustainability doesn't work. We have to work together. So just quick flag on that, that approach still needs to be fixed. It keeps going back and forth. Second part is around 3 broad buckets in a financial services component if you have to deliver. One is a product part, around the fitment to this 80%, and again within that subsegments of it. Second part is distribution, where Rishi talked about cross-sell. And if you go beyond banking and payments, anyway the rest of the penetration is in a single digit. So for an example, I still wonder, and I've asked a lot of questions even in some other forum, including once a member of IRDA chairman. If I'm a life insurance, why can't I sell general insurance? If I'm a general insurance, why can't I sell, let's say, life insurance? I just don't get it. And if banks can sell it, I mean, these are very basic questions, because there are huge challenges around sustainability when you're dealing with that extra bit of a segment, because the unit economics simply does not work if you have to deliver to that customer segment. So distribution still is broken for a variety of reasons. We still see a lot of friction. Lastly, compliance. And there's one common point as a concluding point for the initial remark comes in my mind. I remember Milton Friedman advising government that you can't control whether somebody was born in a rich family or a poor family. But what you can do is probably create equal choices for them. That's in your hand. But it seems we have taken it literally. We actually want to deliver same product as is, same process as is, whether it's a compliance or let's say product or distribution model across the segment. I think what he meant is create right choices, not exactly same choices. So I want to kind of conclude there in an initial remark, and we'll probably can get into deeper into this.
Thank you, very interesting. I think, even when I was in the Reserve Bank of India, one of the issues on which I think I did not agree with the view within the Reserve Bank is as to whether at the customer touch points, a person can deal on behalf of only one entity or several entities. Now, this is an ongoing issue. And the worry within Reserve Bank of India is that they will play one institution against the other institution based on the commission that is given. What is the Reserve Bank's problem with that? The boards or the banks or the boards of the entities must worry if somebody whom I have appointed as my agent is working for somebody else. But anyway, this is an ongoing issue, but I take on from the point that you made about the banks, non-banks, and non-banks including fintechs. So whenever we talk about banks, and particularly when I'm talking to the non-banks, fintechs, they always remind me of the Diwar dialogue. So the Diwar dialogue, very popular, it goes like this. मेरे पास वो है. So instead of मेरे पास technology है, मेरे पास people है, मेरे पास agility है, तुम्हारे पास क्या है? So the bank says, मेरे पास regulators है. Okay? Now, this is the common perception that goes around. So I start off probably with Suresh and Rishi. You can take this. I think in terms of, getting the proper model right. Is there a need for consistency in regulation, the regulatory approach? Because the flip point, for instance, the digital lending guidelines came and completely disrupted everything. The data protection, about which we'll talk later, who can have data, access to data came, it completely disrupted. Who can access Aadhaar, a new rule came, it completely disrupted. So the point that Naveen has been talking about, there has been a lot of flip-flops as a result of which the model, before it gets tested and it gets scaled up, it gets completely disrupted. So do you think that probably we need to have a different kind of an approach, because financial inclusion today will have to be now driven forward and scaled up, in my view, and please contest it if I'm not getting it right, through innovation technology. But are we providing the right kind of regulatory environment as far as this particular aspect is concerned. That would be the first point. Maybe Rishi can start.
Sir, this has been a constant debate, especially in the last year or so. In fact, the growth of fintechs and non-banks have been quite phenomenal. And recently also we saw some debate around the fact that the banks have not played their part on the UPI. And the fintechs have actually played a lot of innovation has come out from fintech.
But why do you worry about that? Nobody will like to play a part on UPI when you get zero revenue.
So that is where the banks came up and said that there is no revenue model on UPI and you would probably burn billions of dollars to make it possible. Maybe the fintechs are there with the kind of money they are getting from private equity that they are able to burn that kind of money. I think balance sheets of banks don't support that kind of money which is there. So to my mind, in fact, a lot of debate has been happening around how do we make it possible. So there is a need that non-banks have to play a role in not only delivering financial inclusion, but a lot of banking products for the masses and for everyone in general. The point which is there, sometimes the fintechs are not able to clearly make out where the innovation should stop and where the regulation should start. I think to that extent, there has to be a constant dialogue, to my mind, between the regulators and the fintechs. And with the fintech department coming up in RBI, I am expecting that department probably will take up the mantle and make it possible that a better communication can happen between the fintechs and the Reserve Bank. So nobody wants non-compliant fintechs. Maybe the fintechs in their innovation and the zeal to do much more sometimes cross their boundary and move into a non-compliant kind of a zone or into a banking kind of a zone, and the banks come up hard on them saying the fact that we are regulated, we are compliant, we have to do audit, risk and everything, whereas you don't have to do anything, and that's where the entire dialogue becomes a little messy. So a light touch kind of a regulation, something which I would say like a BC model, sir, something which came out in 2006, a light touch regulation was put up for BCs, guidelines came out, and within the guidelines, we all of us worked. So if there are areas where fintechs have to grow and there are areas which are identified, RBI, before it becomes up to a stage where you have to bring it back, like we saw in digital lending, a light touch regulation can come up that these are some of the areas which are allowed, some of the areas which are not allowed. Leaving it to the banks to regulate the fintechs may not be the right approach, because I don't know how much banks will be able to regulate or control the operations of the partners they are working with. But a light touch regulation from the beginning can actually make it possible. In fact, like a payments bank also, while we are fully regulated, but the guidelines had come. So we knew our boundary conditions, that these are boundary conditions. So if fintechs are also in advance, or some guidelines are there, where they can know in advance that these are the broad guidelines they have to follow, I think nobody would love to cross that line. Unfortunately, a lot of things are in gray, and that is where some of them actually cross the line. So to that
In fact,
extent,
I pick up on that last point. Lot of things are gray, so which means that it is not that they are deliberately violating, but certain things are not very clear, which goes back to the issue which I have been talking in several forums. Is it necessary for the regulations in this regard to become principle-based rather than getting into micro levels? Maybe, Suresh, I think while you answer, you can cover this, your views.
Sure, sir. So I basically, if I look at it, I see technology can play a huge enabling role, and we've been for long talking about risk-adjusted compliance. And one of the things which we found at the last mile, why did Aadhaar succeed? It was simply the process which was so simple that you just put your thumb and you are able to enable or do a transaction instead of using pins and passwords, and that was really a big change. And even when I look at some of the assisted models which enabled the Jan Dhan moment, what became very significant was that how did technology make the process simple, while we still kept the underlying requirement of KYC in mind, but the cost of KYC, the way it was done, the ability to train the person to actually do the inclusion at the last mile. So technology played a huge role over there. So I was coming to my earlier point to say that whether it is product design or whether it is how you actually solve for the person on the fringe, it becomes very important how technology can be used as an enabler. And I think regulation should then look at risk-adjusted compliance so that whatever is out there, adoption and design should align. Because otherwise, you make it so difficult for the user to actually adopt and move forward from there. And the second part, which becomes equally important, is the fact that as you are deploying this at the last mile, while tech can be an enabler, but at the same time, awareness of the consumer becomes very critical, because ultimately, regulation can't solve for literacy of the consumer. While we are definitely trying to protect the person, but ultimately, as you make them more aware, as you make them more knowledgeable, that also solves a big problem. And I was actually, I mean, we've all seen it. It's now a de facto in India. I had a few friends who had come from overseas, and they were surprised with the way a QR code is nowadays used to make payments to a merchant. And we had gone to a roadside shop, and when the payment happened, and there was a loud noise saying, "You have paid 5 rupees 20 paisa," it was a revelation to some of these people that how quickly we have solved using voice to enable the person who's selling the goods to just make sure that the money has reached their account. So some of these things have helped and played a big role in adoption happening at the last mile.
No, actually, you make an important point, but I again go back to the point that Naveen was saying that probably we have achieved a lot, but looking at the scale that or the size of the country, we need to achieve a lot. You talked about QR. Let me tell you that 2 years I had not traveled out, then I went to Singapore, and I was completely fascinated by the way in which they use QR in Singapore. It's a small city-state, no wonder, no comparison, but even for ordering food sitting in your room to the restaurant, you have a QR facility. So I think in terms of what can be scaled up, we have a huge probably miles to travel. You want to add anything, or shall I go to the next issue?
I actually wanted to add a couple of them. So in fact, even scanning of passport and immigration is done. And it's not that we don't know all of that. So challenge that I wanted to further emphasize is that this whole approach of flip-flop. There is a new technology which enables certain entities who ultimately work with regulated entities. And I don't want to, this is a contest between bank, non-bank. They are good, bad, ugly in all the communities, right? It's about they coming together, something technology has enabled, it's scaled up. Certain entities think that, hey, it's something that we could also do, replicate, but how do we remove their arbitrage? Like you said, how do you get, and I would use this sharp term that how do we get that killed and capture that market now? And I can quote two very clear examples, which is what really makes us disappointed. One is, in PPI, one time, money remittance was the biggest use case, more than Paytm, by the way. A lot of people don't know. 80% of the volume was a migrant laborer loading the money and then transferring into the bank account. 4 or 5 years back, regulation came, you can't do it without KYC on the both sides. Bank anyway is a KYC, PPIs are not. But for the same thing is allowed on a BC, which was always there. That if you go and say that this is a deposit into the bank account, it is allowed. Now the whole business overnight shifts to the other side. So what happens to the entities who started this? Nobody was using IMPS once. Today UPI is being driven through TSPs, working with banks, and everybody is taking advantage whether money being made or not. Tomorrow if a similar regulation comes and take them out completely, what happens to them? So all said and done, somebody has invested money in your objective. Another example. There is a policy which says credit card can be issued, and it's 2004 by all NBFCs subject to RBI approval. Till date, other than 2 bank-promoted NBFCs, none of them have got. You get some funny excuses, and I'm using word deliberately funny, that the complaints come more from the credit card segment, very sensitive. So it reminds me that if baby is crying, should we throw him out or just kill them so that they don't cry? Or rather solve that if they're hungry every day, let's feed them. Let's fix the problem. So somewhere when there is a demand, let's not forget, this whole digital growth in the lending has happened during COVID because of the fintechs and banks collaboration. If there are issues that have happened, the accountability should be on the all ecosystems, policymakers, regulated entities, and non. Why is it that certain segment of entities always singled out and are blocked not to do it and stopped? And then the whole business model comes down. So I just wanted to flag this approach point again.
No, fair point. I think what we are asking for is there must be much more clarity as far as the regulators are concerned. It cannot be a flip-flop, and it cannot be a stoppage of business based on an interpretation which nobody took except the regulator.
And not a guinea pig approach that somebody let them go out, do it.
Right.
And like you said, I have regulator.
Okay. Now, we have two more important questions to discuss before we throw open. So the first question I want to ask, again to Rishi and Suresh. I think the question, straight question is, we are talking about financial inclusion. The doubt that I have is, do we have adequate quality data about the poor? Number one. And the related question is, as far as the data governance is concerned, to what extent data can be shared within and the data can be shared across. I think there has been huge amount of recent developments, mostly negative, and how this is going to have impact as far as the financial inclusion is concerned.
So as far as poor is concerned, I don't think so there is enough data which is there. Because largely the transactions, platforms or the way poor has been dealing is more on cash. So cash doesn't have any trail, so there is hardly any data which is available. So what I understand and believe, more my belief, is the fact that 5 years, maybe 10 years from now, as the poor starts opening account and becomes more digital and starts saving some money, and through some other sources, if he can get some more data, he can get some credit. So over a period of time, some data can be built up. But as of now, they may not be new to bank. Largely, most of them have accounts. 40 crore Jandan accounts got created. But it's more money coming in from various government benefits and getting withdrawn. I don't think so that's the kind of quality data one would look at. One would look at the kind of transactions you're doing, whether he's going to a chemist shop, whether he's getting a fuel done, whether he's buying something online. So that kind of data is missing. Some people in the rural space, in the lower income categories, have started to use debit cards now, and also started to do POS transactions and do online e-commerce transactions. I think it will take some time, sir. My view is it's going to take some time.
No, I agree with Rishi, sir. Basically, I think definitely it's a journey. Today, we do not have sufficient data. But some of the building blocks that we see out there are definitely making it happen. I was actually very pleasantly surprised talking to a huge network company that in rural India today, they have people on the ground who they actually say are making 10 to 15,000 rupees a month on enabling these transactions. I cut back to 5 years ago when we were working on the India Post Payment Bank model, and we were trying to see, is it remunerative for the Dakya to actually provide banking services at the last mile. And it was always a challenge to even stack up 4,000 to 5,000 rupees as incremental income trying to provide banking services. So there is adoption. There is now more transactions. APS has played a huge role at the last mile, even when we talk about welfare and subsidy distribution and the ability of the person to withdraw money. And I think some of the initiatives, like for example, open networks for digital commerce, where we are trying to build now a democratic e-commerce model. And the focus is again to say, let's go to the last Kirana store in the queue and give them democratic access to various fintech-related e-commerce models. I think this is what will create the money transfer, economic activity through digital modes. This is what will definitely create more data for the poor, but today it's a journey for us.
Yeah, but it also, I think we will have to flag the issue of replicating the data again and again becomes a problem. We would, all of us would agree, though we don't have a solution unless the government and the regulator agrees, is the most replicated part of the financial system is the KYC. I'll have to do my KYC, whatever I do 10 times I'll have to do the KYC. That's the worst part. Of course, this is a story which I have shared with many. The happiest day in my life came when an ex-deputy governor of Reserve Bank of India got his mobile phone disconnected because he could not give KYC after the retirement. So, and he was the signatory to the KYC circular. But anyway, and maybe I also think that the blockchain is being wrongly used. KYC data or a central repository is one thing. So this data sharing becomes quite critical as far as this is concerned. Otherwise, this becomes a problem. Now, let me get to the latest baby on the.
So one point on.
Yeah.
One quick point on data, that while we're talking data as a transaction data and KYC, we forget that we don't even know unique users of each of these services.
Correct.
So how do you even measure it? We don't know how many unique users exist. for payments or for bank. It's all aggregate data. And what doesn't get measured can't get managed.
Yeah, but there is a problem. See, there are two things. One is about, I didn't want to get into this, but the data privacy, because in this country, data privacy, this has been in the making for such a long time. I can tell you that if I buy a medicine online today, all the other online medical people start sending me messages. So that is how the data is saved in this country. There's a problem as far as the data is concerned. Now, the second aspect is what Anant shared in the morning. I think you people were not there. I think the regulators are becoming extremely worried. I think, Suresh, in our conversation, you mentioned about the cyber issues and the security of this information. And that goes back to the point about the customer education. He has to be aware of, because unless the entire system is aware, I think the regulators or the government cannot ensure every time the data. Let me come to the latest, CBDC. Lot of things have been talked about. One of the use cases for CBDC has been talked about, touted as financial inclusion. Now, the other side, people are asking the questions, what is the difference between an UPI and CBDC? Why do we want retail CBDC in this country? Will it achieve anything which the UPI has not achieved? So much so that impromptu, the RBI governor during the monetary policy had come out with what is the difference between UPI and CBDC. I think a person probably who has participated in every CBDC seminar in this country, Naveen Surya, I would ask him to answer these questions. First of all, what is CBDC? How is this different? And do you think that that is going to be a game changer as far as the financial inclusion is concerned?
So I think basics, we mostly know two types of CBDC. Both are issued by central bank, just like the physical currency, wholesale and retail. But for this purpose, to keep short, I'll focus on retail one. Retail is, I say in very simple word that it's a physical currency on steroid. Why do I say so? Because your currently physical currency cannot be used in digital. You cannot put your bank note into an internet and a phone and make it use. So the moment you digitize and in digital form you receive it, it immediately is fungible across all possible channels. And it has exactly same characteristics. In a way, the way you go out to a kirana shop, buy something, give money, transaction is over. Payment and settlement both happen simultaneously. Finality is right there. In everything else that happens today in payment space is in a bank money, which has payments and then settlement. Even in a product like UPI, when two transfer happens between two parties, while you and I receive and transfer money, debit credit happens immediately, behind there is a settlement process between the bank. For CBDC, it's not required. Now, inclusion perspective, trying to keep it short, and we can take more questions later on this if required. The ideal use case, and don't go by the pilot the way it is being run. It is primarily a test of use case, some of the features, and eventually things won't be the way they are. Currently, it looks a lot more like a UPI, but it's not UPI. UPI is only a tool to move money. Currently, your bank money, eventually e-currency. So that's an application to move money. This is actual currency. So the simple use case from an inclusion perspective, best, let's say if I'm a government, I want to give money for a benefit to the user. Simplest way could be that if they have identified those users, as long as they have a basic digital device, maybe even a feature phone, theoretically the technology exists for you to get it. You receive a code directly based on your identification, that's your money in your hand. And because it is equal to currency, you could start spending it in your local ecosystem as long as there is a basic digital device with any person. And then if you want, it's a reverse process. You could probably transfer into a bank money and convert into a bank money if you want, if you have still some money left. So the process completely changes. A lot of other friction that exists today completely goes away. And it actually becomes immediately 100% fight against the real physical currency.
Okay, anything one of you want to add? That's fine. So let me go to the last part of my question, and then probably we'll take a couple of questions, time permitting. One is that we want to make 2 or 3 recommendations to the authorities or regulators as to what is the best way forward as far as scaling up financial inclusion further in this country is concerned. And what would be your thoughts? Maybe Naveen can go first.
Sure. So I think, sir, this fixed approach, I think collaboration model has worked. It's proven already, whether it's UPI, IMPS, even credit to some extent. Now, I think somewhere the policymaker has to think that which are the issues being raised, are they genuine in name of customer protection, in name of sometimes, I mean, I really keep hearing the systemic implications. Sometimes I worry, how does a retail credit really even go there? It doesn't actually, we all know that. But I find it very funny. So again, a fixed approach, clearly looking at the risk and fixing, like Suresh said, risk-adjusted approach continuously. And somewhere we have to understand that if inclusion has to work, the distribution part and the compliance part has to be drastically changed. It will not work. Cross-sell has to be allowed to everybody who's included in an inclusion framework, without which the model does not work. Compliances cannot be same what is actually for a very high value transaction. It has to be drastically shifted. And we all understand it's allowed in FATF guidelines, which is what we keep being thrown at.
So, sir, I think Naveen has already said that, but I think from a regulatory point of view, a more open regulation will definitely help. I'll give you our own example. Payments Bank, a lot of distribution has been set up. Nearly 2.5, 3 million points are there all across the country. We are enabled to do payments, we are enabled to do liabilities, but we can't offer credit. So, being one of the largest distribution points across the country, dealing with the real financial inclusion customers, the need of the customer, when they come, they open an account, then they ask us, can you offer credit? So we say we can't offer you credit. So something like this, a more open regulation would definitely help the ecosystem which has been created, the infrastructure which we have. Why do we need to restrict it by regulation? We should be more open to such kind of changes in the regulation. I think that can help financial inclusion in a big way. And coming back to my same point, if there has to be some regulation at some point, it is better to be upfront and bring up that light touch regulation, and it can be entity to entity based. Some of them are really small, maybe given more arm to be innovative. Somebody who's really big, like the big tech, whether they should be regulated, not regulated at all. So a lot of questions around that has been there, but a light to a high touch regulation can depend on entity to entity as well.
So, sir, I think basically with, as we were talking about, data is going to become and is always very important. And as we get into the digital data realm, the account aggregator ecosystem, and how do we actually look at consent, provide assisted consent sort of architecture to the people so that everybody at the last mile can use it. Because it looks like we have to create some assisted modes over here, just like UPI adoption needed time and people needed to be educated how to even get a UPI handle.
Sorry to interrupt your thought, but there the problem comes in. You mentioned about the account aggregator. Today, an account aggregator which the Reserve Bank of India has permitted, he cannot straddle the capital markets from the same entity. He will have to have a separate entity because otherwise two different regulators come in. So the issues of cross-selling, being able to cross-sell, and the regulators coming together. Yeah, probably there is an FSDC which you can call it as a regulatory aggregator, but really they are not able to work beyond a point. So ultimately these regulators will have to come together to make sure that this cross-sell and the innovation which can be seamlessly applied across happens. But sorry to interrupt, go ahead.
No, I agree with you, sir. Basically, going down the same path, the whole point is it's data, it's personal information. So the information can be financial, it can be health. You gave the example of, you picking up some medical stuff and it gets published all over. So as we are looking at technology as an intervention point to create open stacks in health, in agri, in financial services, data stack is the first one. So how data is monitored, measured, how do inter-regulatory and inter-sector work happens together in this space, aligned with the data bill, is going to be very critical.
Let me take a quick vote before I throw open if there are any questions. Do you think that the way forward, as far as the data is concerned, it must be a pure consent architecture rather than the regulators coming and deciding what can be shared and not shared? You think that's the right way? Yes or no? Yes. It's all yes, is it?
Yes.
It's all yes. Okay. I think these are the issues which I basically wanted to discuss with my panelists. You would have seen the depth of their experience and knowledge. We are open to take a couple of questions. Bijur? Okay. No, that depends on the questions. Otherwise, I'll...
Naveen, as you mentioned, this is something that we hear from other fintech companies also. What is it that CBDC is adding to the existing payment system? If we have UPI, why CBDC? But we can flip the question. If we have CBDC, why UPI?
Actually, it's a wrong question. They are apples and oranges. Like I again repeated that if I have to go from a destination A to B, what UPI is a transport mode, not that destination. Currency is the destination. And again, think of CBDC as nothing but your currency in digital form. Like I said that the moment you give your cash transaction is over. In UPI for you it's over, but it's actually not. There's still certain challenges. So think in that sense, what it does to the ecosystem is completely different. There are a lot of models which will get disrupted, right? There are a lot of things that can be done. Imagine that if I'm a vegetable vendor, today if I have to participate in a formal payment systems other than UPI everywhere else, again there is a T plus something. It could be a time or a day. But if I have a currency in my hand and if I have a basic feature phone, I receive the money, I go back and give it that. I mean, I don't really necessarily need the loans for every day because my money is already with me. I can start using it. So the implications are completely different. I don't think most of the people in the ecosystem other than the limited parties who participated in the pilot have even thought through the implications. So to go back and think, forget what exists. Think if the money is digital, what is money as a currency in your hand? Not money but currency. What can happen? Forget what the current infra is, what it should be.
No, I think maybe let me try and give you a more honest answer. Okay. I think the central banks around the world started worrying about crypto. So they wanted to have, because crypto had its own problems. Whether we like it or not, no regulator will be happy with crypto because that's a pure speculative asset, no underlying, and if there is a problem, the kind of problems that has happened, and the regulators get blamed for. Even in this country, I feel that we have done a great disservice to the entire community by not coming out with a firm view one way or the other whether crypto we want or not want. Having said that, so people wanted to come out with this. Now, you will have to think of CBDC as an alternative to cash, not to a digital transaction. So then the question arises, is it going to be adopted? If it is adopted, what is going to be the advantage? The advantage is that my cash distribution cost to the country, which has a certain amount and which has an implication for GDP, etc., or expenditure, central bank expenditures, etc., that could get controlled. Now, reaching these people, it will be easier rather than reaching cash, given the length and breadth of the country. But personally, I think the biggest use case of CBDC retail is going to come about in the P2P cross-border transactions, right? Now, you cannot start off with a cross-border transaction, so the way in which we are getting people used to this local transaction, it's a fair experiment. But whether it is going to make a material difference as far as the people's usage of currency or currency habits, and people are going to move on to CBDC instead of keeping cash, I have a doubt. Now, the other question that at least I must be honest enough to answer is that the so-called anonymity that is being talked about is complete nonsense. I don't think anything which is linked to technology can say that I am anonymous. I mean, the simple example I can draw is that when I was heading the Hyderabad office, we have every regional director has a monitor which particularly monitors what is happening in the cash department in the Reserve Bank of India. Those days, one of our deputy governors, he is no more now, Dr. Tarapur, he came there and it was supposed to be an incognito visit. But I could see it. So I sent somebody to ask him whether he can come for lunch. Then his doubt was whether his visit was made known to me. How did he know that I am here? He said he saw it on the TV. So the anonymity of CBDC is something similar to that.
That was a big one. Good one.
Regarding the same CBDC, I have one observation. Please correct me if I am wrong. So there are two perspectives. One is from the user's perspective, other is from the regulator's perspective, RBI's perspective. What I feel is there are some demerits of the cash which CBDC will take away. So one is tracking. So now if I have to say, I withdraw 10 lakh rupees in cash and give it to somebody else, there is no tracking. I withdrew and gave it to somebody, the connection cannot be made. While when it is in CBDC, it can be made. So one is tracking. Second is...
That's answered. That's why I said no anonymity.
Second, of course, transportability we are talking about and lesser cost for the central bank. So if we move gradually away from the cash system to CBDC system, I think some sort of, corruption, control and all will also happen.
Yeah, but let me add one fundamental point. It's about velocity of money. When it's digital, it will move fast, which means everything will grow fast. That has huge far-reaching implications.
Yeah, but the corruption in this country being completely removed, I think we'll have to remove the word jugaad from the dictionary.
It can happen in cash.
It makes jugaad a bit difficult, sir, in this case. That's
Corruption can happen in cash anyways.
Thanks, sir.
So,
I have one question. How CBDC can improve the efficiency of cross-border wholesale payments involving multiple currencies? I am hoping that this will reduce the transaction costs and makes international business quicker.
Yeah, I think even Malingam will be able to answer that. I think today the central banks are worried about the cross-border transactions for 2-3 reasons. One is the speed of settlement. The second is the cost. And the third is the transparency of the rates applied. All these things they think can be taken care of if the central bank gets into the picture and the cross-border can be taken. That's fairly simple. But I hope all this will happen because it depends upon the other countries coming. And this country has additional implication in terms of the exchange control still remaining. And that will have to be now. Every P2P transaction, if the enforcement directorate comes into the picture, then people will stop that also. So we'll have to think about it. I've given back your 10 minutes. Okay.
Thank you so much, gentlemen, for a lovely discussion right here. I'd like to invite on stage Mr. Ramakrishnan S. to please come up on stage and give the mementos to the lovely gentleman right here. Thank you, sir. Huge round of applause, ladies and gentlemen. Thank you so much, gentlemen. And I would request Mr. Ramakrishnan S. to please stay back on stage to give the talk on process automation in finance and treasury, key success mantra for CFOs. Mr. Ramakrishnan is an ACA, ACMA, ACS and comes with an overall 26 plus years of industry experience in manufacturing, IT, ITES, consulting and services industries. He specializes in helping listed companies to have a highly automated investor relations function and setting up a healthy communication channel between companies and its investors. He has been running his own consulting firm, Ramki Consulting, specializing in investor relations, tax and treasury functions, and is also a partner at CFO Bridge, heading their investor relations practice. Ladies and gentlemen, Mr. Ramakrishnan S. Huge round of applause, please.
Thank you. First of all, congratulations to the Almus team for putting up another grand conference another year, and they're growing year over year. Congratulations to them. Quick word about CFO Bridge. CFO Bridge, we are a 10-year-old firm. We are India's largest CFO services firm, primarily focusing on providing remote CFO services for various companies. We've got about 30 partners in our firm. We're about spanning about 700 plus years of experience, having operations in Mumbai, headquartered in Mumbai, We have operations in Pune, we have operations in Delhi, NCR, we have operations in Chennai, Bangalore, and Hyderabad. So that's briefly about CFO Bridge. And like I said, the remote CFO services which we've been providing is a well-oiled engine. We've been doing this for almost about 10 plus years now. We've got customers staying with us for the entire span of 10 years. But now, we are moving to something new. I mean, obviously, something which is, we've been listening. Morning, we heard Mr. Anand talking about historic level of where we are in imports. The last session, we spoke about fintech. So just taking a cue from some of these things, the areas which we are now focusing now is more on robotic process automation. Why robotic process automation? Again, here we've seen, typically when a finance guy comes over and talks about RPA, there's a lot of eyebrows which goes up. But the effect and power of RPA in finance is something which we are seeing on a day-to-day basis. And it's really having a telling impact on the entire industry. So what, and why RPA is basically, again, it's an offshoot of what happened during the COVID. Post-COVID, companies are struggling to find people. Even if they find people, just before joining, they probably don't come more on board. And then the processes also get struggled, and more often than not, we're figuring out that CFOs are struggling to kind of deliver services. So that's where, I think automation plays a great role of easing the roles and easing the solutions for the CFOs. So some of the areas, and again, I also recognize the fact that the room has got more people from a treasury background, and the topics are around the same. So I would probably touch about the topics which are more concerning RPS pertaining to the treasury. So apart from the CFO services, we also do MIS automation, FP&A automation, working capital management automation. And talking about working capital management automation, some of the areas which we are currently focusing on, obviously is in terms of, it could be on imports. We're speaking about historic imports. More often than not, Almus as a company, they do a great job in advising you in terms of what kind of hedging policies, what kind of, derivative strategies you need to have. And they're good at that. But the basic thing which they first come and ask you is for data. And that's where companies struggle a lot. So what we try and do is we try and put in our RPAs into the systems. And our RPAs are kind of ERP agnostic. So they could pretty much sit on any ERP, pull out data for you as and when you read, and it is not dependent on any particular individual. And you pull out the data and give the data, and then there could be real-time decisions taken. You could have a fixed FX policy, but over and above the FX policy, you could also alter the policy as and when the data comes up. And that data could purely be done by a robo rather than depending on an individual. The second thing area which I would like to talk about is on some of the GST recons. Of course, the technology taking over GST recons is now a good about 5-6-year-old story. But what we have gone to the next step is to kind of introduce RPAs into those GST recons. So traditionally, we have some individual in the company who sends the data, and then that data is pushed into a reconciliation tool, tallies with the GSTN, and then we have a reconciliation. But here is an RPA which goes out and pulls out the data directly from the RPA, from the ERP, pushes it into the recon tool, and gets the output into, it also reconciles with the GSTN and then gives you the output. So basically, we are trying to go to the next level of automation, which is trying to kind of reduce the dependency on individuals. And I'm specifically highlighting these points because these are working capital management points and more interest for this kind of crowd. The third thing is in terms of any kind of reconciliation. More often than not, especially with the kind of e-commerce transactions, we spoke about UPI, now we are talking about digital currency and so on and so forth. But what it also means, the more the transactions happen through UPI, the more the transactions happen through Rupee and various other platforms, the need for reconciliations are also very, very high. And in those cases, typically what happens is we put in our RPAs to go and do majority of these reconciliations. So it's not a human dependency. And we work with e-commerce companies, and one of the biggest problems we've seen with the companies is that they are not very sure whether the settlements happen completely, whether the settlements happen in total, or is there a shortfall. So more often than not, they almost account what comes through. But now we have an RPA which kind of tells you the story in terms of how much is fully settled, how much is partially settled, and so on and so forth. So it's kind of embracing technology to the next level and making sure the human intervention is completely minimized. So similarly, in terms of again, the other thing generally for treasurers, early morning when I come and see as a CFO, the first thing I would like to see is my dashboard in terms of my banking balances, where we are on loans and stuff like that. And more often than not, it depends on a treasury guy to pull out this stuff. Whereas here we are talking about RPS, it could be anything. It could be emails coming from banks, it could be bank statement from banks, it could be from various platforms. Still, the RPS will be able to collate the whole thing and give it out in a meaningful format on a day-to-day basis, and also dole it out in the form of emails to a fixed group on a daily basis. So there are multiple ways in which we could automate the entire thing and take technology to the next level. And that's what now the CFO Bridge is completely focusing on. Other than that, obviously in terms of from a management perspective, be it in terms of automating the entire MIS and dashboards for the management, rather than depending upon individuals to prepare it, there are specific set of data which can be pulled out from the ERPs, specific output format which is determined, and then can be kind of doled out anytime to a set of people whom you determine. So long and short of the story, it's collating of all critical information in a digital form by a robotic product to kind of make sure that you get an output seamlessly, accurately, and also on a timely basis. Okay? The best part of it is, while RPS have been there, it was not all that affordable till now. But now what's happened is RPS are becoming a lot more affordable. And more importantly, RPS are also now available on a SaaS model. So you pay as you use. You don't need to necessarily buy the robotic product and then invest in capital. You do it on a SaaS model, pay for the number of months you're using, or pay for the number of users you're having. And then once you're comfortable, at some point in time, if you think you can replicate it for more processes, at that point in time, you go out and invest further. So that's how, CFO Bridge is completely kind of glued on and changed. Of course, our well-oiled engine of CFO services and MIS and FP&A and stuff like that is a well-oiled engine for 10 years. But now we are moving to the next level, and we are also catching up with technology, and that's where we are trying to help companies to put in RPAs and make sure the automation goes on to the next level. The team from CFO Bridge is there out, and if you need more details, we'll be extremely happy to kind of share more details. But I would like to thank Almus for giving us an opportunity to sponsor. And like I said, more information, we are pretty much available here. Thank you.
Thank you so much, sir. And for our next session, sharing of entrepreneurial experience, I'd like to not actually give you the introduction of our speaker, but let an AV play for you. Can we please have the AV?
मैं चाहता हूं कि आप लोग सब अगले 2-3 मिनट इस वीडियो को जरूर देखें, क्योंकि उसके बाद हम सब मिलेंगे और कुछ बातें करेंगे.
I think the captain is the most important. I think Dr. Amit Sharma.
Maybe the judge.
He stays at the border all the time so that we can spend time with our family. He makes sure our safety is his first priority.
She's upholding the Constitution of India. It's a very, very big thing. The crimes over there. Such a difficult job. Justice being.
This is a COVID situation where someone delivered this. Everyone was locked up in the house. But doctors and the entire medical fraternity was right there to honestly, I don't really know what who she is and what she does.
मेरा नाम स्मिता पटेल है मैं एक स्कूल टीचर हूँ और ये तीनों मेरे स्टूडेंट्स हैं
नहीं यार मुझे लगता है कि ये बहुत इम्पोर्टेंट है एक्चुअली
टीचर्स नहीं होंगे तो फिर कोई कुछ बन ही नहीं सकता इट इज अ वेरी सेल्फलेस जॉब
it's a noble profession or they are creating geniuses but she's kind of shaping the future of the country.
थोड़ा जोर से ताली बजाएंगे टीआर फॉर टीचर्स के लिए आई थिंक वी ऑल थैंक यू वेरी मच आई थिंक वी ऑल ग्रोन अप लुकिंग एट कैप्टन जज डॉक्टर आई इवन सीन दिस कार्स विथ एडवोकेट का भी एक छोटा सा लोगो होता है बट टीआर फॉर टीचर्स हमने शायद कभी देखा ही नहीं है when I saw this video the first time and Maulik and I were speaking about it, we thought that let's invite the person who's behind TR for teachers, the idea, the concept and how it's actually happening out there in the world in which we live today. My name is Vijay Chand, but ladies and gentlemen, it's my privilege today to host Mr. Gyanesh Gala, Managing Director of Navneet Education. We also know him as Sunil Gala. Sunil bhai, with your permission, probably I'll just call you Sunil bhai. Sir, please. पिछले साल Almus की जो 8th conference थी, उस पे we started this little session called Entrepreneur Speaks. आप लोग इस पूरे दिन में बहुत ज़्यादा economy, foreign exchange risk और पता नहीं बहुत complicated बातें करते हैं. And then we thought we should kind of include something that also talks about people who are making some very interesting concepts, some real businesses. And last year, if many of you remember, I had the opportunity to host the chairman and managing director of Lakshmi Organic, Mr. Ravi Goenka. This year, I have Sunil bhai with me. Sunil bhai, thank you for joining us. My first question really is TR for teachers. Sir, इसके पीछे का thought, idea, आप थोड़ा बताएंगे हमें?
So my question to the audience could be, how many of us really remember our teachers, care for them, or once we are out from the school or college? So what we realized in last 60 years or 65 years in the business, we are very, very close to lakhs and lakhs of teachers. We realized that while in the school or college, they have limited resources. Post-retirement, they have almost no resources to really take their livelihood on. There are hundreds and lakhs of teachers like them. So we thought, if we can give them some credit by way of prefix, and if we can give them some status, I'm sure all of us will start recognizing that status, and in turn, indirectly, directly, they will be benefited while in the profession or post their profession. So that was the whole logic.
No, thanks a lot. I think for all of you who've seen it on LinkedIn, on social media, I would really want you guys to share this video and take it out to as many more people, as we can reach. I think TR for teachers is a great idea.
He wanted to say something.
So you wanted to say something?
Yeah, true.
Thank you very much, sir. Thank you very much. Sunil bhai, kam se kam, I have actually grown up and, a lot of credit to you and Navneet Education now, but Navneet Publications as we know it. आप लोग जो गाइड्स बनाते थे, उस गाइड्स को पढ़ के एटलीस्ट मैं तो स्कूल से पास हुआ हूँ. आई थिंक यहाँ पर बहुत सारे लोग होंगे जो आप लोग के पास भी अपनी वो नवनीत गाइड्स हुआ करती थी, जिसको पढ़ के हम लोग फटाफट एग्जाम दे के पास होते थे. So you had a very, very long journey. Can you just spend a few minutes, talk to us about how Navneet started, where are you today?
Oh, I'm part of second generation in the family. My elders hailed from, we hailed from Kutch region, northern Gujarat. They came in Mumbai around 40s, early 40s, and they started with a small retail shop. I should also mention one thing, which today we can't even accept that situation being my parents, all of them, for initial 4 years of their coming to Mumbai, they literally slept on the pavements, and then they continued struggling. But post that, slowly, they set up a retail bookstore, then wholesaling. And one fine day, one of the publisher denied giving us several copies unless we give them hard cash on the table. That was the year 1959 when my father and my uncles decided, why can't we publish? Since then, we are in the publication business.
1959.
That's right.
Wow. Well, I don't want to say that I'm sitting between you and your lunch because this is a great session as well. So slightly better applause for somebody who's been giving us guides and books and education now since 1959. सुनील भाई, आपकी ना वेबसाइट मैंने देखी, उसमें कहीं ना कहीं आपके फाउंडेशन का काम छुपा हुआ है. In fact, you know, I told you this last time as well. It has to come out a lot more prominently. You mentioned that, you know, your family comes from Kutch. मैंने आपके फाउंडेशन के बारे में एक बहुत इंटरेस्टिंग कहानी पढ़ी आपके फाउंडेशन के पेज पे, that छाछ is made at 5:30 in the morning and served to hundreds and hundreds of villages every day, even today. सर, थोड़ा फाउंडेशन के बारे में बताइए, क्या काम आप लोग कर रहे हैं, और ये छाछ की कहानी थोड़ी और बताइए सर.
So our parents, when they came from Kutch and when we also started growing with them, they always told us that whatever that we earn, we should give back to the society, part of it, every year. So when our family was very low in terms of earning, then also we were trying to contribute back to the society. So Chhash, if you all know, most of you rather would know, across the villages in the country, the staple food for them is bajre ka roti, Chhash and onion when they go to farm. We realized, at least at our native place, that for them to get milk every day to make Chhash was also not possible. So for the last 34 years, every day, as you rightly said, around 5:30 a.m. Chhash is made, and around 400 families, they come and collect Chhash so that they don't have to worry about that, one of their staple food, and they can complete their day as far as eating is concerned.
Oh, excellent. Sir, why 5:30 in the morning? Is it because people go to the field very early in the morning and the climate in Kutch? And
That's right. So they leave for farming around 7, so they take before that.
All right. And sir, what other things do you do at the foundation?
Oh, lot many, maybe housing for needy, education. We have a couple of hospitals in the city. Then we have education institute. So that way we do lot. One of the biggest activity that we did, that we housed 1,008 families in a suburban of Dombivali near Mumbai. At 1/3 of the cost, forget about the market price, but 1/3 of the cost, and rest was contributed by the family. One of the most encouraging thing that I feel I should mention here today, we are talking about future of India, very, very bright future of India. The foundation will be, one of the requirement of the strong foundation will be the education. So what we did, of course, we are in the business of education. What we did, we have started approaching various corporates and trying to bridge gap between the needy schools and the corporates. That way, we are trying to support hundreds of schools today with the support of so many corporates. We believe if many NGOs like that who can contribute something to the education, the foundation of India will become more and more stronger.
Wow. Foundation of India, ladies and gentlemen, is in education, and you're hearing it from the man who's a second-generation entrepreneur in the business of education now since 1959. Sir, EdTech के बारे में कुछ बात करते हैं. Yeah, I like that smile on your face now. So EdTech, in my opinion, sir, has had multiple reactions. There are some very famous startups, and I'm not going to name any one of them right now, because we all probably, tend to point a finger at one or two of them only. But a lot is being spoken about EdTech, and there are multiple opinions on the table in terms of what impact or what contribution really technology is making in the field of education. What's your take on EdTech? Because I think that is something that you tend to talk about on your LinkedIn profile. It is probably close to your heart, and there is investment that you're making in that space.
Excellent question. I might say that I'm confused a bit to start with. The reality is that technology in education going forward is must. Question is, should that technology be given directly to the consumer, or should it be routed through the schools? We strongly believe B2C, direct to customer, is not likely to see going forward very, very attractive. As far as K to 12 is concerned, post 12th, of course, it can. So schools will have to adopt technology going forward in the classroom. And if that is so, school will have to invest, teachers will have to start adopting the technology, and thereafter the learning outcome, which is the most important, will improve going forward. So technology is here to stay. I should say blended education, physical and technical technology, both put together, will be the way forward for India, or rather for the world.
And sir, do you think that's also happening in the SSE curriculum? Because IGCSE, ICSE, big words, big terms, these schools probably have the wherewithal to invest in the infrastructure that they're building, not only just the academics, but probably the overall education as well. But what about SSE schools? I mean, I passed out of a very humble school in Goregaon West. When I go through Bangur Nagar even today, how many people from that area? Goregaon, Bangur Nagar, Areva, there are a few here. Maulik and I, by the way, we went to the same college. He studied, I did not. So, sir, SSE, वहाँ पे कुछ impact हो रहा है sir, because वहाँ पे I think 80% बच्चे, मुझे लगता है शायद ज़्यादा ही होगा, percentage all over India would still be the SSE curriculum, right?
Again, an excellent question. I think for the information for all of you, many of you may know it, but the reality is 95% of the student population or the institution or schools, they follow SSC curriculum, and rest all curriculum, be it CBSE, ICSE, IB, IGSE, is just 5 to 6%. The situation at the ground is very different than what we read in the papers or on social media. So the technology inroads into those 5-6% has taken quite ahead, but reality in SSC is a little not as appreciable as it should be. And for this, we believe slowly, with more and more technology going, rather adopted by the parent community, by the teacher community, technology also will get adopted in the schools. And here I believe not only the private players like us, I think in partnership with government, if something can further be done, then in such investment will make, give country a strong foundation, and that should help overall the country.
Thank you very much. My last question, so that you know this is my last question. I follow this guy called Naval Ravikant on Twitter. So Naval Ravikant has, he's on Twitter. Abhi paisa waisa bana liya hai, so he's on Twitter pretty much most of the day, I think. So one of his famous quotes is that listening to a book as compared to physically holding a book and reading it is like drinking vegetable juice instead of eating sabji roti. So I mean, he's still probably a little conservative on that side. Sir, किताबें रहेंगी? आप तो, you are in the business of making books, physical books. But will we still have books in the future? I mean, where do you see ourselves in, let's say, 5 years, 10 years? Will we continue to have books, or like many who have a slightly bigger mobile phone in their hands. Where education moved to the mobile phone, it did for a bit, for 2 years in between. I work for a company called Dwara. We are in the business of financial inclusion. We have 9 group companies. We are very proud and humble enough. We've touched about 60 million lives, and I go to a lot of small villages all across the country, and it's just outstanding. The last few sessions that we heard on financial inclusion, it's just outstanding how Bharat is now really responding to technology, responding to the ability to access credit. But more about that later. So back to the question, will there be books?
So during last 2 years of pandemic, I think many of us were wondering whether books are required really. But the reality is post-pandemic, schools literally are saying, students and parents literally are saying, forget about technology, we'll see that later, we want books. This is the reality. From scientific way, if I may say so, whatever reading material that we have in the form of books or physical books may get converted on a digital platform. Activities may get, but as far as writing skills are concerned, I doubt it should ever get shifted to a technology platform. The brain creativity or the development of a brain happens only when we write with hands. That's proven scientifically, and therefore I believe it will always be blended education, never ever only technology.
Well, that's a great answer. Show of hands on how many of you agree with him right now on this. When you write, wow, that's pretty much all of us in this room. Very much all of us in this room. Thank you very much. Ladies and gentlemen, a round of applause for the person behind TR for Teachers.
Thank you so much, gentlemen. A louder round of applause for these gentlemen, please. And now I'd like to call on stage Mr. Anshul Chandak to please give the memento to these gentlemen. So
And now there is lunch.
Picture. He wants a picture. And now we have a lunch break of exactly 45 minutes, and we'll be back with our next session. Thank you so much, ladies and gentlemen. We'll see you back in the next 45 minutes. Let's begin our next panel. The discussion for our next panel is Advanced Risk Management, Return of Exotic Forex Derivatives and Opportunities for the Corporate Treasury. For that, I'd like to call on stage Mr. Maulik Shah, the co-founder and CEO of Almus Risk Consulting LLP. He's going to be the moderator for the next panel. A huge round of applause, ladies and gentlemen. Friends, आप अभी lunch करके आए हो, थोड़ा louder. Let me hear you. Next, I'd like to invite Mr. Anshul Chandak. He's currently the head treasury for RBL Bank. The bank has added various businesses like FX, derivative, and bullion in the product bouquet under its leadership. Prior to RBL Bank, he was associated with HDFC and Kotak Mahindra Bank. His areas of expertise spans across balance sheet and investment book management, debt capital markets, FX and fixed income trading, and Forex, foreign currency fundraising for clients. He's also handling the additional responsibility of overseeing International Banking Unit located at GIFT City as chairperson of governing body. Next, I'd like to call upon stage Ms. Manasvi Goyal. She's currently the head Group Corporate Finance and Treasury, Mahindra Group. She has taken over the role effective 1st November 2022. She has been associated with the Group Corporate Finance function since 2015 to 2020. Where she was responsible for treasury and banking for M&M and treasury and banking advisory for Mahindra Group. Ms. Manaswini brings with her more than 22 years of experience in treasury and finance functions of organizations like the Mahindra Group, HDFC, and National Housing Bank, spanning diversified businesses around the globe. Next, I'd like to call upon Ms. Tanushri Bagrodia. She is the CFO at Lakshmi Organic Industries Limited. Ms. Bagrodia's banking career started in London. Her first momentous career success was when she set up a widely acclaimed and profitable collaboration for an Anglo-Belgian investment bank, KBC Financial Products, with one of India's most respected financial services group, Kotak Mahindra. She became amongst the youngest professional CFOs in India in 2013. After a 6.5-year successful tenure in manufacturing, she transitioned to India's fastest unicorn, Udaan.com, as the CFO and head of the enterprise credit at Udaan Capital. And next, I'd like to call upon Mr. Jay Gupta. He is the co-founder and COO of Dhan, a technology-led investing and trading platform. He has been in capital markets for over 18 years and led the digital broking initiatives at Indiabulls, Carvey, and headed the currency desk for Mangal Keshav Group, after which he was the founder and CEO of Malayalicious Securities. Mr. Jay Gupta. He's just coming? All right. Can we have a huge round of applause for all our panelists, please? Mr. Jay Gupta will be shortly joining us. Till then, we can start, I guess.
Hello. So welcome back, everyone, from the lunch. The topic for this panel is Advanced Risk Management, Return of Exotic Derivatives. The title itself says something, Return of Exotic Derivatives. And in the Indian context, I must say, as far as exotic derivatives journey is concerned, in one line, if I were to sort of describe, it has actually moved from a glamorous girl to the most hated villain, and then become an extinguished alien. 2007-8, something happened. We had the exotic products being used both by the corporates, being sold by the bankers, and then something happened in next 2-3 years. 2011, there was a ban on the product, and now till about, I think a year back, when Reserve Bank of India came out with a guideline which allowed the return of the exotic product. So we are going to take you through this journey, and I know there will be some controversial topics, and we are going into the past. I think the way we have structured our conversations, I will be moving around the various panels. We will broadly cover the 3 different phases, and I also set the context for that. The first one being, we'll slightly dig into the past. May not really be as comfortable, Anshul is already smiling, but we will do that with the only objective that what are the key learnings? Something that did not work, what are the key learnings, both for the bankers, for the corporates. We'll pick certain learnings from there, and we'll then come to the today's scenario where there are certain existing time frame, existing regulatory frame under which we are looking at this particular product. And given the return of exotic product, how can we as a corporates, how can banks together as an entire ecosystem can actually benefit out of that more for the risk management and maybe some other applications. So that's really the broad theme that I've thought through, and feel free, it's going to be a very free-flowing conversation. So dear panel members, while I know the the topic itself may be a difficult conversation, one thing which I can tell you, Almus Conference is known for the free-flowing conversations. There are no media here. I am not Arnav Goswami. Nation does not want to do anything. It is just this community really wants to learn and take away.
I can endorse that over the years.
All right, great. So let's begin the first round. Really, Anshul, I'll start with you and then come to you, Jay, before I come to the corporates. What exactly happened? I mean, if you were to really look at, and all of us, I guess, were market participants. I mean, I have done the transaction myself in 2007-8. So what was the key things that you would really want to look at it, pick up as a learnings?
Thanks, Maulik ji, for having me over. And I will try to be as honest as I can be.
Thank you. That's what is expected.
So back between 2005 to 10, there were varied exotic products that were sold, barrier options, range accruals, which are leveraged, knock-in, knockouts, TANs. The common theme across all these products were one, highly skewed, payouts uh, huge counterparty risks that it got associated with, excessive leverage, and shallow depth with a very complex math behind it on how it would get valued. So these were the common, and these are the products that got blamed during global crisis when, for the mounting losses. But the risk that got undermined the most in that period was the voluntarily induced risk in the name of innovation, excessive confidence on payout, and most importantly, ignorance. Of course, financial institutions tasted success while selling these products, but that gave excess confidence and became more speculation than hedging, leading to the construed line as mis-selling. And of course, corporates enjoyed the party till it lasted, and when things went the other side, of course, pleaded for ignorance. So this is the long and short of what happened between that period.
But if you were to really look at that scenario, I mean, given that it did not really work the way it should have worked, what are the key learnings that you're picking up?
So, of course, a stronger risk management framework on both sides was a key. So people who would execute the deal, people who would sign the confirmations, and of course, the reporting authorities. All these three, in a lot of those cases, were same. Banks, on their side, of course, the suitability and appropriateness. I think what was on paper and what was on spirit was completely different. And I think we made ourselves more comfortable to put down on paper so that we could execute a certain product. And that was the reality, which of course, when I look back and in all my honesty, now I see, I think we could have done a better job on that. So these are some of them.
So Anshul, you talked about the risk management framework, and let me move on to Jay. Now, the very fact that some risk management practices were compromised or ignored upon. What was the conditions? I mean, if you were to really look at what happened in 2007-8, why there was so much of an euphoria to really take risk? Can you just throw some light on that?
See, in macroeconomics, when we all might have read about Keynesian theory, right? So we have heard a term called animal spirit. So in 2006, 7, 8, those times, so the animal spirit was at its all-time highs. So for any bank, says they are in India, if they find their Western counterparts are taking bonuses worth millions of dollars, right? So you have all the more incentive to sell whatever comes on your way. So what happened in 2008 was, you missold because there was some kind of easy availability of money. There was abundant liquidity. The corporates in India were seeing this for the first time. They did not see this before, right? When a banker comes to you and asks you what amount of money you need. So that was a peak time. And you would have seen in US the kind of subprime thing which were happening, the abundant lending which was happening. So that all resulted, where the mis-selling happened. There was no due diligence done. The corporates, whether they actually were prepared for that risk worthiness or not, that was compromised. And that resulted into the chaos, which we all know about. So in lighter terms, in those era of, chasing the animal spirit, the animal was dead, and you had only the spirit, which haunted the bankers and the RBI for next 3 years.
Yeah, I think you are highlighting a very good point in terms of there was a risk appetite. The business conditions were extremely good, and that allowed a corporate to probably compromise and not even look at the downside of the whole thing. And picking up that point, yes, you want to say something before I actually go to the corporate?
No, I think, I wanted to highlight on the key learnings from there. So next, when we have launched this again, it's very important to understand to whom you are selling it, right? What about the sustainability? Are the corporates who are going to buy it are worth, so those frameworks need to be in place. If that framework is in place, then there are further challenges which may come, which we can discuss going ahead.
Yeah, but suitability and appropriateness was even earlier was there, like Anshul said. Those frameworks were in place. maybe it was not really highlighted the way it has been done now, but those conditions were, or stipulations were anyway there. Still there was definitely a urge to compromise on it. Like you said, animal spirit, a higher risk appetite, because I'm making money, it's okay for me to take a risk, not even look at the downside. And that could be, but that could be on the corporate side. I would be more keen to hear from the bank side. What was it that was probably there for them to really go ahead and be so aggressive? I'm sure there was some element of, grade or whatever could be there.
Just to add, the fact remained that, which I think he pointed out rightly, that there was some initial success. And of course, there was a transition on these businesses at bank level as well as at the corporate level, where suddenly corporates also started eyeing treasury as a function where they can make money, while against the probably the extended version of the basic principle of protecting and being consistent and hedging. I think that kind of got overwhelmed with this whole money making process. And at the same time, banks completely, the kind of targets that were put across for the sales dealers to convert, and this was happening across the industry, so not as if it was restricted to one or two financial institutions.
Pressure to perform.
Pressure to perform. So that's what kind of led to this.
So Manasvi, I know Mahindra, for that matter, Mahindra & Mahindra is extremely conservative corporate, but you were a market participant. I'm sure you have certain experience. You would have heard some stories. You can throw some light on what was it that probably was not really from a corporate side, and what could be the learnings?
Yeah, thanks, Maulik. Both Anshul and Jay have been actually very candid in accepting what were the, if I may call it, the wrongdoings on the part of the bank. But I also feel that corporates also held a responsibility. And while I've worked at both HDFC and Mahindra, which are known to be very conservative and good governance with proper risk management, but both of them also bore the brunt of the last round when this whole story sort of unfolded. And when I think back, if you really look at what the losses were during those times, there were 3-4 key issues which come to mind, because of which the corporates faced all those losses. Most of the losses, were on the borrowing side. So a lot of the borrowings were left actually unhedged. Even when they were hedged, there were maturity mismatches. So if you have borrowed 5-year, but you're doing a 1-year hedge and you're thinking you'll roll it over at a more attractive rate, or you then take a knockout on your hedge. So that actually goes against any risk management principle. So I think a lot of those losses emanated from, this. Secondly, when you think about the past of exotic derivatives, a lot of us, and I would say myself also, thought that the past is the best barometer of the future. So just to give you an example, for example, in dollar yen, it has never gone below 100. So let's take a knockout at 99. And that used to happen in dollar CHF also. So everybody thought, took a lot of comfort in what has happened in the past. So aage nahi hoga. And obviously, when the GFC, global financial crisis came and this whole story unfolded, everybody was caught unawares. Thirdly, I think it was a lot about leverage also. There were a lot of these 1:2 structures, right? So if dollar rupee goes above a certain level, again, people thought that it has never crossed 50 or 49. So, if it goes to 49.5, I will be double hedged, but at 43. So that again goes completely against the concept of risk management. Taking comfort in the past, taking a lot of leverage. And lastly, this was also the era, this was the pre-IFRS era. So in terms of accounting and disclosures, it was a free-for-all accounting, and that was the time when ICAI came back with a guidance, and then obviously subsequently IFRS followed. So accounting was a bit of a free-for-all, and everybody, and also the disclosures, right? So in terms of, and I'm not just saying the disclosures in the annual report, but to the board or the audit committees or the risk committees, there was no framework. There was no, I don't think at that time people really thought about tail risks, that okay, I'm taking a knockout, but if that knockout happens, what is the impact? So I think it was a mix of all these factors, it was just basically a euphoria sort of a moment.
But Tell me, how do you still explain? You talked about dollar yen borrowing. I mean, I can understand for Mahindra, you have Japan business, okay? You can still, play in that currency. Rather, you can actually, how do you explain borrowing in CHF, completely unrelated? I mean, what was that?
In plain and simple words, greed. So if you have a rupee borrowing, how can you convert into yen and CHF and gain some carry? So the carry trade was really big, if you recall, in those days. And everybody thought they could reduce their cost of funds. So, I mean, yeah, that's the answer, short and
Sorry, not just loans, but trade payments as well.
Even
were
trade payments,
hedged.
yes,
Yeah.
yes.
So, I mean, it
Yeah.
wasn't restricted only to loans.
Yeah.
And it, of course, went to a third currency. And there was a process back then, defined by regulator as well on how you could do it. But again, all of that was on paper. And I think lack of disclosures also led to some of the senior folks in the treasuries to kind of go ahead and sign it, seeing, the peer pressure from, other corporate treasuries.
Yeah. So Tanushri, you bring in a lot of international experience. And you have your own experience about the whole 2007-8 and also a great learnings. What's your takeaway on the entire episode?
So Maulik, I'd like to start with a story, right? During 2007-8, I had taken an Indian corporate in London to meet GLG Partners, one of the largest hedge funds in the world. And they'd had a huge loss on derivatives, purely India business. There was absolutely no foreign currency exposure they had. And the GLG Partners senior person sitting there asked the CEO who was there, how do you explain these derivative losses that have happened? And the CEO's face fell, okay? And he said, look, the bankers missold the product to us, and we didn't understand the risks. And then he suddenly became defensive and he said, and we are going to sue the bank now, right? So I came back to the office and, I at that point in time was just setting up the partnership with Kotak Mahindra. And again, Kotak's a very conservative house and a lot of respect for them, right? And started to understand what was happening. And just before I had joined KBC, I was with Merrill Lynch. So just to give a perspective, right? While I think Jay, Anshul, Manaswini have been very candid and said banks missold, I think there's an element to understand over here that the entire MNC banks who were there in the country had been facing challenges in making money in Europe at that, from 2006 onwards. India had been a hot market and they'd been selling these derivative products here without acknowledging the fact that they didn't have experts on the ground, right? So you don't train your people here, they are not aware, but now you've given them targets to sell. I think it's absolute gross negligence. I think the second aspect that happened was, in London as a banker, I had to pass what was then the Financial Services Authority's exam. And every 3 years, I had to renew it, which meant that guidelines or no guidelines, I had a fiduciary duty to my profession to be able to sell what I understood, what the client wanted, and what the client understood. Now, such a framework even today doesn't exist in India. So to say that the regulator has a framework and you have to follow it, and there is a target that you've been given without being explained to what you are selling, I think it's unfair, right? So I think just having that FSA license and that responsibility made it extremely important for us to take accountability of what we were doing, right? I think similarly on the corporate side, I think Manaswini said it very, very well, right? It was greed. But I think if you look at India even today, the relationship between a banker and a CFO or a banker and a treasurer is that of trust, right? And I think when you had a banker who'd been with you through the tough times when liquidity was not available and was coming and advising you today saying, nahi hoga, and was showing you models, but those models were not completely stitched up, right? Because they were unaware. I think you just believed them. So I think the big learning for me is we have to have the financial services players in India take accountability, it can't just be the regulator, right? The second thing is, I think within the corporate world as well as CFOs, we need to hold off and say, am I looking at, what is the risk reward that I'm looking at? For this particular reward, is the risk non-commensurate? And if it is non-commensurate, then as a CFO, you stand up to the audit committee and to the stakeholder and say, this is not my recommendation. Then if you're overruled,
So
then
I'll
you're
pick this
overruled.
point and go back to the past. What was exactly, so when you say 2007 and 8, was it not already being practiced or it was all compromised?
It was not being practiced. See, Maulik, I think we need to take back and say derivatives in India is not something which is, and I say this with all humility and all respect to all market participants, derivatives in India is even not understood today. Because we are not a country that, we don't understand the convertible bond product, right? Which is a simple bonds plus warrants. We're the only economy in this whole world that does not use that product to raise money for the small and the mid cap, right? And now suddenly we're talking about exotics. The awareness, education was not there. So it's not that framework was not there or regulations were not there, right? That's why I'm saying if I take an outside-in perspective, I could see, I was sitting in the offices of these banks and seeing how they were keen to expand business in India, and banks have misused the FCCB buyback opportunity in a huge way, right? When RBI came up with a framework saying, these are the caps, you can't buy back beyond that point. Overseas banks have misused that to make money, right? So banks wanted to make money, they didn't have an opportunity, so they pushed. You didn't have the FSA sort of a regulator over here who made the individual accountable. The corporates trusted the banks. It just became a vicious cycle.
Tell me, from your experience, was it only an India-centric phenomena?
So, Maulik, I have to admit, so I have worked very closely in that period with Japan, Taiwan, Korea, China, India, entire Western Europe. Okay? And yes, it was only India. I mean, Taiwanese understanding of derivatives is far more nuanced than ours is. Their market is much deeper. Koreans understand it. Japanese, along with the French, are up there, right? And the Americans. I think, aaj bhi dekh lo. Let's forget that era, right? Just look at the bonds plus warrants and how they are helping infrastructure, education, healthcare, raise money globally, and where are we today in that journey?
So I think you are highlighting some of the key points in terms of being even readiness today. And that's a very valid point. I want to come to that. Yes, Anshul, you wanted to say.
No, so I just wanted to extend that Tanushri was just trying to mention. The fact is that a lot of these products did transition from these European countries. Secondly, irrespective of the licenses that some of the matured market bankers had, we saw some of the largest scams happening in form of LIBOR and many others. So if license was the only way to kind of have that stamp that you are eligible to sell, then world wouldn't have seen the largest transition in form of LIBOR to SOFR and so on, right? So it wasn't as if people weren't educated. Of course, the maturity levels of markets were different, and I agree. But the fact is that this problem didn't start in India. Actually, the first structures that started going bad were actually in US and Europe. And then, of course, with a lag, that came over to India. And a lot of these, started with rates market and then eventually moved to currency. That's when India was hit more versus some of the matured markets. But the fact is that, yes, there was underinvestment in people. Was it optimal? No, 100%. Was it optimal on the corporate side? For sure, no. But were people completely unaware of what they were selling? No, they were aware. Okay. It, of course, as I said at the start, that it did involve complex math, and banks did fair bit of investment in, kind of resourcing, the kind of hiring that we do, And unfortunately, with the life cycle of this product, we had to lose a lot of our colleagues. So it's not that as if there was completely no preparation to kind of do it, but was it optimal? No.
So I think it's very important to know from where we are coming today to even look at where we are moving ahead. And I think one of the important point even Anshul that you talked about, and to some extent Tanushri that you mentioned, is about the readiness. Now readiness comes from the entire ecosystem preparation. One of the things that happened, and I know for a fact because I was talking to a friend from a foreign bank, there was we actually exported the intellectual capital. A lot of bank invested into exotic derivative products and the related entire mathematical model. And suddenly in 2011, when we had the ban on those products, we had no opportunity for those talents. If you were to really look at that and look at current scenario, where while there is a regulatory framework, are we really ready? I mean, do we really have those talents as a banker, as a corporates, where we are?
So I think we are much better prepared versus last time. There was a huge learning curve for everybody, including banks and corporates. So the whole framework that has been put across now, and of course it's little more restricted with the number of corporates that are participating right now. But the ones that are far more prepared in terms of the human resource that they have, that they manage these products. And the banks,
the banks or the corporates?
Corporates as well as banks. And banks, of course, have, started preparing. We've, of course, put across smaller teams because the product hasn't kicked off the way we all envisaged. So it's an ongoing investment, and it's not like a one-time thing that you hire one person with a skill set and then do away with it, right? It's a continuous process, and it's very important, which is the point that even Manaswini mentioned, that it's not just one or two people, because the client engagement at the bank level happens at multiple forums, and it is important. And the point which Tanushri mentioned about the trust, and that's very important. And I think that's the learning for bankers. If there is so much trust involved, and we are in the business of trust, we have to be more responsible. And the only way we can be responsible is that be more transparent, be more forthcoming, give everything which is a probable scenario, and then probably let products kind of flow into the system.
So I have a different view on your comment about the corporates, and I'm going to check that with Manaswini. My view on the corporate is neither they are ready nor they are interested in being ready.
Yeah, so in corporates, actually, we have a very unique challenge. When you go to your board and the senior management, derivatives is like, it's a weapon of mass destruction. Yeah. And if you say exotic derivative, you're thrown out of the room. You're like, get lost. Yeah. But when you talk about the treasury teams, especially...
And think about a corporate, M&M is talking. Yeah. I mean, I'm leaving aside medium size and the small corporates who do not even have,
Absolutely. But when you talk about that, the new talent which has come, and some of them who have perhaps joined the workforce in the last 10, 11 years, they have no scars of the past, right? And this is the first time actually, so for them it's like a new toy. Suddenly there is a new product and they think it's a very cool thing, and they can now, be at par with their peers in Wall Street and London. So, so those are the two ends of the spectrum, frankly, as corporates we are dealing with. As a treasurer, I'm more concerned. I think, talent can be groomed from a treasury perspective because we have bright minds. I mean, I don't think anybody in this room really doubts about the competency of Indians. What I'm more concerned about is the price discovery process, because forwards, all said and done, have become a very vanilla product. And if people understand, when you go to options and then exotic options, how that price discovery will happen, how will we ensure transparency of that pricing, and whether there has been no any other issue around it, that is what I'm more concerned about.
Yeah, I think that's again another point, because especially when it comes to price discovery, today you have a forum market, but at the same time a very liquid exchange market. When it comes to options, you're still relying on OTC market, and exotic derivatives, no way. I mean, there's no other choice where you have to, really have that competitive pricing. Tanushri, your take on really a corporate's readiness for using these products.
Maulik, I think we need to look at, I don't think there is one answer whether corporates are ready or not. I think we still need to acknowledge that for us, we are still in a world where there is a set of corporates who get the talent, who have the ability, and who have the balance sheet strength. Then when you come to the mid caps and the small caps, they don't have the balance sheet strength, they have the requirement of the funds, and they don't even get the talent which is required, right? Now the talent piece, it can be supplemented with experts such as yourselves, right? Because you can come and guide, you can come and educate. But I think the onus still lies internally. And I think there, the memories of the promoters and the boards is still not able to get over what happened in 2007 and 8, right? So I think there is a little bit of hesitation. My experience as a CFO, and this is where I beg to differ with my, with Anshul and other bankers in this room, I don't think the bankers have still become responsible enough, right? Very recently.
That's a big statement, by the way.
Sorry?
That's a big statement.
No, I'm going to tell you, and I'm going to give you an example to prove this, right? Whatever I'm going to say is public information, so I'm not disclosing anything which is non-public. Lakshmi Organic is a net importer. Okay, we recently drew down rupee loan at a fantastically attractive rate. And 2 banks actually came to us in this absolute desperate push mode saying, isko dollar mein swap kar lo. And I said, why would I do that? Explain this to me, right? And the way I was explain things was where they didn't even have numbers on an Excel spreadsheet. So I had to actually tell those 2 gentlemen, mid-level, not very junior, that go back and put numbers on a spreadsheet. And just don't put numbers of the transaction. Also put accounting numbers on the spreadsheet and then come back to me. They've not come back to me in the last 3 months. So that probably shows where we are, right? So if that's the market, how do you expect a corporate to get ready? So I think there is a set of corporates who are ready, but by and large, if we forget the larger ones who have all the means and the talent at their disposal, I think this is still a little bit of a journey that we need to travel.
Fair point. Joy, I want to come to you on your comment about certain conditions that existed in 2007-8. Now, as you reflect back, see, one is of course the real economy is doing pretty well. Animal spirit, as we talked about, is slowly gaining momentum. If you were to really look at the maturity curve on specifically the usage of these products, how do you assess? Where do you see today's conditions vis-a-vis what it was earlier?
Well, see, I see it from from 2 perspectives. First is the corporates which were there in 2008 and now. So I believe there is a lot which has been covered in terms of learning curve. Our corporates today are more exposed to international trades. They understand the dynamics of how these exotic derivatives and other financial instruments work. So there, definitely we have moved ahead. In terms of our readiness, see, when this episode happened in 2011 when RBI actually banned it, so till then for next 10 years, our corporates have worked on kind of forwards, right, which is a vanilla product. So the whole ecosystem here in India is designed, the understanding of the product has been more on the practical side on how you use forwards. Now if you bring exotics here, there's no dearth of talent, right? But the knowledge is theoretical. They haven't, created a position and exited from them. So the challenge will come in terms of execution. Again, even if they understand something a little bit, or you have somebody who has an international exposure, he starts working for a corporate in India, the liquidity becomes a challenge, which is not there in international markets or in international companies. So there, there are 2 things. In terms of manpower readiness, I think we are at a very nascent stage as of now.
Yeah, got it. And I think even in terms of the liquidity that you mentioned, I think overall the total option market itself is hardly about what, 4-5%? Less than that. And within that, exotic products I think you will probably count few deals.
Zilch.
Yeah, so I think that issue still remains. So even if, let's say, we were to talk about being ready for the exotic products, the question really is probably, in terms of the liquidity or the ability to easily enter and exit continues to be a challenge. I want to go to them for the next set of questions, but as I do that, we will still have time for the Q&A. So given the topic, which is very, very interesting, I would want definitely few questions. I mean, you will have the opportunity. You can be ready with your questions. I'll just take them with the last round of my questions and then over to the entire audience. I want to talk about the existing guidelines which came out. Okay, and broadly, if we were to look at it, there are two critical elements. One is it has defined the retail and the non-retail users. And the distinction is 500 CR. And the second, which is more for a bank, that you cannot sell a product which eventually results into the more losses than had the corporates being unhedged. Now, these are the two driving criteria for the guidelines. Now, I really want a reflection on the first one because I'm not too sure. 500 CR, I mean, on one hand, we talk about suitability and appropriateness and 500 numbers. I mean, how do you, and we have, by the way, a formal regulator in the room, so feel free to share your views on the guideline.
No, actually, I would appreciate the regulator that this time around, the whole framework that they have put across is fairly clear for bankers as well as for corporates. The last time around, the other learning was that some of the areas that were there with product-specific criteria were little more left open for interpretation, and each company and each bank interpreted in their own way, and that led to a lot of leverage structures where the payouts were quite skewed. The risk-reward ratios were not favorable. So this time around, one, of course, the distinction is very clear. What it also kind of signals is the ability to invest to get ready to handle these products, right? So 500, while is just a number, but if banks on their side put across a proper method to the madness on how we do our suitability, how we talk to our client and explain the product, not just on the paper and the term sheet that we put across, the trust factor that was spoken about. If all of that is a deeper engagement, not just at the dealer to dealer level, but of course at the senior level as well, makes a lot of difference. So some of this, in my view, is very important as we start picking up some of these products from here on before we start selling honestly.
Okay, Manaswini, I mean, 500 CR still is a puzzle for me. I mean, what is the sanctity? I can have a corporate beyond 500 CR but no risk management skill set, and a below 500 CR which can either have in-source or outsource to a firm like us. I mean, we serve a lot of corporates below 500 CR as well. So how do you really distinguish?
Yeah, so Maulik, I don't think, when RBI came out with a 500 CR, it's like a sacrosanct limit. I think they wanted to first, because they were coming out after, 11 years, 10 years. So they wanted to first, I think they want to first see how is the adoption. And typically, before, the smaller, so-called smaller units start looking at it, in my mind, once the market develops and there is a proper use case which comes, because so far, at least from what I know, exotic derivatives are more discussionary than executionary. Like, I don't think many executions have happened. Sorry, not many executions, many trades have happened. I hope there are no executions in the process. So I don't think that's a sacrosanct limit, but I hear your point, and perhaps linking it to the percentage of how much of your revenue is linked to Forex could be another more mature way of looking at, these thresholds. So.
Okay. Tanushi, independent of forget 500 or those, but you have gone through the guidelines. I mean, your reflections, or from a different standpoint, what probably some of the international practices could be in place, which can in turn either be a part of regulatory framework or part of the operative practice. I mean, your comments.
So I think on the 500 crores, right, one thought that immediately comes to mind is what happens if a company of 1,000 crores net worth has a subsidiary, wholly owned subsidiary, which is a 300 crore net worth. And if this subsidiary can actually have a huge financial benefit by getting into some of the derivative transactions, why is that subsidiary being left out, right? So I think it's unfair. I think in India, the RBI, I don't envy their position. They actually have this very tough job of putting in safeguards, right? Which, and everybody just, anything goes wrong, they'll say RBI ka regulation nahi tha, right? But when those tough regulations actually save us, they don't get any credit for it. But I think we can't paint the entire industry with the same brush. And that's why I'm saying, what about a 300 crore sub that can't use this, but has the wherewithal, the talent, the risk management framework, and can financially benefit, right? So I think that's there. The second point that keeps coming back to me is, and that's on the second point that you made, excessive losses if the company was unhedged versus hedged. I could be just using simple forwards to hedge my export exposure. The currency moves and I'll make a loss. Was I better off hedging or not hedging, right? I think there's a free market for a reason. And I think at some point in time, India needs to start becoming more brave and mature and saying that, let's become a little more free. Could it be the top 1,000 listed companies? Because they anyways have so many compliances, regulations, etc. to do. Can they be a participant of the free market without any of these guidelines? I don't know. But I think that's my view.
So in a way, there is some beginning. Maybe over a period of time, there could be some other yardstick to actually tweak some of those guidelines. Basis the use case, as Manaswini said.
Just to add to her point.
Okay, how much time do we have? I don't have time. Okay, so.
Yeah, derivatives is a need. If you are in international business, if you have to hedge, it's a need. See, now, what is the problem going on in the global markets is that the hedges have become an issue. The kind of movements, kind of the market it moved, it is totally different. Even for India, rupee depreciated heavily against dollar, 3-4 months, 2 months come back. It appreciated against other currencies. It never happened in our history, So, it's a need, derivatives is need. I think why RBI opened it up, as we said, bit bold, bit aggressive, bit freedom, which we are all seeking. That is why they have done it. Definitely there is nothing 2011 is forgotten according to me. So what the corporates should have is, yeah. So execution, risk management and value addition and how it is measured and managed, that is critical. Over to sir.
No, first of all, I think, give me a minute. When the first issue happened, I was very much in Reserve Bank. I don't think there was any doubt about what the banks could do and cannot do. What they did was different. It was in my own hand that we wrote that circular which said that you cannot offer a derivative which takes him to a position worse than unhedged, which means not the kind of thing which Tanu is saying, but which means that you cannot offer a leverage product. That's as simple as that. If his loss is on account, it can be only that X. It cannot be 2X or 3X. That cannot be done. That was broken. Now, when the mark-to-market was positive, no corporate complained. So to the question that they asked the question of how did you do it, nobody complained. But the thing which hit Reserve Bank of India at that point of time, I was very much in that meeting. When we asked some of these banks, many of them foreign banks, how did you price the product? No answer. We got this price from London, we have offered. But what are the components which have gone into the pricing? No answer. Right? Now, what is different today? I think in the today's guidelines, it is clear that you will have to tell them the basis of pricing, how mark-to-market is going to move, and then the corporates cannot say that I didn't understand what was happening. So they have made that that much clearer. Why 500 and why not something? Reserve Bank always believes in doing something, it may be less than ideal, but which is more quantitative rather than an assessment or a qualitative. Somebody will have to assess about your risk management. That goes into sort of somebody interpreting it. They would like to have more quantitative parameters, which are easier to monitor. And the question is, at some stage we said a bank which has 9% capital adequacy or 10% capital adequacy alone can offer derivatives. Why? Not because of their risk management abilities, because of their ability to sustain the risk and cushion the risk in their balance sheet. I thought these things must be made clear from the regulator's point of view.
I think, thank you so much, sir. Just one built upon what you just said, and one of the guidelines that was critical is, I think it states very clearly that only when banks are able to value the product, that's where the pricing, that is critical. Yeah, yes. Absolutely, absolutely. I think there are also cases of banks creating an intermediary banks to sell the product. So while there was a relationship between a
Again, the answer we got was we have done a back-to-back hedging. And I myself told them there is nothing in practice which is back-to-back. Only you can stand back-to-back, not the day.
Okay, questions from the, yes.
Yeah, good afternoon, everybody. I come from a banking background. Initially, I was with SBI, and from there, in the last part of my, banking job, I was doing this marketing of, derivative products. I have some few observations to make, and that is what I want to do. See, so what was offered initially was exotics in all other currencies, but not in USD INR. The products that were sold as exotics in USD INR were nothing but the leveraged products. They were not truly the exotic products. We badly need exotic products to hedge our risk. So this is one differentiation that I want to make. My suggestion for now, because I have lesser time I have written so many things that I can't speak out everything. What I suggest is devise a course and allow derivatives only to those who pass those courses. This is one thing that the regulators can do, so that you know the suitability much more than anything else. And I think this thing, the liquidity has to be introduced. So some of the banks will have to come and start writing, taking those risks on their books. Otherwise, the liquidity is not there. Even after the guidelines, the liquidity is missing. So maybe they will have, some of the banks will have to be nudged to start offering those products, run the books, and then don't do it back to back. As sir said, back to back means suitability is gone. So if you do it, after running your books, the products will automatically be suitable. So these are some of the things that I thought I would just add.
Thank you so much.
Just to your point on liquidity, you're right. Banks, and now we've got PDs also who can participate. So put together, I think the volumes slowly and steadily, once they pick up, the transparency on pricing and all will kind of get addressed. But it's a journey that you have to go through.
Yes.
Any other questions from the audience?
So, Maulik,
yes,
I just wanted to add something which I think Tanushri also touched upon is, say, take a very basic example that in capital markets, right? If you have a dealer who is supposed to execute trade on client's behalf, he's supposed to get certified. There is NISM exam which he needs to pass, then only he is eligible to, punch the orders. And when we're talking about launching of, exotic derivatives, and we trying to aim at 5 trillion economy where a lot of corporates would get this exposure of, this exotic derivatives product, why can't we have certain kind of certifications for the bank employees or whoever wants to sell this product?
Yeah, I
So
think
this
it's
is
a
just
great, I
one
think
night of
Tanushri, something that you were also talking in our side conversations about the courses that we need to have.
So, I think, like I said, FSA exam that is there, right? It's an educational program, and every banker needs to refresh it. It teaches you what these products are. It gives you that accountability. In the past, I know BSc has run programs to educate people on how to invest, so that when a retail investor is investing, they understand the risks, right? And I think those are the kind of courses that we really need. And once you have all the foreign banks, to Mr. P's point, right? All the foreign banks who've actually got these experts sitting outside, why can't they conduct these courses and educate everybody? And those who've passed these courses can then lead the education and awareness of.
Sure.
In fact, just on the point of need, today banks are allowed to lend through Gift City to the Indian MNCs, if I have to say so, and much bigger set. So if these Indian MNCs, global MNCs, practically today, large institution, if they want to do some sort of hedge on their loans or, so that enabler has just come in about 10 days back from the regulator. So I think we've seen a lot of push.
Yeah.
Got it.
Done. We're all done.
It's enabler.
So quickly, just to sum up, we had almost 35 minutes of conversations. Quickly sum up, regulator has enabled, put the framework in place. Whether the corporates are ready or not, we will see over a period of time. But key here is, I think there is a willingness to look at it. Infrastructure needs to be in place, research, educational piece, overall opportunity, especially the Gift City. I rather wanted to talk more on it. We are talking about, building kind of a solid structure at Gift City. Maybe this is one more opportunity. There's a huge opportunity, a risk management need, sell side, buy side. I think it's all about which wheel moves faster. And with that in place, thank you very much. We are just rushing it. And thank you so much for your patience here.
Thank you so much to all the panelists. I'd like to call on stage Mr. Mahindra Patwari from Nagrika Exports to please come up on stage and present the memento to all our lovely panelists. A huge round of applause for Mr. Mahindra Patwari. Thank you so much, everyone. A huge round of applause for all our panelists here. And now for a special address, Empowerment of Financial Markets, Bharat. I'd like to call on stage Mr. Sameer Shah. Mr. Sameer Shah joined Dwara Holdings in February 2018 as Executive Vice Chair to take on responsibility for the strategic direction of the Dwara's trust mission of financial inclusion and portfolio management of group of companies. He has over 2 decades of experience in building institutions and market infrastructure. Prior to joining Dwara Holdings, he was the Managing Director and CEO of NCDEX, India's largest agri-focused commodities exchange. During his tenure, the exchange had transformational impact on India's agri-economy through various technology and digital initiatives. Prior to this, he worked at global information company Thomson Reuters for 17 years, where he held various capacities. Mr. Sameer began his career as an investment banker in Mumbai, helping companies unlock value through public offerings and buyout deals. Ladies and gentlemen, please welcome Mr. Sameer Shah.
Good afternoon, everyone. I'll just wait for my presentation to be up. Okay. Good afternoon, everyone. My name is Sameer Shah. It's a pleasure to be back associated with this community, and I'd like to thank Maulik and Bijur for giving me this opportunity. I used to be a very much integral part of this community many years ago, up until almost 2009, I would say, when I was on the sort of the technology supply side to all the participants who are seated in this room. So I've seen a lot of these developments up until that point in time. And at that point in time, in 2009, approximately 2011, I took a slight shift in my career to start to work on, trying to put all the learnings that I had about financial markets, OTC markets, exchange-traded markets, risk management, into trying to make them work at the last mile, which is very challenging and very interesting and very exciting. So I'm going to basically, and that's basically what I've been doing over the last, since 2011, trying to make markets work in my own small way at the last mile. I had the opportunity at NCDX when I was there, which is India's largest agri exchange, to launch an exchange-traded options product for agricultural commodities. And obviously, agricultural commodities are an extremely sensitive part of India's economy because they touch farmers, they touch consumers, when food prices go up, and so on and so forth. So it's a political hot potato. But to be involved with SEBI to design a options product, an exchange-traded options product for agricultural commodities was actually quite a phenomenal experience. And it's still in early days, and like many things in India, once you get started, you iterate over a period of time, and over a period of time, these markets become extremely strong. I also had the opportunity at NCDX to launch India's first dematerialized warehouse receipt as a product. And for those of you who might remember, we had a scam in India which involved warehouse receipts, where goods didn't exist in warehouses, but warehouse receipts were offered and financed and refinanced. And unfortunately, in India, we often, a spate of regulations do come on the back of scams. That's how we learn, and that's how we move forward. So that's been a real passion, and in the last 5 years, I've been sort of taking that journey forward to go towards, bringing some of those really sort of core institutional processes, products, mechanisms to the last mile, where consumers in India are still deprived of accessing just basic services. So I'll start my, have 15-20 minutes to cover. I'll start by giving a quick sort of run through my own experience. A lot of this data may not be very unfamiliar to all of you, but I'll just, just as a headline, start with some of the backdrop. India has come a long way as far as financial inclusion is concerned, but it is like a glass half full, depending on how you look at it, glass half empty, glass half full. We've come a long way. We've got still a very long way to go as far as making financial markets work for the last mile. So we've had, through the Jan Dhan Yojana, which the government has launched for a long time now, we've had a very strong penetration of bank accounts in India. But even after this extremely aggressive, ambitious rollout of the bank account program in India, the usage of bank accounts is still extremely low. We have a fairly significant inactive bank accounts in India. So there is a very large, so we may sit in this room and talk about exotic derivatives on one side, but the most basic of basic financial product that is in the country today remains unused by a variety of population. So I think the challenge on us is to use our institutional memory, our intellectual capital, and our regulatory processes to really sort of start to plug away at these problems at a much more ambitious level, at a much more faster pace. Savings is another sort of horizon, another battle that is still not solved, not won. We have less than 25% of Indians even today save through formal channels. So while bank account as the first building block continues to be a challenge, as you go up the building blocks in the banking system, savings continues to be a challenge. I think have made a huge amount of inroads over the last 10 to 15 years on two parts of financial inclusion. One is credit, and second is payments. UPI, of course, has brought about a transformational effect on the payments ecosystem, and credit through microfinance, small finance banks, the regulatory guidelines that have come over the last so many years have increased penetration of credit. But credit can't solve problems in financial inclusion on its own. In fact, if you use credit as a tool to solve every problem of financial inclusion, you will have an over-leveraged society. And we've seen that time and again. The Andhra crisis was an example of how excessive reliance on credit to solve financial inclusion can create a huge problem. We recently had the Assam crisis as well, a couple of years ago. So we know that on its own, credit can't solve the problem. On its own, payments can't solve the problem. You've got to focus on, it is a four-legged stool, not a tripod. It's a four-legged stool, which is credit, payments, insurance, and savings. And I clubbed sort of pension with insurance sort of as one bucket. So the two missing pieces need to be looked at are savings and insurance plus pension. So these are sort of unsolved problems in the financial markets today, and we need to solve them, while even the first two, which is payments, accounts, still is a glass half full. The other horizon that continues to remain unsolved is the gender gap in financial inclusion, which is a very, very, very big problem, and that needs to be also under a significant amount of focus. Digital payments, we've talked about the huge success of UPI. We still have a very, very big challenge ahead of us and an opportunity. I like to look at it as an opportunity, which is to try and take our digital payments infrastructure to the last mile. Very exciting announcement over the last 10 days or so, where the pilots for e-Rupee, the central bank CBDC for retail, has now been launched and started pilot work within 4 banks. So with a combination of UPI, e-Rupee, I think we are a country that's really making leaps and bounds in the digital payment infrastructure. But I think the real focus has got to be to take digital payments to the section of society that doesn't have access to digital payments today. Otherwise, what is happening is that the population that uses digital payments, between 25 to 35% of the population which uses UPI today, is using it more and more. The remaining 65-70% is still excluded, vastly excluded from this infrastructure. And I think the priority needs to be to create institutions, to create innovation in bringing digital payments to this community. Debt and sort of assets, Indian households primarily rely on physical assets still. It has changed. However, even today, the proportion of financial assets versus physical assets in a typical Indian household continues to be very skewed towards physical assets. So for all of us in this room today, the opportunity is to really enlarge, be it broking, be it capital markets products, be it banking products. It's to bring this to an average normal Indian household, which is still heavily invested in physical assets. And it is only when that shift of physical assets to financial assets starts to get a significant amount of momentum, is when the real economy at a grassroots level will start to move, and the ship will start to move in a very significant manner. I'm going to skip some of these, but just to let you know that the fact that financial inclusion has got a long way to go is not just a thing about numbers. It's not just about exclusion of a certain percentage of population. It's also mental. It's also perceptions. A large portion of India still does not feel, the underlying theme from this slide is that a large portion of India still doesn't feel safe and secure for being able to manage their household finances in the moment of crisis. So if you leave the actual metrics aside, but just look at mental sort of perceptions of a typical Indian household, you will find that a normal Indian household does not feel that they have the safety net to deal with financial challenges. So what I'm going to spend for the next 10 minutes or so, 15 minutes or so, is I've talked about where how far we have come. We have come a long way. We have still an extremely, daunting and ambitious program and roadmap ahead of us in terms of making markets work, making banking work, making capital markets work at the last mile. So what might some of these examples be? right? I mean, I'm just going to sort of paint some of these. Many of us may be familiar, but I'm just going to sort of piece it together to give a sense for what might be some of the solutions and some of the design challenges, some of the infrastructure challenges that we should start to think about over the next 2 to 3 years to really make it work at the last mile. RBI has basically been talking about cash in, cash out points, CICO, cash in, cash out points at the last mile. RBI has been talking about having a certain sort of, for every 5 to 7 kilometer distance, there must be a cash in, cash out point. We talk about fintechs. And we've talked about the explosion in fintechs, and we've talked about, there has been a recent game-changing guideline from the Reserve Bank of India in October, which is digital lending guidelines. A version 1 of a guideline for the first time, where the central bank has come out with a set of rules, guidelines to play, where fintechs can start to sort of operate in a more structured framework. Those guidelines obviously have a long way to go, and I'm sure, like many things in India, they will, over a period of time, become better and better and better. But the opportunity really is to take fintech to rural. That's really the opportunity. Rural India today is an aspirational household. It's an ambitious household. It is a lot more financially able as compared to 10 years ago. Agricultural incomes, despite the crisis, have actually made rural India a lot more, I wouldn't say prosperous, but a lot more capital in their hands. The balance sheets of rural households are in much better position as compared to 10 years ago. So this is the time where the combination of UPI, technology, the aspirations of rural households and their more capable balance sheets today means that there is an opportunity for fintechs to start to take their business models to go to rural. And this is an example of a lady who's basically experienced, she is in charge of a cash in, cash out agency in deep Tamil Nadu. And she has gone from being perceived as a simple woman running a shop to a banker in her village. Her profile and her reputation and her brand in that village has gone up significantly ever since she started to offer cash in, cash out services through a BC outlet in a village. We have 6 lakh villages in the country. Can we get a BC point at each of those villages in the country? In the country, that is really the the transformative effect of finance that we should be able to. We should sort of think about bringing and empower people like her to become sort of bankers to that village and bring banking services at the doorstep of a village. That's when real transformation will happen in real Bharat. That's the theme of my address, and a large part of this conference about sustainability and stability in the financial system will come when financial services are much more broad-based from a consumption perspective. Credit scores for new to credit customers. Even today, so this is an example of a farmer in Odisha. And this farmer has been now taking small credit. He's a small and marginal farmer, taking credit which is now being designed using artificial intelligence and remote sensing. A new surrogate credit score has been built that allows this thin file, new to credit customer who doesn't have a bureau record. And hence, most banks, NBFCs, small finance banks will be typically reluctant to offer credit to this customer because there is no bureau record for this customer. Can now start to access and avail credit through surrogate credit scores that are using a combination of credit, using a combination of technology, which is satellite images, using combination of machine learning to build surrogate credit scores that are realistic, not based on some black box 200 parameters that go into an algorithm, but real farm level credit scores that can be used by banks to now start lend to these farmers. Our experience has been to work with small farmers is that 70% of the farmers that we've worked with today, even today, are new to credit. Right? So we talk about excessive credit on one place. In some cases, we talk about 70% of small and marginal farmers in the country. And if you go to tenant farmers, the ratio is even higher, because a typical KCC product, which is the flagship product of banks in India, still requires a land holding farmer to be eligible for KCC. So the tenant farmer population is still significantly excluded. So how can we all put our own sort of intellectual firepower together to bring about access to credit to these marginalized communities in a much more significant way to take advantage of tech and some of the sort of infrastructure through UPI and so on and so forth that is getting built very excitingly in the country. And what we are seeing, this just the graph in the earlier slide which shows delinquency. Contrary to public understanding, the delinquency ratio for this cohort of farmers, small farmers that we saw was less than 1%. This is a very exciting development. If a small farmer that is 70% new to credit can demonstrate less than 1% delinquency, it is an extremely attractive customer segment to pursue for any participant in financial markets. This is savings. This is a product which is, in my opinion, gold as an asset class is a super asset class. We have superfoods that we talk about. I want to start to talk about gold as a super asset class, and I know that classical economists and regulators have mixed feelings about gold as an asset class, whether it should be encouraged given our dependence on imports and so on and so forth. But if you look at a low-income household in the country, gold is a super asset class for this low-income household. And the supply side of gold is extremely broken. So the need for that household in the way they use gold for managing their household emergencies, for asset creation, for liquidity purposes as a social status symbol is incredible. It outweighs, it outclasses a bank deposit in the kind of liquidity it has, in the kind of flexibility it has, but yet the supply side is still dependent on pawnbrokers. The regulator perception, the economist perception of gold is still something that we shouldn't be encouraging. It is still perceived as a passive, asset class and should not be something that. But if you look at the consumer is an extremely this consumer is an extremely savvy consumer with gold as an asset class. So I would like us to reimagine whether there is a need to create a gold bank or gold fintechs or create products and services. Recently, SEBI has launched a very exciting product which is called as the electronic gold receipts. I'm personally very excited about that product because I think, and it has a low denomination of 1 gram, there could be innovation that can bring that denomination down even to below 1 gram. And I do think that it has the opportunity to convert gold and rewire the supply chain of gold, change the perception of gold amongst policymakers and regulators, and to give a product that consumers really like, understand, can use without sort of fear of misselling and so on and so forth, because a lady of a rural household today understands gold like nobody else. And this is an asset class that she feels comfortable with. So I'm just trying to throw up some questions and some possibilities for the future in terms of making markets better work for Bharat. Rural insurance. Insurance is, if you look at cattle insurance, there are 400 million cattle in the country. Less than 4% of cattle are insured. 1 out of every 3 rural households has backyard cattle in their house. Between 1 to 3 cows, some buffaloes, some chicken, etc., etc. It is like a rural ATM. Breeding cattle at home is like an anytime money for a rural household. Yet, insurance penetration is very, very poor. If insurance penetration is poor, credit penetration automatically is poor, because if the cattle is uninsured, the banker is obviously going to be very reluctant to lend to a farmer whose cattle is uninsured. So it has a knock-on effect. So under insurance is under credit penetration and so on and so forth. But now you have good technology that can allow us to take insurance to rural India, to have cattle insurance that is designed. So there is a company that I'm associated with which has created an Aadhaar equivalent for cattle. The nose of the cow is like the fingerprint of human beings. Which means that it is a unique identity for the cow. So using AI, you can actually create a Pashu Aadhaar, and that unlocks suddenly a huge population of cattle to create insurance. And if you can insure 100% of cattle in India, you can then offer credit to 100% of small and marginal cattle farmers in the country. Again, just small examples, but huge numbers that can be really empowered to enter the mainstream of financial markets and banking industry through just being very, very commercially smart. None of this is social service. These are all good customers. Less than 1% delinquency could give very decent yield. And just if we can be a bit more imaginative in our product design suitability, we can take these markets to this customer segment. Yes, I'm about to wrap up. This is going back to the first point I made, which is revisiting the account experience to customers. We think we have solved the problem of a bank account to customers. We haven't. Even today, when I talk to even urban customers, you walk into a Uber enrollment center where a young driver wanting to be a part of Uber platform walks into an Uber enrollment center. 6 out of 10 Uber, aspirational Uber drivers will get turned away by an Uber enrollment center because they will not have a functional bank account at the time of enrollment. And Uber will make payments only into the bank account of this driver. This is urban India. This is not even rural India. 6 out of 10 Uber partners don't have a functioning bank account, right? So we haven't solved the problem of a bank account. We need to think about solving the problem of a bank account much more aggressively. Great moves have been made through setting up of payment banks. It's a great move by having a differentiated banking architecture in the form of payment banks. They are beginning to do well. We need to continue that path of, even staying focused on solving basic problems of even making a bank account accessible, usable, functioning to the consumers of Bharat. Evidence, this is a very famous economist, ex-Yale, Rohini Pandey. She's spent a lifetime in studying financial inclusion around the world and in India. And she's proven, so this is the prize. The prize is that if we focus on making financial markets work for Bharat, we can actually directly impact poverty and remove eliminate poverty in the country. So it is not just about, as I keep saying, this is not just a social good. It is obviously a social good and a national imperative, but it makes tremendous commercial sense and from an economic perspective has the tremendous empowering ability to remove and eliminate poverty from the country. So I'll end there with my again, the United Nations Social Development, Sustainability Development Goals also put a lot of emphasis on financial inclusion. Out of the 19 or 20 SDG goals, anyway, the slide's not coming up, but out of the 19 or 20 SDG goals, about 13 SDG goals appeal directly to financial inclusion. So people in this room, we have the power to influence a significant amount of, sort of the global focus on SDG. We are the host this year, starting next year for G20 as a country, and financial inclusion is going to be a big work stream under G20 presidency, and this is going to be under a big spotlight. So I do want to leave this audience with a message that I think this community has a tremendous opportunity and a responsibility to make finance work for Bharat. So I'll leave it there, and thank you once again for the opportunity.
Thank you so much, Mr. Shah. I'd like to invite Mr. Sunil Patwari from Nagrika to please come up on stage and present the memento. Can we have Mr. Utkarsh Patwari to please come up on stage? Thank you so much. And our next topic, enterprise risk management. For that, I'd like to call upon stage Mr. Anil Matthew. Mr. Anil Matthew is President, Public Policy Advocacy, ESG, Engagements and Chief Risk Officer. He also heads Corporate Communication and Business Transformation. Being the head of Public Policy Advocacy, he works with senior government officials in Delhi and other state headquarters on various trade and non-trade related policy matters. Mr. Anil has been in metal industry for about 3 decades. Prior to the current position, he has handled commodity and currency risk management, corporate treasury, mergers and acquisitions, strategic planning, business finance, and investor relations. He is currently the member of ExCom at Hindalco. He is also the Vice President of Aluminium Association of India and also member of various committees. Ladies and gentlemen, please welcome Mr. Anil Matthew.
So, good afternoon, everyone. So, by the time my presentation comes up, we heard a panel discussion here, in derivative world when complexity came in, how the risk managers failed. Because we did not have a risk management for the risk managers. I was also on the trading desk at that point of time, and banks had approached me. But before I took this job, my CEO told me two things. One is, you are a risk manager, your job is to protect. If you make money, you don't get extra bonus. That was first thing. Second thing, what he told me was that, please don't do what you don't understand. Simple. So that's what I did. The bankers came, tried to explain to me the animal. I explained completely. They explained the tail, they explained the trunk, but when it came to the body, couldn't explain, so I decided not to do it. So I'm going to talk about in a derivative world, when complexity comes in, what can go wrong. I'm going to talk about in the whole world, if complexity comes in, what can go wrong. So my subject is enterprise risk management. So it is not just smaller, it's a much wider risk management. So when you talk about risk, typically we tend to think about the threat part of it. So anybody who is doing business, or if you want to do business, it's all about taking risk. Without taking risk, we cannot make money, and if anybody can suggest something, I will be happy to get into that. So without risk, no money. But then when you take risk, you also should know that what risk are you taking. But when I'm talking about the enterprise risk management here, there are two sides to it. One is the threat part of it, and also the opportunity part of it. So when we talk about enterprise risk management, we ask, what are the threats to your business? That is the first question. 3 questions. Anything before you do, check up what can go wrong, how can it go wrong, and why should it go wrong. If you can get an answer for that, your first job is taken care of. On the other side, looking at opportunities, what we are looking at is, am I taking enough risk to deliver the results of the company? So in enterprise risk management, we look at 2 sides, the threat part of it and the opportunity part of it. Now, we used to hear the word risk management over a period of time. If you see here, the risk management had been there in existence, but again, you see how it changed over a period of time. Insurance had been there, a part of the businesses in earlier days. Financial risk had been a part of the business earlier days. You had receivable or credit risk management. You had liquidity risk management, commodity, currency, or price risk management. All had been there. Slowly, we moved into giving a lot more importance to customers, suppliers, risk management. The people became a focus, talent became a focus. And finally, today, when you look at it, everything what you touch in an organization is all about risk, what you're talking. For example, let me tell you, take social media. Maybe a couple of years, social media was not there. Reputation. Today, if anything happens, whether right or wrong, the message goes across the world in no time. That is the biggest risk we are facing. Like in my organization, communication reports to me, we already have a holding statement ready. Any incident happens, what is that you should communicate first? Earlier days, it was not there. It used to come in newspaper. Few of the news channels may bring it, may not bring it. So the world has changed over a period of time. So anything in business, what you touch, there is risk. So that is where the enterprise risk management becomes important. So why enterprise risk management? We heard about the complexity. We used to hear the word VUCA, volatility, uncertainty, complexity, ambiguity. The world has actually become VUCA. I've just tried to give you examples there. The world is changing, and what you have seen is the pace of change is much faster than what had been. What had been changing over a period of time, there's no doubt about it. But now the pace of change is much faster. There are disruptive ideas coming up. There are new business models. If you see pre-COVID and post-COVID, there are a lot of new businesses which came up. There are a lot of old businesses which died. So if you look at it, things change. Technology has become the center stage. ESG has become the center stage. I talked about global reach. Activism has become much more, whether it is media activism or whether it is shareholder activism or ESG activism. So the world which we are working has become much more complex over a period of time. That is where you need risk management. So I was just sitting and writing down the world around us in last 2 years. So I'd been on the commodity currency hedging desk since 2007. Then from there I moved into enterprise risk management. When I was looking at what are the risks which played out around us in last 2 years, I don't remember. We had so many risks. Started with COVID, then we had a major supply chain disruption which happened. The geopolitical issues, Ukraine-Taiwan issue, which Taiwan has not come up, but Ukraine issue, inflation, energy crisis, talent, the great resignation we talked about, impact of climate change we are seeing. So host of things which have come up, and I can tell you the CEOs and the CXOs are busy handling these risks. So coming to the objective of enterprise risk management, as I said, without risk, no business. Now, what we are trying to do here is optimize the risk. So neither ignore risk, because if you ignore risk, you don't know when it will come and hit you. But don't try to eliminate risk. If you eliminate risk, your risk-reward ratio come down. So what the whole purpose of business is optimize risk. How do you do it? You have a risk appetite. You may be in the same business, but your risk appetite may not be, like for example, I am a company which makes 100 crores profit. There is another competitor who makes 200 crores profit. But my debt EBITDA is 3 times, whereas the other company's debt EBITDA is 10 times. Definitely, my risk, even though I make lesser profit, from a risk appetite perspective, my risk appetite is much better than the other company. So what you need to do is optimize risk based on the risk appetite of the company. That's what we are trying to do. Also, let me point out here, if you have a proper risk management in place, that will actually help you to take more risk. For example, if you're driving on a highway, if your car has got a very powerful headlight, you can see way ahead and you can drive much faster. Whereas if you've got not a very powerful light, a dim light, you'll be driving very slowly. So a good risk management, a good enterprise risk management in the organization actually help you to take more risk. So talking about what is the purpose of enterprise risk management. So when we talk about enterprise risk management, we basically talk about 3 types of risk. One is the known risk. The first known is I know about the risk. And the second known is I know how to mitigate that risk. So a risk which is known to you and a risk which you know the mitigation plan is called known risk. The second one is known unknown risk. I know about a particular risk, but I don't really know what should I do to mitigate that risk. I need to wait for things to go wrong and wait for a crisis management. And the third one is most difficult, which we had seen recently with COVID and things like that, the unknown risk. Neither I know about the risk, nor I know, if you don't know the risk, you don't know the mitigation plan also. So typically what happens is in enterprise risk management, we work on the unknown part of it. See, it is unknown to you. But if you do some extra amount of, like for example, if you do a scenario analysis of your organizational business, you may be able to identify many more risks which you felt it was unknown to you. So the whole purpose of risk management is reduce the unknown unknowns, reduce the known unknowns, make it known, and if possible, mitigate the risk and put it in the green category. That is the whole purpose of the enterprise-wide risk management. So what are the aspects of risk management? The first part is identifying the risk. How significant is the risk for you? And do you have an owner for your risk? That is very important. There could be many risks in the organization. If there is no owner, I don't know who is going to handle that risk. Similarly, once you know your risk, do you have a proper mitigation plan? How effective is your mitigation? And also an owner for the mitigation plan, because this cannot be left to anybody. And finally, you should keep reviewing the risk, because the risk profile of the company changes very frequently. Because last week I was making a presentation. I was looking at the World Economic Forum risk in 2010 and the World Economic Forum risk in 2022. I was saying in 2021, it was just the post-global financial crisis. It was all economic factors. Hardly there was one geopolitical factor. Today, when you look at it, the 8 out of 10 factors are ESG-related factors. See, in 12 years' time, the global risk itself has changed focus from economic factors to ESG factors. That is how. So you need to keep on reviewing the risk profile of the company and then work on that. So typically what happens is when you want to do a very structured way of risk management, it is good to have a proper process in place. So typically what happens is, to do a risk management, the first stage is you need to acknowledge the factor that there is a risk in the organization. If you don't acknowledge there is a risk in the organization, you can't manage your risk. Once you acknowledge, yeah, there are risks in the organization, you need to first identify the risk. So there are different ways of identifying the risk. You go and talk to the operating managers who had been there in the organization for many years. They might have seen a couple of cycles in the organization. They will tell you through their lifetime what all risk you have seen. You've got other industries which you can look at. You can do a scenario analysis. So there are different ways of identifying the risk. Now, once you identify the risk, see, there will be thousands of risks you might have identified when you went through the exercise of identifying the risk. Once you identify the risk, you need to assess the risk. So when you talk about typically assessing the risk, there are basically two things people look at. One is, what is the probability of this risk hitting you? That is the first thing. And second one is, if the risk hit you, what is the impact of that? So the probability into the financial impact or any other impact is the second part we should look at. Now, once we know what is the net impact of a risk hitting you, the third stage is you need to prioritize your risk, because your CEO, actually your CEO is the biggest risk manager. The CEO will not have time to look at thousands of risks in your risk register. You need to find out what are the top 10 risks of the company, and that is where the CEO or the CXO should be focusing on. So once you prioritize the risk, what you need to do is, so when you prioritize, the top 10 goes to the CEO, the second 10 goes to maybe the chief operating officer, then you've got the top 10 financial risks which can go to the CFO, then you've got operating manager. So in our organization, we have got all the way going to the departmental heads. So everybody has got 10 risks which so you can imagine it is cascaded down, and lot more risks are tracked. Now once you identify these risks and the risk owners, what is required is you need to have a mitigation plan. How do you mitigate it? And once you have a mitigation plan in place, some mitigations will be very, very expensive. So you decide not to mitigate it. You create a good crisis management structure to handle that. But there are a lot of risks which can be mitigated within your financial capability. So mitigate that, treat it, and take out from your risk register. And that is where we call the residual risk. After mitigation, whatever risk is left over in the organization, that is called residual risk. That is what we'll be watching very closely. You need to monitor it very regularly. First, as I said, from a risk profile perspective, whether your risk profile has changed. From second perspective is keep on stress testing to your mitigation plans. Your mitigation plan, which was effective today, may not be effective tomorrow. So look for that. And then comes into the reporting part of it, because without reporting, without visibility, you will not be able to act on it. So finally, the process what I talked about, I call it as a tool for risk management. How do you use the tool for better performance? You need to integrate this tool with your operational performance. So the first one is integrate ERM with your performance review, integrate ERM with your strategy. Find out what are the risks to your strategy. That is the first part of it. The second part is build a risk-aware culture. And when I talk about risk-aware culture, it is not for your organization, even for your personal life. If you are aware what are the risks which can come and hit you, it will be really beneficial. So in my organization, what we always tell people is that whenever you do something, ask three questions: what can go wrong, how can it go wrong, and why should it go wrong? And look through a risk lens. That is what we suggest. So I'm skipping this. Who is the risk manager? As I said, everybody is a risk manager. If I'm in a manufacturing organization, I don't go to the shop floor and I'm an aluminum making organization. I don't go and produce aluminum. What I do is that I need to ensure that aluminum is produced within the cost, within the efficiency. So that is my role. So all of us in the organization are risk managers one way or other. Before I conclude, is this mandatory or is it optional? Yes, for some set of people it is optional, but some corporates it is mandatory. You got the Companies Act. I'm not getting into details of it. Companies Act talk about risk management. SEBI LODR talks about risk management. The top 1,000 market cap companies are supposed to have a separate board committee for looking at enterprise risk management. And before I conclude, I always say that enterprise risk management is a performance enhancer. Whatever we do in the organization, we are paid salary for that. If my activity doesn't add value to the organization, it doesn't make any sense. So it gives early warning system. That means it give you time to prepare before something come and hit you. Less surprises means lesser crisis management, lesser stress. Improve profits. If you mitigate your risk on time, your performance will be better, your profitability will improve. Protect or improve cash. For example, if you do a project risk management, if you complete the project on time and within the cost, it will save cash. So you save cash there. Enhances brand equity. Look at the ESG risk. What sort of a brand equity you're getting by taking care of the ESG risk. Whether it is credit rating, whether it is share price, liquidity, funding cost, all those things will be within your reach. And it will attract customers, suppliers, and even very soon, talent also will get attracted to only companies which practices risk management. So I'm not taking, so I think I'm short of time, so let me conclude with last statement. Manage your risk wisely, or you have to manage a crisis. And crises will be very expensive, painful, time-taking. So it's good to have a risk management system. And before I close it, I had been using a logo there. It is called, so I work for Hindalco, but I used a separate different logo there. There's an organization called RM Next. We are about 150 odd chief risk officers and enterprise risk managers in the country. It's an informal organization. We learn from each other, and this is free of cost. Some of the founders of this organization, Maulik is a part of it. Maulik is one of the earlier. So Maulik, while he advises you on risk management, he also come to our society to learn what is an enterprise risk management. And anybody want to understand more about it, or if your chief risk officer or somebody want to be a part of this community, you can connect with Maulik, and he will help you to get in there. Thank you very much.
Thank you so much, Mr. Matthew. I'd like to invite on stage Mr. Sunil Vishwakarma from SR Capital to please present the memento to Mr. Anil Matthew. Mr. Vishwakarma. I'd like to call upon stage Mr. Maulik Shah, please. Thank you, sir. Louder round of applause, ladies and gentlemen. Thank you so much. And now for our next topic, which is technology disruption of capital markets, I'd like to call on stage Mr. Jaiprakash Gupta, who is the founder of Dhan. Ladies and gentlemen, please put your hands together for Mr. Jaiprakash Gupta.
Yeah, hi, good afternoon, everyone. So this is going to be a tougher session, I think, the session before a tea break. Yeah, so I hope I'll keep it short and so that we can wrap up in 15 minutes. Yeah. 9 or 10, okay. Yeah. Yeah, so, we have been talking throughout the day about, lot of things happening. So what I believe, or most of the people out here believe, is that the technology is going to be the next enabler, disruptor, is going to change the way we do businesses and all. So I'd like to share my thoughts and also the thought behind we building Dhan with few slides here. So this is, if I talk about capital markets per se, this is how the things have evolved in last 30 years. We used to be a ring-based trading mechanism. From there, we moved to electronic trading. And this whole leap of faith happened in 1993 when NSE was launched and NSE became the first electronic exchange in the country. The whole leap of faith, I would say, happened only because of our regulators' conviction. And the whole credit goes to the SEBI, which was newly formed at that point of time. So just to give you a context, in 1993 when NSE was formed, our country was reeling through a series of crises. We had 1991, post that there was a liberalization which happened. In 1992, our stock markets witnessed one of the worst scams, also called Harshad Mehta scam. Then in 1993, there was Mumbai riots. So the whole country was in disarray. And at that point of time, when such a bold decision was taken to adopt to an electronic-based trading, that showed the vision and leap of faith our regulators had at that point of time. And that became the enabler of what we see today. So what we feel that from here on, the future is going to move on mobile technology. The future is going to be on blockchain, on cryptos. So this is how we have evolved over the last 30 years. So if we talk about, say, evolution of stockbroking in India, we all know we started on a ring-based trading, then we moved to a traditional broking set, then banks became brokers. Post that, there was something called marginal leverage. So the only way to attract client or attract corporate was how much of a leverage the entity used to provide, be it a bank or be it a traditional house. So from there on, we moved to something called discount broking. The first of its kind happened in 2011. So pricing was the factor, which was differentiator. The leverage was already there, but a client would always move from one entity to another on the fact that I used to get leverage and I am also getting a lower transaction cost. So then came the product and experience side of it. So when it's not working. Yeah. So when you talk of product and experience, the product comprises of what kind of features you are going to bring and what kind of technology you are going to embrace. So this is what is going to define the capital markets from here on. So let me also give you a glimpse of how the demat accounts have opened in last 7 years. In September 2015, we were 1 crore demat accounts. Till August of 2022, in a span of 7 years, we have done 7.5x. So this happened also, the tailwind was the COVID times. So now if we have to dissect this 7.5 crore demat accounts, we could see that there has been an overlap, and out of that only 2 crore accounts are actually long-term investors. And the remaining ones belong to trading community where they either trade in intraday trades or they are also option traders. So in totality, if you see out of 7.5 crore accounts, 3.5 crore is what actually is the market. Now, when we analyze this data, and we have been often asked, why are you building this now? Because there have been already so many of banks who are already working on this arena. Then there are already technology-led platforms, and the size is small, right? If we see the statistics, which I'll present in the next slide, that we have only 4% of our population who invest in markets. So is there an opportunity? So that deliberation we did within ourselves, and we found that we have only touched the surface as of now, because the use of technology, the embracement of technology which is going to happen from here on will take us way ahead. If we just put some data in perspective, today we had a discussion about how this UPI success story has happened. If you see the chart here, in last 6 years, from almost zero to we are doing almost 678 crore transactions. So we have seen in terms of UPI transaction, there has already been a revolution which has happened. The next big thing which we see is going to happen on the capital market side, on the transaction side. So when we talk of transactions, we have already seen that there is interoperability which has already happened between exchanges. There is interoperability between depositories, clearing corporations, KRAs and RTAs. We feel that the next interoperability is going to happen on the intermediary side, where a client would have an option of switching from one broker to another, from one depository to another, from one AMC to another at his choice. Now, if you take a common analogy, what we do today is if we don't like a service of a mobile network, we can easily switch without changing our mobile number. So we anticipate the same thing going to happen in the stockbroking business from here on. So that's going to be a game changer. So what you as a company need to do at that point of time is you need to create certain kind of features, certain kind of technology, which creates or which motivates a client to move from one entity to another. I think. So that brings to our value proposition, which says that we want to make a combination of technology, customer experience, and product, and there lies the sweet spot which we want to target going forward. So now, as I was telling you, right, in terms of the kind of potential we have by adapting technology, is that this data which shows that in India, the mutual fund penetration is only 11% of GDP, while the equity penetration is only 7% of our population. If you compare it with US or, say, for example, China, so we are still a long way to catch up. And there are more initiatives we know which can happen through technology. If we talk about gold, so we have, as per World Gold Council estimates, we have $1.5 trillion of gold lying within Indian households. Out of that, only $5 billion has been mobilized till now through sovereign gold bonds. So if we want to achieve financialization of gold, the technology is going to play a big role into it. And there lies a big opportunity again here. So there are certain initiatives which have been taken by IIBX. We have recently heard that through IIBX, any domestic entity can also hedge gold. So that gives an opportunity. Again, the whole journey of converting, say, out of 1.5 trillion, even say $50 billion, the whole process can happen through using technology. Now, even when you go and speak about currency derivatives, we see globally that $6.6 trillion of average transaction which happens in a day globally on currency markets, vis-a-vis in India, which is only $33 billion. And if we dissect it further, only $6 billion per day is exchange-traded currency trades. Now, if we integrate that and we're talking about launching of exotic derivatives, NDFs in Gift City, that can further enhance the participation within the domestic markets. And again, technology has a bigger role to play here. Now, again, moving it further, if we talk about the lending business, which is essentially the loan against shares, we have almost 2,87,000 crores of market cap. Out of that, only 40,000 crore is the lending business of LAS. And the largest player there has a market share of only 12,000 crores. So if you want to tap a business, so there again is a huge potential, and this potential has not been used till today. And the journey from here on, even if we try to do this through a physical offline model, is going to take decades, right? So that works well if you use technology here. So the transition is going to be faster. So on this, this is what our whole belief is, that technology is something which is going to drive the future. And with that philosophy or with that thesis in mind, we have embraced our journey. And currently we have started with this 5 products. And we hope that in coming days, we will be able to create more impact in terms of embracing technology and driving inclusion of financial markets with Dhan. Thank you.
Thank you so much, sir. I'd now like to invite Mr. Bijur on stage, please, to introduce Currency Dart.
Yeah,
Yeah, let me change bit, and I have promised that we'll start the next panel at 16:20 sharp. So I would call upon Mr. Kunal Sodani. He is the Vice President, Global Trading Center at Shinhan Bank, to speak on the psychology of mastering the trade. You have 12 to 13 minutes, then award ceremony for currency dart winners.
Well, so first of all, I think I'm not here to tell that what technical parameters to use or what technical indicators one needs to use or what fundamental parameters need to be used in order to have a successful trading session or trading plan or a winning trade. Because I think one thing is for sure that markets are dynamic and they will never remain constant. But there is one thing which remains constant, and that is you. So we will talk about you, we will talk about us today, which should be a changing dynamics for us in the next 10 minutes. So first, I believe, everyone wants to work out, everyone wants to go to the gym, or maybe they go for jog. So assuming, well, I go to gym on day one, I work hard, I come back home, look at the mirror, and what do I see? Possibly nothing. The another day I go back once again to the gym, work hard, come back home, watch the mirror, I see nothing. I repeat the same process for a couple of days, and possibly when I look in the mirror once again, I see nothing. The problem is, what we start believing is that the process is not working well, it's not measurable, it's not effective, so what do? We quit. But if you really believe in the process, if you really believe in the daily course of action, if you really believe in the daily regime which you follow, exercise, I think nothing can beat you to get into the shape. It's the same thing when it comes to trading. One fine day you cannot be a successful trader, or maybe suddenly you believe that a couple of good trades make you a trader, a successful trader. I think it's a daily regime which one needs to follow. And if this daily regime is rigorous enough to make you feel tired, but at the same time, at times alter the process to become what you want to, that's actually trading. Trading is not about, finding the right trades. It's about trying to understand probabilities. And if you really understand probabilities well and incorporate that into your daily regime, I think it can work for you. So I think if I ask the audience, everyone might have dreams, aspirations, they have goals, everyone wants to make money, they want to have a better standard of living, they want to grow in life as a person, as a professional. But I believe very few people are willing to tell me that, what are you willing to sacrifice in order to become that trader, right? So I just want to tell you, remember one thing, that success is not a feeling, it is a mindset. Remember, success is not a feeling, it's a mindset. And don't let your mindset be affected by the market dynamics. Because as I said, markets will be ever changing. The only thing constant is you. So keep on repeating the process, keep on doing what you like. It's not about the person who's more intelligent, it's not about the person who is more smart, it's more about only one thing, and I really truly believe that is consistency. If you continue to consistently do something, if you consistently observe numbers on a daily basis, it is impossible that you don't start forming patterns in your mind. You don't even have to look charts after a point in time, because it will automatically be imbibing in your eyes and in your brain. So that kind of rigorous watching of the market should happen, and it will work for you. Apart from it, like I'm sure everyone is also, have watched FIFA. What happens? There is a lot of passes which happens in order to finally come to that 30 seconds where the goal is scored. But that 30 seconds of goal scoring is not that important than the passes which were taken to lead to that 30 seconds of goal. So basically, there can be 15 passes, 30 passes, 50 passes in order to find that 30 seconds of the probability of you scoring the goal into the goal post. Similarly, markets will tell you and give several instances and opportunities to tell you that please trade, 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 trade. But there is no need to unnecessarily find a setup which is not made for you, or you don't have a full conviction towards trade. The passes in financial terms may refer to pass the trade. It's not necessary to take the trade. You need to pass the trades. Even if you trade 5 times in a month, I just want to keep in one single sentence that it's not the quantity of trades that will make you a good trader. It's the quality of trades that will make you a good trader. So even 4 trades in a month can be 30 trades, in a month. So that kind of scenario one needs to create. 2 things I want to, tell you for myself as well as for everyone. One, I think you need to, every time you get up in the morning, first have a purpose. And second, a clarity of thought. If you have these 2 things, it's not about only markets, it's also about life, that nothing can beat you down, not even markets. People say that, okay, analysis may go right, wrong. Yes, there can be a logical reasoning behind it. But if you really work through the process, alter the process according to the needs of understanding the market, I think still believe that markets cannot beat you. So in ancient times, what used to happen? When we talk about hunting, there was nothing like a bow or arrow, or maybe there was nothing like a pistol or a gun. So what used to happen was the hunter used to keep the favorite food. For example, if we take an example of monkey as an animal, the hunter will keep the favorite food of the monkey in a jar, an opaque jar, with the favorite food with a narrow bottleneck of the jar, and the hunter will hide behind a tree. Now what happens? The monkey will obviously come out. He will try to have his favorite food. He puts his hand inside, and to his surprise, he realizes that he cannot take the food out. But because he's so biased towards that food, he doesn't want to leave that food also. And thus what happens? The hunter comes out and he makes the monkey as his hunt. The same thing also applies when it comes to trading. If you want to be a successful trader, first you need to survive the another day. If you don't even survive the another day, you cannot become a successful trader. So it's important to understand that when to move on, when to leave the trade, when to alter it, when to not believe that it's not going right and come out of it, take the loss, that's completely okay. We'll at least give you another day to fight back. But if we just give and turn bias towards what we want to do, it will never turn the way we want. So anyone who has heard about Renaissance technology, Rentech, anyone? I think I cannot see as, okay, only 1, 2, 3 names out of possibly 50 people sitting out here. So I'll just tell you about Renaissance technology. Renaissance technology is an American hedge fund, and that hedge fund was founded by James Simmons. James Simmons is a mathematician. He has no financial background as such. And James Simmons was the person who was a code breaker in Cold War. He's still there. But the point is, he started with a hedge fund, which is known as a Mendelian fund. And to your surprise, the return with that hedge fund is 66% on a gross basis and 39% on a net basis after taxes and cost. The other surprise is, this is not for 1 year, 2 year, 3 year. Since last 30 years on an annual basis, he has been delivering that 39% every year. But only 3 people out of these 50 people know about him as a person. Why? Because in trading, what we also follow, we do a lot of chest thumping. I will flash a trade call, and I say, look, I told you this trade is going to go right. It goes right. I republish that trade to whenever I had told. But it's not about creating an identity in other people's mind. If you really want to be a true trader, it shouldn't matter. You are not here to prove something else to someone. If you really want to be a true and successful trader, it's about proving yourself. And thus, I think the audience doesn't even know about, and this is the best fund in the history till now of Wall Street, but only 3 people know about this fund. So, couple of things more to just conclude. I understand people will have to move out to have, I think people might be tired as well. But one thing which I want to tell everyone here, including myself, and I keep repeating this to myself as well, is you need to first, in trading or even in, when it comes to fitness, you start, you stop, you start, you stop, you start, you stop, you wait. If funds are available, I'll trade. When funds are available, you don't have setup. Why this is happening? Because possibly you need to answer this question to yourself. Either you don't have enough skin for it, or either the case is the goal is not even favorable enough to push you that way. So if you really don't want to be a mediocre in life, and if you really want to go ahead, you need to beat these mindsets out of your mind and move on. So lastly, I want to say is, decide what you want to get, decide to have it, and decide to just go behind it. वो हिंदी में कहते हैं ना अपन कि मंजिलें तो मिल जाएंगी, भटकते भटकते, लेकिन गुमराह तो वो लोग हैं जो कभी घर से ही बाहर नहीं निकले. So that's all from my side, friends. Thank you so much.
Thank you so much, sir. And now I'd like to invite Mr. Bijur to please give us the introduction for next winners.
We usually conduct in Almus the currency dot winners competition, where we want to predict. Earlier we have started with only dollar rupee. We extended it to many currencies this time to make more competitive. I'm happy to share with you that the first prize of the competition goes to Mr. Kunal Sudani. Can you come over here, Mr. Kunal? And the second prize is won by Shankar Ramaswamy. Mr. Shankar Ramaswamy is in Chennai due to the cyclone. He could not come. And the third prize goes to our own team person, Virendra Yadav. He is not a trader. He is marketing. So Virendra, to come over here. And who is here? The trader. I wanted to call Ashwini Sindwani, Fedai chief, to come over here. He is not there. I think I'll call Mr. Sudarshan Bhatt to come here. Mr. Sudarshan Bhatt is General Manager Treasury at Union Bank. One of the very good trader even today to honor and give the gift to the winners.
Congratulations to all the winners. I would now request Mr. Bijur to please introduce world markets to us, please. Afterwards? Okay, so next panel directly. So our next panel is discussion on the impact to the Indian economy. For this, I'd like to invite our moderator who's going to join us virtually, Mr. V. Thiagarajan. Mr. V. Thiagarajan is currently the chairman of the SYFX Treasury Foundation. He's well known in the forex markets with nearly 25 years of trading experience. He teaches both fundamentals and technical analysis in all the professional training programs in the country and abroad. In 2003, he moved to Reliance Industries Limited as Senior Vice President Forex and rose up to being in charge of Forex Treasury. Next, I'd like to invite Dr. Rajeshwari Sengupta. She's an Associate Professor of Economics at Indira Gandhi Institute of Development Research, IGIDR, in Mumbai, India. She has also held research positions at the Institute for Financial Management and Research in Chennai, the Reserve Bank of India, and the International Monetary Fund, IMF, and the World Bank in Washington, D.C. Her research focuses on policy-relevant macro-financial issues of emerging market economies in general and in India particular. She has published in reputed international journals and has also written chapters in various books published by Asian Development Bank, G20, the Center for International Governance, Innovation, CIGI, among others. Can we please have Dr. Rajeshwari Sengupta on stage, please? I think she'll join after some time. Next, I'd like to invite Mr. Saugata Bhattacharya. He's Executive Vice President and Chief Economist at Axis Bank. He's a member of the CII National Councils on International and Trade Policy and on Financial Reporting, the CII Western Region CEO Economists Forum, and ASSOCHAM National Council on Banking. He has been a part of RBI Ministry of Finance and Ministry of Housing and Urban Affairs committees earlier. He's a member of the Executive Council of the PGDM programs of the National Institute of Bank Management, NIBM, Pune, and the Academic Council of NMIMS, Mumbai. Can we please have a round of applause for Mr. Saugata Bhattacharya? Next, I'd like to call upon Mr. Rahul Bajoria. Mr. Rahul is the Managing Director and Chief Economist for India and the Antipodes Barclays. Mr. Rahul also leads the economics teams covering M-Asia ex-China and is responsible for driving thematic research across Asia-Pacific. Mr. Rahul has also worked at INSEAD Singapore and NUS Business School, looking at issues around productivity and growth. He joined Barclays as a part of the graduate class of 2009 in Singapore, covering economics across the Asia-Pacific region. Can we have a huge round of applause for Mr. Rahul? Next, I'd like to call on stage Dr. Ajit Ranade. He's the Vice Chancellor of Gokhale Institute of Politics and Economics in Pune. He was earlier Group Executive President and Chief Economist with the Aditya Birla Group. Mr. Ranade is a member of the executive committees of Apex Industry Chamber CII, FICCI, and NCCIA. He has also been a member of the board of several companies and trusts. He writes in the business press on economics and current topics. A huge round of applause for Dr. Ajit Ranade. Over to you, sir. Mr. Tyagarajan.
Thank you very much. Good evening, ladies and gentlemen. Thanks, Almus, for the opportunity to moderate this flagship panel discussion of the conference. Instead of being on the on-field umpire and officiating as a third umpire, extremely sorry for that, but of course, this is the consensus. We have had a high-quality discussion since morning, and the panel possibly brings home the theme of the conference and a glimpse beyond the obvious. Mr. Anand had set the tone for the conference by talking about two pertinent questions that have been engaging the market. That is, the debate about the resilience of the financial economy versus the fragility of the real economy. Possibly, this is the question that has been engaging the market for quite a long time. The financial economy, which was supposed to reflect the real economy till 2008, actually probably till 2008, we can very well say that the financial economy was reflecting the real economy. And the paradigm shift happened in global financial crisis. And from then on, actually, financial economy is not really reflective of what is happening in the real economy. I think this dichotomy has been going on for nearly 14 years. Whether this dichotomy is going to end probably in 2023, not sure. The question actually boils down to whether you are going to chase the bubble or choose to accept the macro reality. I think this is going to be the question of 2023. And a set of central bankers who paid a war cry not too long ago that we will do whatever it takes. Now we have got a set of central bankers who are shouting every day, I will break whatever it takes. So whatever it takes to break, we will do. That's a kind of the shift that has happened in the central bank thinking. So the macro perspective is going to be the primary importance. Actually, if you ask any trader in the last 14 years, actually, no macro trader would have ever played one, honestly speaking. But it is very difficult. They will not fighting the markets. Now, from here on, possibly the macroeconomics is going to engage the attention of the markets. The economics which has lost relevance in the last 15 years, I think it is making a big comeback. The composition of the panel itself is a sign of what things are going to happen. Normally, we would have had a practitioner sitting alongside this economist talking about the practicalities of applying economics in the market. But right now, we have got all four eminent economists. It's my privilege to be a moderator of this panel discussion. Let me start with a question to Dr. Ranade about the global growth. Of course, everybody is talking about the recession. Of course, in 2023, in basic question is how deep it is going to be, or whether it is going to be a shallow recession. Dr. Adit Rande.
Thank you, Mr. Varajan, and good evening to all of you. So, how deep is the recession going to be? I don't know, but I think there will be there will be a recession. These kind of sharp changes, we saw on 20th April 2020. On 20th April 2020, more than 2 years ago, the price of oil was minus $37, minus, negative. And that was, of course, if you remember, I think Rahul will remember, the West Texas Intermediate, WTI crude, and this is technically a forward price, not the spot price. But basically it was minus 37 and then it went up to 120, 140. So these kind of sharp movements happen in oil markets, maybe in some commodity markets, but sharp recessions are, I don't think, going to happen in the world. You'll see when global GDP growth rate slows down from 3.7 to 3.1, we call it sharp. Oh my God, it's sharply down. Then when India's GDP forecast is revised downwards from 6.7 to 6.3, oh my God, sharply down. So if you mean sharp in that sense, yes, there will be a sharp, but otherwise I don't think there is enough degree of diversity in the global economy, because countries like India will continue to grow at around 6% or higher. There are countries like economies like the US, which I don't think will be in negative territory. And there'll be Germany and possibly some of the large European economies which will actually have a GDP contraction, but even the contraction will be a minus 0.5. I just want to spend a minute on this just to give you the perspective. When the US economy grows at 0%, when the US economy, if and when it does at 0%, it means it produces about 17 million new cars, right, Shrikant? 20 million. So 0% growth for USA means 20 million new cars. And 8 million new cars for India means 10% GDP growth rate. So if the US technically grows at minus 0.5%, instead of producing 20 million new cars, they'll produce 17 or 18 million new cars. Okay, we are not. So one has to be careful when we say recession, negative, positive growth. So my short point is that because of the variety of economies today, China possibly slowing down to 2 or 3%, India at 6%, Germany at minus 0.5, minus 1, America, I don't know, maybe 1%. So overall, you will have a global GDP growth during calendar 2023 at, I don't know, 3% or 2%. And if you want to call that a sharp recession, it is, but I think that's the way it's going to be. So basically, the next few years, we're going to just have growth rates of that kind. We're not going to go back to global GDP growth of 5% or 6%, nor will we be close to zero. Thank you.
And that's reassuring. Rahul, coming back to you, in the context of weakening global growth, what is your take on regional economics? For that matter, what do you think of China actually? What is transpiring there? And whether China is going to be inward looking? That's a basic key risk for 2023.
Thank you, Tyagarajan sir. I think, in the context and the picture that Dr. Ranade has painted about effectively sort of reverting back to mean, on global growth in terms of what we have seen, but the disparity across various regions probably is going to increase, where you have, Europe sort of going through a shallow but a fairly persistent recessionary outlook, largely because of commodity price shocks. We have global manufacturing sector basically going through what already feels like a recessionary outlook, but services holding up reasonably well, both in the US and also in large parts of emerging economies. And this is effectively a function of what we see as a post-pandemic recovery, right? I mean, high contact services coming back in a big way. In this particular context, I think China obviously was the big outlier in 2022, right? Because as the world was reopening, China actually went into what was probably the most stringent of its 3-year lockdown that they have experienced, where zero COVID effectively broke down. But then after what was a fairly stunning images coming about protests in large cities, I mean, there has been a very distinct shift in the zero COVID strategy. Now, whether it works or not, because if one takes a long view of a 3-year period, I mean, zero COVID actually has been a very successful strategy, but it's not worked in the last 1 year primarily because of the transmissibility of the Omicron variant. And as they exit, I mean, whether, China sort of goes through a round of persistent or, disruptive lockdowns again to manage the virus, how smoothly they are able to get out of it without having to revaccinate their entire population also remains a bit of an open question. So these are the known unknowns, but then what is very clear when we sort of take a step back and think about going into 2023, China's consumer outlook has definitely improved at the margin, right? Because the steps that have been laid out just in the last few days, there was this 10-point easing measures that was announced by the NHC, which is their health council, which clearly shows that on a 6-month horizon, Chinese consumption, Chinese spending should actually be increasing, not decreasing as a result of the domestic measures, and that should provide a degree of comfort to the region at large. India, is for all valid reasons, I think, kind of stands out as an outlier, even though we expect there to be a bit of a slowdown. I think what is very visibly clear is that the lack of leverage or the reduction in leverage in the last 3-4 years, the hard yards that were done even before the pandemic set in are being acting as a tailwind for us. So the regional outlook is one where the manufacturing sector, which is a very large part of Asia's economy, is going to be in a bit of a doldrum as Western demand comes off. But then the invisibles, the non-tradable sector actually looks to be doing okay, and we reckon that probably will sort of anchor the growth outlook in the region, but not necessarily prevent the cyclical slowdown from playing out going into 2023.
Just extending that to further, Mr. Bhattacharya, what do you think of Indian view? How it is evolving?
So, thank you, Mr. Tyagarajan. Good to see you after a long time. Thank you, Almus, for this opportunity of coming in here and interacting with all of you. So, point number one is that India's economy seems surprisingly, almost incredibly resilient to these major shocks that we have been exposed to, series of shocks, one after the other. Now, particularly with very sharp rate increases, and which has been transmitted very, very quickly. I mean, this time because of the link to the repo rate, the external benchmark rate, a large segment of the loans, the rates have been transmitted almost instantly. Given all this, all the indicators that we have seen remain very, very resilient. So that's number one. Second is from what we have heard on the global economy. I mean, there are three major channels of the spillovers from the global shocks or the global activity into India. Two, we are more or less already over. The first, the financial channels. We have had a large series of shocks on the financial sector, portfolio flows, other flows, foreign capital, etc., current account deficit. So that part is hopefully, fingers crossed, more or less over. The second channel is the commodities channel, and the commodities channel will now probably, again, fingers crossed, we don't know how things are going to pan out, China, US, we don't know what the geopolitical situation is likely to be, but hopefully even the commodities shocks that we have experienced, energy, metals, food, whatever you name, even that probably is a bit behind us. The third one now is is probably the one that will be the most dominant, and that's going to be the part of the reason that India is likely to slow down, which is trade. We are already seeing that in the context of merchandise trade. Services trade, particularly IT and even other services, non-IT services, still remains fairly robust, but I think it's only a matter of time, given the carnage that we are seeing in the tech sector in the US begins to transmit itself to India. It's not going to be a huge impact on IT services because IT, I mean, the discretionary and the non-discretionary spends. Discretionaries will probably be postponed a little bit, but the non-discretionary is going to remain robust, particularly now with the increasing automation, use of IT systems, etc. The third point in all of this is that now we expect India to slow. I'm quite sure. I mean, whether we grow at 6.5%, 7% this year, growth will probably slow to about 6, 5.5, 6, 6.5, who knows, next year, FY24. But we should slow down. In a situation where the global economy slows and we carry on at 7%, will increase the imbalances, the macro imbalances, particularly the current account deficit. And as a consequence, even the fiscal side. So we should slow down to minimize the possibilities of these macro imbalances coming up. And that's the broad picture that we see going forward in the next year or so. But hopefully we will remain in a very good spot, and that will have other macro consequences.
Thank you, Mr. Bhattacharya. Dr. Rajeshwari, actually expanding on the point that Mr. Bhattacharya made, if global growth is declining to, let's say, 2.7%, and if you are going at, let's say, 6 to 6.5%, what are the parameters one should watch? We have never experienced such a kind of a divergence between global growth and Indian growth. Have you got me?
Yes, yes.
Hello?
Yeah, we can hear you.
Yeah. Basically, the divergence between India and global growth, to what extent actually one should watch which parameter, and probably the impact is going to be there on which parameter.
Thank you so much. And I just want to say at the outset that I'm truly delighted to be here in person. And I was telling Maulik today that the first time I participated in an Almus event was 2015. And it's really amazing to see that they have come such a long way from there. So congratulations to all of you. So before I exactly answer that question, I want to put a little bit of perspective on the India growth numbers. So there is a statistical illusion hidden in the 6.5-7% growth rate, because there's a lot of contamination by base effect. Because we had 2 years of unprecedented events, a completely unprecedented shock when the GDP contracted. And then there was a recovery the next year, so none of which was a normal year. So ideally, we should be comparing the performance with the pre-pandemic year, which was a quote-unquote normal year, which is 2019. And when we compare with 2019, sort of skipping the statistical problem of the base effect, India has grown about 7.5% in the last 3 years, 2021 and 22, which roughly means that India has grown about 2.5% every year. During the same time, China has grown at about 12-13%. Even a slow-growing economy like the US has grown at about 3.5-4%. So it depends upon how we are looking at it. It doesn't essentially convey the picture of a very spectacular performance per se. But yeah, compared to several other economies in terms of vulnerabilities and in terms of how we are responding to the global headwinds, things definitely look relatively better. Now, coming to the indicators, I think there are 2 very big near-term risks that should be worrying all of us. One is the current account deficit, and I don't think the problem is over yet. It could be anything between 3.5 to 4% of GDP or 3 to 4% of GDP this year. Now, ordinarily, having a high current account deficit is not a problem in and of itself if you're able to finance that current account deficit. The problem is twofold. On one hand, with the global growth slowing down, even in the worst case scenario with a shallow recession, let's say US slows down and Europe goes into a recession, it's still bad news for emerging markets like India, because export demand is going to continue to slow down. Right? And given that India is still growing relatively higher than the other countries, the import demand will continue to increase. So the gap between the two, the trade deficit, is going to be pretty high. On the other hand, the problem is to finance about 3.5 to 4% of current account deficit, you need at least 4% of GDP worth of capital inflows. Now, in a global environment where the buzzword today is uncertainty, we're living in unprecedented uncertainty today with a land war in Europe, the highest level of inflation in the developed world in the last 40 years, the fastest pace of monetary tightening in the history of the US Fed, China potentially slowing down. In this kind of an uncertain environment, typically, as we all understand, the foreign investors display massive amounts of risk aversion. And they are, as we have been seeing over the last several months, they go back to the safe assets of the US, they withdraw money from emerging markets like India. So in that kind of a scenario, financing 4% or even 3.5% or 3% of GDP worth of current account deficit is going to be a serious problem, which means that it's going to keep putting more and more pressure on the rupee to depreciate. And as I said, uncertainty is the buzzword. So there is no guarantee as to where the US economy is headed, as Ajit mentioned. We don't know what the pace of growth slowdown is going to be, what is going to happen in the European economy as well with the energy crisis, etc. So given that uncertainty, there is this pressure on the exchange rate that is going to continue, and the financing of the current account deficit is going to be something that I guess we should worry about. The second parameter that I want to highlight here is the fiscal deficit of India. About a general fiscal deficit of more than 10% of GDP is one of the highest in the world right now. And that leads to a debt to GDP ratio of about 90%. For an emerging market like India, that's a very high level of debt. Now, once again, the only way forward for fiscal policy is fiscal consolidation. Right? The fiscal deficit has to be brought down over the next few years. Because again, financing this amount of fiscal deficit with the government borrowing large sums of money from the market is problematic. Today, interest expense is close to 1/5 of the total expenditure of the government, and that keeps increasing. And the more the government has to borrow from the market, that puts pressure on monetary policy as well, because if the RBI has to keep, and we have seen that during the past, if interest rates have to be kept low, then that also discourages capital inflows, and it conflicts with inflation management objective. So fiscal consolidation also means that it's going to be drag on growth. So now I want to end with the growth scenario, therefore. Even if, let's say, we assume India is growing by 6.5–7%, how do we sustain that growth going forward? The recovery from the pandemic was largely predicated upon a very strong recovery of export demand in the year 21-22. Now that is gone. Export is going to slow down from here on till there is more certainty about the global economic outlook. Private sector investment has continued to be sluggish over the last several years. Government expenditure cannot provide the necessary stimulus to growth because, as I mentioned, the fiscal deficit is exceptionally high. So then you take out investment and exports and government expenditure. Consumption by itself cannot give a 7 and 8% of growth rate that India needs, which is India's potential. And that is why I would be a little bit worried about India's growth going forward, given the two imbalances, the external imbalance in the form of current account deficit and the domestic imbalance in the form of high fiscal deficit. And I would end with that. Thank you.
Thank you. You dropped a lot of points in the table. I think that brings Rahul, actually, maybe let us talk about the most interesting aspect of financial markets nowadays, Fed pivot. Do you think Fed will pivot when the core inflation is running at 6.6%?
So at this particular point, I think, and this is a trick we saw the RBI also kind of pulling, is that, the words and the actions of global central banks may start to diverge at the margin, right? I mean, not that they are not going to be hiking further, right? So next week, we have the Fed, we have the ECB, we have the BOE, RBI has just met, RBA had just met. And most central banks are actually starting to reduce the pace of hikes. Mainly because monetary policy works with long and variable lags, and so the impact on the flow economy is going to be felt a lot more as incrementally the rate hikes are going to come through. But then central banks are basically telling us, so this was a classic example last week when Governor Das in his press conference, despite the fact that we had a smaller quantum of rate hike, we had more members of the MPC dissenting on various aspects of the decision, but then everyone came out of that meeting thinking, oh, the RBI is actually quite hawkish, right? And so it was a big push towards building credibility. And our sense is that the Fed, the ECB are also basically in the same boat, that even though they are going to be tapering down their pace of rate hikes, so we are expecting a 50 basis points next week. We reckon that maybe in February they go by another 50, but then 25. You could still see the Fed talking up risks to inflation, and that effectively is a function of kind of trying to talk down inflation expectations, right? I mean, it's something more to do with the fact that wage growth in US is kind of running close to 5.5%, and you don't want that to persist in the system, because unlike commodity prices, wages, particularly in developed economies which have large service sectors, tend to have a lot of muscle memory. And so you're trying to remove that muscle memory from the wage price setting behavior, and effectively that is why the pivot in terms of actions is already here, but in terms of words, it might still take a bit longer for central banks to kind of signal that the risk or the monkey of inflation is off their back, right? And that I think might only be a phenomena when you actually start seeing activity levels break down much more strongly than what is currently visible in the data, which is not that strong, to be honest. I mean, we recently just upgraded our US near-term growth forecasts, even sentiment indicators as commodity prices and particularly gas prices are coming off is starting to improve at the margin. So there is a certain degree of resiliency in consumer behavior, which probably keeps global central banks, continue on the path of tightening at least for the next few months, at least indicate that they are not really switching gears.
So no pivot.
Not in a more subtle way, not in a full way.
Dr. Ranade, I heard an interview about where you were saying about India should be careful about inflation next year. Can you please elaborate on that point? Now everybody thinks India has won the battle against inflation.
No, I mean, so long as we are at 7%, I still think that's inflation. So unless we have decided that 7% is not inflation, I think, the fact is that maybe because of our consumer basket, our CPI is biased in terms of food and fuel. To me, if it is anything above the target, 6%, it is still inflationary. It may not perhaps be double digit, difficult to say. I think if you look at inflation, for example, if you just take agriculture, the biggest contributor to agriculture is now meat and poultry and animal husbandry. And there is a huge amount of cost push inflation, the feed stock, something like 30-40%. And that's going to feed into, there's only so much control you can do on milk prices and egg and poultry. So that is one example of how inflation can creep into food products in agriculture. And the same is true for other prices. So I think we are not, and remember that the excise, just what Rajeshwari said, even though oil prices seem to have come off, the excise taxes have not really been reduced, which means if excise taxation is going to remain high, that also is going to contribute to inflationary situation. So there's pressure from administered prices on energy, and then there's pressure on agriculture. So I feel it's going to be very difficult, at least to my mind, to see an overall average for the whole year at less than 7%. And to me, 7% is inflationary.
So 7% inflation for let's say calendar year 23.
Yeah, I think it's going to be closer to 7 rather than 6.5. So that, to me, that's something to watch out for. The fact that the Reserve Bank of India has already started taking action, to me, further confirms that they also are thinking about getting worried about inflation. At a time when all the factors that Rajeshwari mentioned, that we are worried about growth, we are worried about export slowdown, we are worried about investment sluggishness, even then, per force, we are going ahead with rate hikes. So that obviously the inflation is coming back as a concern.
Thank you, Dr. Rajeshwari. Dr. Rajeshwari, then in that case, it's a firmer inflation and softer base.
So I would say that on inflation, I would in fact add 2 more points to what Ajit said. One is, of course, the food price inflation. Cereal prices have been quite high. And the other point is also that core inflation has been remarkably persistent. It has been almost hovering at 6% for 3 years now. And such a persistent core inflation is deeply worrisome. And the Reserve Bank of India is also clearly worried about it. And we have to keep in mind that the legal mandate for the RBI is to bring inflation down to 4%. Somewhere down the line, I feel we have lost that perspective, and we somehow keep thinking that 6% is the upper threshold, and therefore if inflation comes down to 6%, it's fine. But there is a legal mandate that the RBI is bound by, which is 4%, and inflation is significantly above that target. And with the persistent core inflation of 6%, that means that inflation is entrenched. And therefore, how do you structurally bring inflation down to less than 6% is definitely proving to be a struggle. Of course, and the other point is that there is a very high risk of imported inflation because the era of low global inflation as we knew it is over, just as the era of zero lower bound of interest rate is over. So in the US, even with a little bit of softening, inflation is around 6-7%. In UK, it is 11%. In the European Union, it's 10%. These are exceptionally high levels of inflation in the developed market. And so therefore, there's a considerable risk of India importing inflation as the rupee continues to depreciate. And we cannot ignore that. So I think inflationary pressures in India continue to persist. In terms of softer rates, I don't think we can, the real rate is still negative, even in the US it is. But at the same time, the RBI has been consistently hiking the interest rate and has turned hawkish, as Rahul mentioned. It's possible that after the next meeting, they may be pausing, they'll wait and watch for the data, because we also have to remember that monetary policy transmission works with a lag, even more in India than in the developed countries. It could be anything between 4 to 6 quarters of lag. And we'll perhaps only see the impact of this monetary policy tightening on inflation sometime next year. And at the same time, you also don't want to overshoot by over-tightening, because this is an extremely difficult forecasting act to do in such an uncertain global environment. So maybe the RBI will pause after the next meeting and wait and watch for the data and then take the next step. But I don't think that we are going to see softer rates anytime soon. We also have to keep in mind that, to put things in perspective, typically the interest rate differential between the US and the India over the last 10-20 years has been around 4%. US would keep the interest rate around 1%, India has been around 5% on average, right? Now, if the Fed pauses after 5%, that means RBI has to take it to 9%, and of course that's not going to happen. So it's an unprecedented scenario that we are witnessing, where the DM interest rate, the developed market interest rate, is at 4-5%, and even if the Fed pauses after March, even if they lowered it a little bit, they are not going to go back to 1%, 0%, or 2% of interest rate. Which means it's a constant struggle for emerging market central banks to keep up, because we are also dealing with capital outflows. Now, of course, RBI, given an inflation targeting mandate, is going to look at inflation, but I'm sure this also plays at the back of their mind, that there is this worry about interest rate differential reversing. So I don't think we are going to see softer rates anytime soon. I think we'll see a lot of uncertainty on the inflation outlook, but the good thing is RBI has finally, after being behind the curve for a while, has finally started becoming watchful and very cautious about inflation, and is finally turning hawkish. I would actually be more convinced about the intent of the RBI now to achieve the target. But yeah, I don't think we are going to see softer rates anytime soon. And also, one last point I want to add is, I don't think we should expect the central bank to do the work of supporting growth when inflationary pressures continue to persist. Because in the short term, monetary policy is the only game in town to bring inflation down. And the more we expect central bank to stimulate growth, the more it distracts attention from more fundamental reforms that are required to boost growth. So therefore, we should let the central bank do what it's doing. Thank you.
Can I just make a short point, Mr. Tyagarajan? Sorry, just half a minute what Rajeshwari said. You know, she said there's so much unprecedented situation right now. One more little data point is that the US inflation is something like 7 or 8%. And money supply growth is 0 or negative. This has never happened, so.
But they are coming from a very strong growth, 3 years long. Yeah. But just to pick a point, actually, whether Indian inflation can be tamed by monetary policy. Dr.
No, I don't think so. I mean, this is not me saying it. Everybody said. A lot of people say that India is different. Most of it is in food and fuel, and its supply. Many people use this some kind of mysterious word like, oh, this is supply. What is it called? Supply bottlenecks causing inflation, not demand. See, inflation is the rate of change of prices, and it doesn't matter if it's coming from demand or supply factors. It's basically, you can explain that to an elementary school kid that if there's too much money chasing too few goods and services, that's called inflation. But whether monetary policy can curtail inflationary tendencies in India, no, I don't think so. By the way, I'd like to quote I.G. Patel, which is something I really like that quote. Mr. I.G. Patel, former governor of Reserve Bank of India, once said, he was actually quoting somebody else, E.M. Bernstein, who said that ultimately inflation is like a social tug of war. It's between the people who won't let go of raising prices and people who want prices to be softened. It's a social tug of war. So there are people like Hindustan Lever, sorry to take a name, who will not stop at raising their shampoo prices because they say, oh, cost push, ke wo. And then there are people who just can't afford things, basic things. They want prices to be lower. So ultimately, the bigger contribution in this social tug of war is not just monetary prices, policy cutting interest rates. That works in developed markets much better, but even, transmission and all that. Really, it is about administrative measures. It's about trying to do other things to reduce the, if it's all about supply-demand imbalances, you have to figure out how to reduce those imbalances. So we do things like, they sound very draconian, so please don't get shocked, but we use things like stock, what is it called, stock limits. If people are hoarding food grains or hoarding stuff because they want to stock up and create scarcity and let prices go up, you got to intervene there. If supply is not growing, you need to say import. But now, if you're going to import stuff, you're going to actually create import inflation. So it's not going to be easy. It's going to take a combination of administrative measures, monetary measures, whereas fiscal measures also. You cannot, sorry, I'll take one more minute on this. There was a lady, Prime Minister, her name was Liz Truss. She said, we are going to fight inflation by giving $500 to every household, or 500 pounds. You can't spend money and reduce inflation. She said that she said that we will. I mean, it's very kind of voodoo economics. But one of the strategy was we are going to put money into everybody's pocket so they can deal with inflation. You can't have fiscal expansion. You can't have and fight inflation. So the contribution from fiscal side has to be actually to curtail spending. We got to reprioritize spending because all spending is inflationary, especially fiscal spending. So it's not going to be easy, but I think we'll have to see a combination of all these three.
Can I take literally half a minute? So the way monetary policy comes in is, if, again, very simply put, as Ajit said, explaining to a small kid, if it's a supply-constrained environment where there are supply problems, and if you keep monetary policy loose, you'll be encouraging demand. So encouraging demand in a supply-constrained environment is a sure-shot recipe for inflation. So at least the one thing that monetary policy should not do is encourage demand when there are supply constraints.
Mr. Bhattacharya, we will talk about the most interesting point. Whether the monetary policy divergence can be addressed by depleting FX reserve, that is, spending out of FX reserve. We saw this, a 100 basis point rise in repo rate, you have saved $100 billion.
So I'll approach this in a relatively indirect fashion. I'll not get into the point directly. One, following what all my fellow panelists and particularly Rahul mentioned, all global G10 central bankers, except the ECB, seem to be falling over themselves to try to signal that they are slowing down their rates, almost as if they are embarrassed by what they have done. Definitely all of them are going to slow down. On that side, it's important. Second point is, in our quest to get to a 4% inflation, we should make sure that we don't also get to a 4% growth. Yeah, so that's very, very important. Yeah, too much of a good thing will certainly lead to problems because remember, all of these effects are very non-linear. Although things look very cool, good, hunky-dory as of this point in time, there are these processes are very non-linear. You never know what tipping point is probably it might come in. One point that we have not talked about so far, that's one part that is actually driving growth and demand, aggregate demand, is credit. Credit demand remains really remarkably strong, and particularly even for the MSME sector. That's what is really surprising, and there's very little sign of stress, even in those segments who, having been exposed to the series of shocks that we have seen over the last 4 or 5 years, still remain very, very resilient. And that demand is growing. At what point that credit demand begins to fall off is very important. That brings us to the third question that you asked in terms of the instruments that are available. So obviously all these instruments, whether it be the domestic rates, whether it be the exchange rate, whether it be whether it be liquidity management, all of these things are part of the whole monetary policy, fiscal policy, whatever, inflation control, price stability policies. One thing in the external environment that we still haven't talked about, it's not just the rates, which all central bankers are signaling that they are now going to slow down. It's the other part, which is the quantitative tightening and the effects of that, the non-linearity of that coming into play in the global economy and then spilling over into India. I mean, that's something that, which is completely untested, because, I mean, we haven't seen quantitative tightening for God knows how long. Nobody knows what effect that is likely to have. And remember, cutting down from an $8 trillion balance sheet to a $7 trillion, then to a $6 trillion is going to be very, very non-linear. So the final point in all of this, yes, exchange rates are going to be an important tool in this entire control issue of price stability. And these are connected. I mean, the whole macro is connected. I mean, you cannot let go of one and try to control the other. But exchange rates will probably act as an automatic stabilizer when domestic financial conditions are being tightened. So that's going to work. And RBI, to their credit, have done a very good job in terms of managing the exchange rate, because if you'll see, it's not just a matter of moving against the dollar. It's the dollar strength that has Mr. Tyagarajan, you have written the book on this. So, I mean, our real effective exchange rates have been very stable. And on top of that, we have managed to keep the rupee, the USD INR rupee rate, in a very tight band if you compare it with a set of emerging market effects, EM effects, the more stable effects. So, I mean, all of this, so the exchange rate will definitely play a part, but you need to be careful, because as Rajeshwari also mentioned, because there is that element of imported inflation, you need to have a tab. But most certainly, given the reserves that you asked, the first question that I have taken so much time to try to get to, the best measure that I've seen of how good, how effective the reserves are, is this measure, the IMF's measure called ARA, Assessment of Reserve Adequacy, ARA. Yeah, so that showed that we were very, very comfortable when we were at $650 billion worth of reserves, but that has now come down to about 2018, 2019 levels. So you cannot afford to fritter away the reserves trying to block a move in the currency which is due to exogenous factors. So obviously that currency management is very important. One final thing, it's no longer just a matter, given if this quantitative tightening that we are thinking is likely to have an effect. It's no longer a matter of just controlling exchange rate volatility, as the RBI publicly says. The governor in one of his speeches had mentioned that a secondary objective of the exchange rate management is managing expectations, because when there is a dollar shortage, if there is a significant move, the dollar shortage becomes exacerbated, and that's what needs to be managed. So that's a broad answer in what I say. So sorry about going on.
Yeah, thank you, Mr. Bhattacharya. Actually, Rahul, quickly about the BOP deficit. Whether the large fiscal deficit is translating into large current account deficit, that's why we are going to have BOP deficit in the foreseeable future. In that case, probably the exchange rate, the apprehensions of a sharp rupee depreciation over the next few years actually valid.
So I would say, the linkage between, say, the fiscal and the balance of payments effectively is a function of total savings in the system, right? I mean, it sort of gets connected to how much investment we are doing either on fiscal side or on the private side, and how does that sort of translate into the external balances. At this particular point in time, I would say, there is no real contradiction between what the fiscal policy is sort of doing in reality. I mean, the actual borrowings, both by the center and also by the states, has been a bit lower than what was indicated, and that's probably reducing the pressure. We have not necessarily seen bond yields spike up very dramatically in response to these pressures. Even on the current account side, I mean, so the way we look at it, I mean, Rajeshwari mentioned that we'll have a number around 3.5%, this year. I mean, I think that's ballpark correct. But then the annualized rate, right, the run rate of the current account deficit, which was running closer to 5% at the middle of the year, is now probably around 3 and maybe going towards 2.5, right? So just at the margin, right, because FX markets are flow markets. I mean, they tend to be driven by flows rather than necessarily by stock of activity. And so in that particular situation, the pressure on FX is coming off. In fact, the rupee actually has been doing poorly, I mean, despite the fact global conditions have improved. And I don't think that's just a function of India's fundamentals being poor, right? I mean, the flow environment has actually been improving both on the current account and the capital account. And what we see is that the parallel build-up in the reserves on the RBI's books, I mean, partly because of valuation, but probably also because of intervention is increasing. I mean, the lesson I kind of take away from it is that RBI in the last 4 years has had this strategy of an asymmetric intervention bias, right, where they have been very aggressively buying dollars and then also not allowed the rupee to become expensive in real terms, as Shogatoda was saying, but then also have deployed that reserves very heavily when they felt that they had to protect the range. So this tight range environment is probably something that could also work on the other side if capital flows incrementally were to come back in a mean reverting fashion. So I think the focus on macro stability is something that comes across variety of policymakers, whether they are in Delhi or in Mumbai, that emphasis on maintaining stability in markets, in macros, and also in terms of sentiment is probably going to be the overarching objective of the way we manage our fiscal balances, the way we manage our current account balances, and the way we manage the financing, which is definitely probably the most challenging aspect, as Rajeshwari said, looking out into 2023. I mean, that's probably going to be the one defining factor. The one good news, I think, or at least, the revealed behavior has been that both the rupee and the bond yields peaked out sometime, I think, in June, July. That was the rupee a bit later, bond yields, and so there's been a degree of, I guess, belief, or, like markets have been relatively stable in India compared to what we see elsewhere. And that probably sets us up for a relatively less turbulent 2023 compared to other countries, because bulk of the financing, at least on the fiscal side, is domestic in India, so should not create so much of negative spillovers looking into next year.
Thank you, Rahul. Actually, Dr. Rajeshwari, one quick question. With there being no fiscal room and there is absolutely no monetary space, how the recovery could gain traction? Because exchange rate depreciation is one route.
Before answering that question, I just want to make one comment, which is what Shogata mentioned on the credit growth. So it is true that credit growth has picked up remarkably from about less than 6% during 2020 to 17, 18%. But we also have to be mindful about the composition of the credit. Because if I look at the last 6, 7 years, the share of industrial credit or business credit in total bank credit has fallen from about 46% to 28%. And the share of retail consumer credit has gone up from roughly around 18% to 30%. So today, retail consumer credit is a larger share of bank credit compared to business or industrial credit. And the reason that's worrisome is, in absence of a developed bond market, there is no supply of credit for the industrial sector or the business sector. Of course, the other side of it is there is no demand for such credit because the recovery of the private investment cycle proves to be elusive. But while there is credit growth, we also have to be mindful about what sector the credit is going to. It's not really going to the business or the industrial sector. That was getting credit during the boom years of pre-2008. So on the exchange rate point, so yes, there is no room for the fiscal policy to be accommodative or stimulative to support growth. Monetary policy, as I mentioned, needs to stay focused on inflation. Therefore, the way I look at exchange rate is, at the end of the day, exchange rate is a price. And when we have a current account deficit, that essentially means there is a mismatch of demand and supply of dollars. We are demanding more dollars than there is supply, and that's why there's a current account deficit. So in the short run, the only way to restore that external imbalance is by letting the price adjust, which is by letting the rupee depreciate. And the more we'll delay the process, the more the pressure will build up, the more tricky will RBI's job get, because trying to control any price in a relatively open economy is extremely challenging. The question is, how does the RBI do it? You start losing reserves, and then at some point you realize you've lost too much reserves, then you stop. It's a constant bet against the market, which is extremely risky. And RBI possibly cannot be using interest rate to defend the currency as well, since it has an inflation targeting mandate. So I don't particularly think that defending the rupee, managing the rupee is a strategy that the central bank should be following, considering we have decided to keep our capital account open. We need capital flows. And also, there are two advantages of letting the rupee depreciate. One is, of course, we should let it respond to the supply-demand forces. One is that as the rupee depreciates, the exports become more profitable and the imports become more expensive. So there is a natural adjustment mechanism for current account deficit in the medium term. And also, if you let the rupee depreciate, there is some price at which the Indian assets start becoming attractive to foreign investors. There is some price at which returns on government bonds in India start becoming attractive. So, and then that's a natural adjustment mechanism because that builds an expected appreciation. And as inflows start coming in, the rupee starts appreciating. But the more we try to delay that process of adjustment, the more distortions are going to keep building up. So I think the two most important things that we have to do in terms of boosting growth or even sustaining a 6% growth rate, whatever it may be, is to let the rupee depreciate and also to give a lot of focus on boosting exports. I think not enough is being talked about. Even in a slowing global economy, the share of India's exports in global exports is extremely small. Now, with China withdrawing largely from the international trade landscape, with Russia suffering from sanctions, there are two large Asian economies which have pretty much shrunk their share of international trade, creating a historic opportunity for India to fill up that gap. Exactly what countries like Vietnam and Philippines are doing. That is something that we should be focusing on. That is something we should be prioritizing in order to create growth and jobs, because the manufacturing sector is contracting. That's the pillar of job creation in India. So that is not going to pick up anytime soon. It hasn't happened in a very long time. Industrial credit is not picking up. So export is something that I think needs to be brought on the forefront of strategy and policy making. And we have to convey to the world that we are an export-friendly, export-oriented economy. And whatever it takes to do that. I mean, you let the rupee depreciate, you let the exports become competitive, you stop being protectionist, you basically extend welcome to foreign producers who want to come in. FDI has been stagnant at 2% of GDP over the last 10 years. Not a particularly good news for a country who wants to be seen as a global powerhouse of the next decade. So I think in terms of boosting growth, exports should be something that we should be focusing on, and policy making should cater itself accordingly. And rupee depreciation is one small part of that package. Thank you.
Thank you.
Mr. Tyagarajan, I'm so sorry to interrupt, but we just have another 5 more minutes to conclude this session.
Yeah, absolutely. We also keep a track of what is that. Anyway, actually, Mr. Bhattacharya, the 6% fiscal deficit, is it becoming a new normal?
No. So very quickly, it's not. The finance minister in her speech was very clear about this. That, I mean, the old FRBM glide path is gone. So that 3%, 3.5%. We are now looking to move to a 4.5%. So that's the step, 50 basis points reduction every year. So probably from the 6.4% this year down to a 5.9, then 5.4, etc. So I mean that 6% thing is not normal anymore for the center. States are a bigger problem. So states, that's a separate matter of conversation that I'll take up later.
We are not talking about the state. Dr. Rajeev, quickly, fiscal prudence, whether it is the need of the hour.
This is a tough question for me to answer, because I have got this lady sitting on the right who have given all this very gloomy picture about the fiscal situation. And I used to be, until recently, I'm now in academia, but I used to be a votary of fiscal support. Not an easy question. I think given that so many, as was discussed extensively, the drivers of growth, all of them have some issues, although we heard that perhaps exports through currency depreciation might have a chance. So I think even though fiscal consolidation has to be pursued over the next few years, in this particular year, 2023, I would not recommend a sharp consolidation.
Okay. The last statement actually basically key risk that you foresee for 2023. Rahul, you go first.
Sorry, the key risk for 2023?
Yeah.
I think the global risk is basically how do we live with very high interest rates that we have not seen in almost a full generation. I think the way we put it is that 2022 was the year of very sharp monetary tightening. 2023 will be the year where we have to live with it. For India in particular, I mean, one particular issue that we are watching closely is basically how much can we do on the pandemic measures which were introduced. There is a need to think about sunset strategies around it, particularly given our food stocks are becoming more normal. So that's a risk, you know, it's an unknown. We don't know how that plays out. But yeah, that's something we are watching closely.
Okay. Mr. Thawadan, what is the key risk in one sentence?
Key risk in one sentence is the external environment. I mean, there's no doubt about that. That's the one to watch.
Dr. Rajeshwari.
Financing a high level of current account deficit in an extremely volatile global environment, and not for next year, but I think the structural risk that we should all be very worried about is creating jobs. I'll just leave you with one number. Since 2015, the total number of workforce participation, the total number of people participating in the workforce has been stagnant at 400 million since 2015. There was a sharp drop to 300 million when the lockdown was announced, and it's gone back roughly to 400 million. So stagnant workforce participation from 2015. No matter what growth numbers we talk about, that to me is a serious sign of worry. Thank you.
Dr. Rajeev.
Madam, that what you said, meeting the fiscal challenge and job creation, these are challenges, these are not risks. So please, I'm not being nitpicking, these are challenges to the economic policy maker. He was asking about risks. So I agree with Sogato, the main risks are geopolitical. So it can, you know.
Thank you. The risk is the hostess might jump into the dais meeting. Okay, thank you very much. Actually, basically, you are out of time. Okay, it has been wonderful talking to all of you. And thanks, Almus, for making this occasion memorable. Thank you very much.
Thank you so much, Mr. Tyagarajan, for joining us. I'd like to invite on stage Mr. Bijur to please give the memento to all our panelists. Mr. Jairam, could you please come up on stage? Ladies and gentlemen, a huge round of applause for all our wonderful panelists right here. A louder round of applause, ladies and gentlemen. Thank you so much, everyone. I'd like to invite Mr. Bijur to please announce the winners and give the vote of thanks.
It's good to see so many people. It's 6 o'clock already. And the one job which I don't want to do is, it was a bit taxing on me, is closing summation. I am not going to do it. I'll promise it you that it will be mailed to you. And I'll straight away switch on to vote of thanks. And it's my duty to thank the mentor, Mr. Padmanabhan sir, who has done a lot of work behind the scene and guided us. A big thank you to sir, and I'm sure you're going to support us next year also. My thanks to Tyagarajan, and I have to thank another Prabhu, Mr. K.S. Prabhu. He was behind the conference and in so many ways and guided me and all. And he took a lot of time, so Padmanabhan and all. And all the speakers, for want of time, I am not going to name the speakers. However, I would like to name the sponsors. The NSE, our principal sponsor, Union Bank of India, CP Plus, our client, RBL Bank, the banking partner, CFO Bridge is the new partner this time, and Gandhar, GJPC, and Trontech. And we have also few supporting sponsors. They are Rosie Blue, Navneet, Nagarika, To The New, Sai Marine, Devi Fisheries, Vajral Tucker, Janta Fish Mill, SR Capital, Crestflex, SVC, Fine Jewelries, and R Square. These people have really supported us. and that otherwise this conference would not have been in this style and all. Our core team at Almus, Maulik, Suman Prabhu, Dinesh, Kushi and Seema, they are the core team. They have done this to it, and to, of course, to the Pine Tree, who is the event manager, all in Pine Tree. My partners, Jairam, Pankaj and Mr. Govardhan, the Sofitel Hotel Management, and I would like to share here, I am Lucknow, 5 the people who are studying there, they have come all the way from Lucknow here to attend the conference. A big thank you to you. And we also organized a contest for them. My promise is that I don't want to make it a hurry, announce that. We'll do some webinar or something like that. In that, I will declare the prize. And of course, the prize money will be delivered to you. It will not take time. And the last one, the power of declaration, we always believe in Almus. Next year is the 10th year, and this conference is going to reach the global level. What I mean global level? More bigger hall, maybe more global participant, and to deliberate more global speakers, and that is the promise to you all. I have coincidentally, I'm completing 20 years in business, and 2023, I'm going to see this conference reaching a different level. Again, thank you all the participants who have come here. If not for you, the conference. And today at 6 o'clock, we proved that people stay here if the contents, if the speakers are good. I could manage the time well, but it is always challenge to manage to challenge with the central bankers. So happened the early morning central bankers were there, evening also former central bankers were there. So we have delayed by say 5 minutes. Thank you once again. Thank you all.
And before we end, a big loud of applause for Venkatesh Bijur. And he deserves, in fact, really it is so pleasing to see all of you at 6. We never expected, very frankly. He is the man who has been tirelessly working with selfless commitment and a passion to make this conference happen. So indeed, he deserves a big round of applause. Thank you all very much. We complete the session.